A key feature of this conference is the combining of research with industry perspectives.
It's an opportunity for us to all dig deeper into the community banking model and the important role of community banks now and, of course, into the future.
What takes place at this conference each year is known and appreciated by numerous constituents around the world.
It has provided for over a decade now
perspectives of all market participants,
from academics,
policymakers,
regulators,
and community banks,
to figure out what is working and what is not working.
You'll see there are a lot of additional questions that help kind of drill down into these topics.
Researchers here, the researchers in the room, thank you all for doing this stuff, because this is not what I do.
I think one takeaway that I get from these papers is a lot of the value in community banks resides in the people who work there. A lot of that value sits in the employees. We create relationships with people, not necessarily with institutions.
We truly do have an unwavering commitment to relationship banking. We focus on cultivating very long-term connections with our customers, and I'll say particularly small businesses.
To me, a relationship is when you go to the next party, or you go to a dinner party, or you're out with your friends and someone says to you, I'm looking for a new bank, who should I call? I want you to say Connect One Bank. That's the value of a relationship.
They mean it when they say that they focus on relationships. It's every strategic decision. It's every person they encounter in their day-to-day. They are focused on relationships.
I think if you truly believe in relationships and you continue to instill that throughout all your organization, you make that your culture of your organization.
We are only one part of a larger interconnected system. It's hard to survive in a desert alone.
What makes a community bank? Without that mindset of prioritizing customers, prioritizing your community, trying to give back to them, I think you're just a big bank but smaller.
Despite all the shifts that have gone on in the banking industry, community banks remain a vital and source of reliable capital to their communities.
But it's also about the art and the science of community banking. So the art, the practitioners, the community bankers, and we just heard from a few of them at our last panel here. And then the science was the research.
Community banks generally are more exposed to very specific localized shocks, and they also do not benefit from the too big to fail guarantees that the largest banks of the system get to enjoy.
The big banks in Tampa Bay were calling me to say, Corey, can we put one of our customers in line at your bank? And we understand we're going to lose the relationship because of it, but you just got to help them.
Corey saw firsthand how strategic combinations have had positive effects in the communities he serves.
So what it tells us is that relationship lending is valuable on average, but it's even more valuable during bad times, and that makes sense because that's the time when there is significant demand for those distressed borrowers, and community banks having that informational advantage, they're able to utilize that comparative advantage and extract more value.
You remove a community bank from a rural community in northern New England, or in the lower Appalachian, or even in greater DC in certain communities, and you're going to feel it.
Ultimately, we all share the same goal of promoting a safe and sound banking system.
All right, good morning, and welcome to the 13th Annual Community Bank Research Conference. Those were highlights from our 2024 conference, so I guess full disclosure, you may see yourself in the 2025 highlights if you are here today, so next year. This conference is being recorded, so before we start, I just ask that everybody just please check your phones, make sure they are silenced. We want to be able to ensure full engagement by all of you here in the room, and of course from our webcast audience who are joining us via communitybanking.org. So welcome to all of you, and welcome to our webcast audience, and certainly we look forward to today's discussion and conversations as we continue this long journey that we have been on since 2013, exploring community banking research and adding just valuable perspectives through all of the community bankers, regulators, fellow researchers, policymakers in the room today. So welcome. Just a couple housekeeping items within the room here. In front of each of you is a hot mic. So right now it should be red. If you touch that gray spot, it becomes green, and they are very, very sensitive. So if you have a side conversation that you want everyone to hear in the room and also on the live stream, by all means, hit the gray button. Please be mindful of that. Again, we want everybody to be able to be present and engaged, whether they're here in the room or participating via the live stream. And I guess to that end, if for any reason you need to leave the auditorium, because this is being live streamed and recorded, we just ask that you leave through the back doors on my left, your right. And we understand there are reasons people may need to leave, but if you could just use the rear entrance, we would certainly appreciate that. So there's a lot of elements that combine each year to make this conference what it is. It keeps changing. It keeps developing. People bring ideas, and those ideas then come to fruition each year at this conference. And all of you are part of that in many different ways. But the anchor for this conference really is our sponsoring agencies. That is the Federal Reserve System, the FDIC, and of course the Conference of State Bank Supervisors. The St. Louis Fed is delighted to host each year. But there is a planning committee that handle every single detail of this conference. And before we really jump into the formal proceedings, I would like to ask every member of the planning committee to please stand and be acknowledged. We meet starting in January every year, and it culminates today. So please, our planning committee members, thank you all. And that's not all of them. We have a number of planning committees who could not join us, but who are joining us on the live stream. So we acknowledge and thank all of you as well. Another feature of this conference is what we call the Emerging Scholars Program. This was created in the early years of the conference, and the idea of the Emerging Scholars is to identify PhD candidates that are exploring a banking or community banking related topic. And there's a lot of value if you are an emerging scholar to be in this room, because all of you represent kind of the vastness and the richness of this banking and regulatory and policy ecosystem. And so through the Emerging Scholars Program, 3 individuals this year have been identified. They are here to talk to you. And so I would strongly encourage you during networking breaks and others to actively seek them out. I'm going to name them now, and I would ask if you stand as I call your name. Jean Kang, Haas School of Business at UC Berkeley. Anthony Weichel, University of Georgia. And Renan Liu, McMaster University. If you can join me in giving our 2025 Emerging Scholars a round of applause. Please, please, please find them during networking breaks, talk to them. I know they are very interested in talking to you, and we are delighted. And thanks to CSBS for continuing to sponsor the Emerging Scholars Program each year. I mentioned our sponsoring agencies, and you're going to hear from representatives from all of the sponsors. But at this time, I would like to direct your attention to the screen as the Federal Reserve's Vice Chair for Supervision, as of February of 2025, who is not able to join us in person this year, but has prepared some welcoming comments for this year's conference.
Welcome to the 2025 Community Banking Research Conference. While I regret that I'm not able to join you in person this year, I would like to take a moment to acknowledge the contributions this conference has made and continues to make in promoting research on community banking and related issues. Since 2013, this conference has synthesized insights and perspectives from research, regulatory, and banking communities with a single goal: deepening our understanding of the community bank business model in order to better inform future policy decisions. We share this goal and the sponsorship of this event with the Conference of State Bank Supervisors and the Federal Deposit Insurance Corporation. We are very proud of this ongoing partnership with CSBS and FDIC and the effort to further actionable bank industry research. As the former Kansas State Bank Commissioner and a community banker, I very much appreciate the goals of this conference. And again this year, the organizers have included valuable research and created a conference program that includes a wide range of perspectives that create an opportunity for discussion and debate. Ensuring the future and viability of the community banking industry continues to be a top priority, especially as the President recently appointed me to serve as the Vice Chair for Supervision of the Federal Reserve Board. This position, which was created under the Dodd-Frank Act in 2010, requires the Vice Chair to develop policy recommendations for the Board regarding supervision and regulation of depository institution holding companies and other financial firms supervised by the Board, and to also oversee the supervision and regulation of these firms. It's an honor and an absolute privilege to be entrusted with these important responsibilities. And I look forward to working with all of our stakeholders in the financial industry to modernize supervision and regulation that allows for continued economic growth and innovation in the banking system, and that enhances the critical role of community banks. Community banks are the cornerstone of local economies, providing credit to local customers and businesses with few alternatives for accessing financial services. The community bank relationship model requires just that, relationships, direct knowledge of, and a connection with the community, which makes this banking model truly unique and even more valuable. But this model continues to face challenges that I am confident this conference will explore in greater detail that will help us to inform future policy developments. When I spoke at this conference last year, I described a framework for community banking regulation for the future. In those remarks, I discussed the necessary building blocks for building an effective framework. These include reviewing, reconsidering, and indexing the asset size thresholds that are used throughout our current supervisory and regulatory framework, gaining a better understanding of the trade-offs of regulation, identifying the hidden costs of supervision and supervisory guidance, streamlining the mergers and acquisitions review and approval process, and identifying ways to promote new bank formation. Since that time, the Federal Reserve has already launched several initiatives to advance these goals, but there's more work ahead. We are also refocusing supervisory efforts on core material financial risks, reviewing the CAMEL's rating framework, revising the community bank leverage ratio, and considering ways to improve the treatment of mutual banks. We are also prioritizing work to assist in the fight against fraud. In the coming years, this conference will be an important mechanism for continuing to explore challenges facing the banking industry, and especially community banks. And with the work that we're currently undertaking, we will continue to prioritize changes to the community bank regulatory and supervisory framework that will allow community banks to continue to thrive. Over the years, this conference has highlighted the important role community banks play in our economy, the impacts of regulation on our banks, the disproportionate cost burden from regulation on our nation's smallest banks, and the importance of having a strong, diversified network of community banks. It is critical that our regulatory and supervisory framework continues to support a network of these banks across and throughout the country so that they are positioned to support the economy and to meet the credit needs of their communities. As I work with staff across the Federal Reserve to enhance the Fed's supervision of banks, I'm reminded how the research presented at this conference over the years, along with the findings from the CSBS annual survey of community banks, have consistently demonstrated the need for regulatory tailoring. This has given us a better perspective to understand and measure the cost of compliance. In short, this conference truly matters. Each year, the research presented here moves us forward. It improves our understanding and combined with other insights from key stakeholders and our own experiences, enables us to make better regulatory and supervisory decisions. From the first year of the conference in 2013, we've seen a number of changes in the banking and financial systems, in our economy, and in our supervisory and regulatory structures. The research presented here each year has evolved with these changes and has delivered critical and timely insights. I am so pleased that this conference has not strayed from its original mission, and that it continues to provide a forum for the discussion of thoughtful, timely research into our country's unique community banking business model. Community banks are vital to the U.S. economy and to the thousands of smaller local economies that they serve across the country. It's important that we continue to study and understand the important role that they play. This conference helps us to increase this understanding. In addition to presenting thoughtful research, it improves or provides an opportunity for open dialogue between community bankers, academics, and policymakers. In these ever-changing times, the unique combination of research presented in combination with real-world perspectives provides insights that help to ensure the community banking model endures well into the future. But this conference is just one aspect of the Federal Reserve System's engagement on issues affecting community banks. Outreach to banks of all sizes, including community banks, has been a top priority for my work because your voices must be a part of the conversation in Washington. In a few days, the board will host a community bank conference in DC. It's the first of its kind, where we're bringing together bankers, industry experts, and other stakeholders to discuss and identify the most relevant issues facing the industry. This event will be live streamed on the board's website, and it will include several unique and exciting speakers and panelists covering a number of current issues. I hope you'll enjoy watching it. Thank you for your continued interest and engagement in supporting the Community Bank Research Conference.
All right, thank you to Governor Bowman. And as she noted, that conference is on October 9th and will be live streamed on the board's website. We may have to rebrand this week Community Banking Week. This is a chock full of community banking research and information taking place here and, of course, in Washington this week. So, again, always appreciate her longstanding support of this conference. So at this time, I would like to introduce Tony Salazar. Tony is the Commissioner of the Maryland Department of Financial Regulation, and he's also the current chair of the Conference of State Bank Supervisors. Background, Commissioner Salazar is an attorney with a distinguished 39-year career in the banking and financial services sector. He is currently serving his 8th year as Maryland's Commissioner of Financial Regulation. He is an active member of CSBS. Obviously, he serves as the chair of the Board of Directors today, and he is a member of the Non-Depository Supervisory Committee. In addition to his regulatory duties, Commissioner Salazar is a member of the Maryland Commission on Financial Education and Capability. We've had the privilege of working with Commissioner Salazar for many, many years, and I am delighted to welcome him to this year's conference and to welcome you on behalf of the Conference of State Bank Supervisors. Please join me in welcoming Tony Salazar.
All right. Thank you, Jim. Good morning, everyone. I want to welcome you on behalf of the CSBS, at least, and our other sponsors to the 13th Annual Community Banking Research Conference. As chair of the CSBS Board of Directors, I also want to thank our co-sponsors, the Federal Reserve System and the Federal Deposit Insurance Corporation, the FDIC. And I want to thank our host, of course, the Federal Reserve Bank here in St. Louis. They always do a wonderful job, and this is a great location. So this conference is a wonderful partnership. You heard Governor Bowman talk about that, and we look forward to a couple of great days here. You know, we often hear about how the work presented here helps policymakers understand the empirical value of community banks. But I believe it also plays another important role. This conference and the research that it fosters helps hold us as financial supervisors accountable by showing us the impact of supervisory activity and the areas that need attention, and also by demonstrating potential approaches to addressing the challenges that are facing the community banking system. So in addition to serving, as you heard, as chair of the CSBS, I'm the Commissioner of Financial Regulation for the state of Maryland. My agency charters and supervises 19 community banks, and we license and oversee a large number of non-depository institutions. Like my counterparts in every state in the country, our job is to ensure consumer protection, maintain the safety and soundness of the financial system, and encourage economic growth in the state. In other words, our role involves building trust with both our state consumers and with the institutions that we supervise. State regulators meet with community bankers that we supervise on a regular basis, and we know their relationship banking model and the businesses they serve. We recognize that community banks are locally owned and operated. They want their communities to thrive just as we want them to thrive, because we all want strong, growing economies, and that all requires a tremendous amount of trust. We face a complex landscape of challenges today, including rapid technological advances. We face limited resources, the bank merger movement, and fluctuating federal policies. My office, despite having significant authority to protect consumers and ensuring a stable financial system, operates with a relatively small team of fewer than 100 and a budget of approximately $20 million. That means that we, like many other state regulators, must be strategic and accountable in how we use our resources. State regulators must make tough decisions on how they deploy their limited resources to be effective, and we need to ensure that our institutions and the broader system operate with integrity. However, we're not passive with those constraints. We continue to lead in areas such as non-depository licensing and supervision through state collaborations, and we're developing technology for more efficient and interconnected oversight. And we're strengthening our enforcement and coordination across state lines. Despite these challenges, state regulators like the OFR remain dedicated to consumer protection and maintaining a trustworthy financial system. But let me highlight, just to emphasize the importance of trust, the technology area. The current pace of technological change is unprecedented, and it presents both opportunities and risks. Digital assets, biometrics, facial recognition, they all offer the potential for broader access to financial products and system improvements, yet they also introduce significant risks, including fraud, profiling, and potential government overreach. Trust in our financial systems and the community banking system is paramount, and as a regulator, I'm acutely aware of my responsibility to foster this trust in every decision I make. As supervisors, we must not only understand these technologies, but also their potential implications so that we can effectively supervise, advise, and support our community banks, and to appropriately influence public policy. Trust in financial supervision is always important, and state regulators recognize that we are committed to filling gaps and ensuring that financial institutions always receive the oversight they need to ensure their safety and soundness. So, how do you establish trust in financial supervision? I often think of the quote that trust is built like a tower. It's like a tower of stones, one stone at a time, and that gives a good visual of how we approach accountability in the state regulatory system. We work incrementally, just like this conference, through our work and our outreach. States are known to be laboratories of innovation, and part of their composition is embracing new technologies. For example, Arkansas has its Innovation Lab, New York has the Innovative Bit License, and in Maryland we have an Innovation Committee in our office and a designated Innovation Contact. Earlier this year, my office surveyed our community banks and their use of artificial intelligence, which of course is becoming more pervasive in our personal and business lives. We found that the community banks in Maryland are growing comfortable using AI for fraud prevention, customer service, and improving their decision-making processes. Through the survey, we recognized the opportunities where we as regulators can provide guidance, resources, and regulatory clarity to help foster responsible and effective AI adoption in the financial services sector. But innovation also means looking to new ways to support our state residents as well, like fostering an accessible financial ecosystem. A couple of years ago, my governor signed the groundbreaking Access to Banking Act to provide incentives to state-chartered financial institutions to provide low-income communities with ongoing access to the financial system. The legislation also created a Community Investment Venture Fund, which we launched in June. And that fund is working to pair financial innovators with our state-chartered institutions. And the fund has received enormous interest from both fintech companies and our state-chartered banks. And I look forward to and have high hopes for this initiative. Now, another way we supervisors build trust is through collaboration. State supervisors collaborate with each other regularly, and we also work with our federal counterparts closely. Though there are sometimes differences in our approaches and our directions, we do always find ways to work together to improve supervision and maintain that important trust in the system. Because at the end of the day, we all agree as to our goals, protecting consumers and ensuring that our financial system retains its status as the best in the world. This conference, co-sponsored by CSBS, the Federal Reserve, and the FDIC, reflects that relationship. State supervisors are also represented on the FFIEC, State Liaison Committee, and the FSOC. That representation, I believe, improves trust between the agencies and gives greater confidence to the public that decisions are made with representative input. So ultimately, public policy built on sound data and research builds trust, and that underscores the importance of this conference. Bankers, you've shared your pain points and your successes over the years, and I've seen how that inspires the researchers to come back every year with data that can help the policymakers and academics. And the academics, your research is building a repository of information that strengthens our financial services ecosystem. And finally, we as regulators are learning from conferences like this how we can better support the institutions we supervise and the consumers we protect. And that, I believe, is how trust is built, right? One stone at a time, building on each other. As we move forward at this conference and in the future, let's embrace the opportunities ahead and commit to fostering innovation and collaboration, and to collectively navigating the challenges we face so that we can ensure community banking remains a trusted cornerstone of our financial system for generations to come. Thank you.
Thank you, Tony. I'd now like to ask our team that is going to present the findings from the 2025 CSBS Annual Survey of Community Banks to come to the front of the room. As we noted at the top of this conference, there are a lot of different elements that combine each year to provide insights and perspectives around this conference. Since 2014, CSBS has offered this annual survey through its own and through the significant efforts of our state banking commissioners and, of course, through the community banks that respond to the survey. The idea was to provide more current information in terms of what community banks are facing, but also to gather some real data that can be used in research, in white papers and others, and certainly over the many years of this survey, that is exactly what has taken place. So again, special thanks to CSBS, the commissioners, and to all of you who actively participated in the survey for your efforts. Quick housekeeping item, if you are wondering why maybe your Wi-Fi isn't working, thinking, I thought the St. Louis Fed would have better Wi-Fi, it appears that we may have left off an @ symbol in front of that password. So if you look at your Wi-Fi card, before the letter F, put an @ in there, and the world will open up to you. So apologies for that. And we're printing some new cards too. They'll be available outside, so I don't have to keep reminding everybody of that little addition. So also, those of you who have registered and those of you on the live stream, you should have just seen in your inbox that the 2025 survey was just sent to you. So there's a link on communitybanking.org. There's a link on CSBS's website, csbs.org. Everyone in the auditorium should have a hard copy. I see some of them out right now. So please follow along while our presenters, Joey Samowitz, Senior Policy Director at Policy Development at CSBS, Tom Seams, the Chief Economist at CSBS, and Kathleen Navin, Senior Business Economist in the Supervision Division here at the St. Louis Fed, present findings from this year's CSBS Annual Survey of Community Banks. So with that, Joey, I think I'm turning it over to you.
Thanks, Jim. Welcome, everyone. We are excited to share the 2025 results of the 12th CSBS Annual Survey of Community Banks. 12th, time flies when you're having fun. These two experts, as Jim mentioned, are going to help me disseminate this year's results. I say this every year, but it continues to ring true. It's been an interesting year in banking. Last year, we presented on the heels of our first interest rate cut since March 2020, on the back of what many economists were calling a soft landing. Now we are again presenting after an interest rate cut that comes with a backdrop of a unique operating environment for banks and the broader economy, with tariffs, a government shutdown, and an abrupt pendulum shift towards a more relaxed regulatory policy environment. Based on this year's survey, we can see bankers continue to be impacted by rates and a competitive environment for deposits, while feeling better about that regulatory policy environment. This year's survey questions focus on current banking conditions, liquidity, regulatory risk, and technology. We also included special questions on deposit insurance and compliance costs. I encourage you all to pay attention to these results. Bankers are at the front lines of the economy, seeing trends take shape before it bears out in the data. At the end of the annual survey that you have in front of you, you'll see our 5 Questions for 5 Bankers series, which gives additional context to these results as we interview 5 community bank CEOs. Throughout today's presentation, I'm going to sprinkle in some quotes from those 5 Questions for 5 Bankers. And don't panic when you see the quote on the screen is a little shorter than what I'm reading off. That was for aesthetic reasons. I'm going to give a deeper quote when I read it off to the group. So it's great to be with you all as always. I see a lot of friendly faces in the crowd. This is a really impressive group of policymakers, regulators, bankers, academics. We're so glad that you're joining us today. We're going to ask that you hold your questions till the end to allow for the survey results to be presented in full. I'm going to get us started by sharing the key findings before I kick it over to Tom and Kathleen to go into the details. So some of the key takeaways this year: community bankers ranked net interest margins and core deposit growth as the most important external risks facing their banks. As I previewed, regulation fell to the 6th spot in the 2025 rankings of external risks. Bankers reported adhering to safety and soundness practices accounted for the largest share of their total compliance expenses, followed by money laundering and consumer protection standards. Cybersecurity once again took the top spot among internal risks, followed by technology implementation and costs. Signs of mergers and acquisitions activity picked up this year, with more respondents indicating seriously considering acquisition offers, although there's an interesting wrinkle that Kathleen will dive into later on that one. Credit and debit fraud was both the most common type of fraud reported and the largest source of dollar losses, followed by check fraud, then identity theft, and account takeover, respectively. And community bankers generally supported a change to the current deposit insurance framework, with targeted unlimited coverage and increased coverage the most popular solutions. But you'll see there was no strong consensus for how to actually handle updates to the deposit insurance framework, which in part explains why it's such a difficult policy topic to tackle. So I'm going to kick us off with our first quote from the 5 for 5. This is on net interest margins and core deposit growth, and from Lloyd Hamm, President and CEO of River Run Bancorp in Massachusetts. A tidal wave is coming toward community banks. Margin pressure, efficiency challenges, technology, talent costs, and compliance constitute that wave. We all need to move to higher ground. Some banks will try to stand still, some will merge early, and others will climb alone. Kathleen?
Thanks, Joey. Okay, so every year the CSBS annual survey essentially looks to bankers to get an idea of what are the risks that community banks are facing. We have a list of external risks that we'll present to you, and also a list of internal risks a little bit later in the presentation. Starting with the external risks, what we saw this year in the survey results, as Joey mentioned, was net interest margins and also core deposit growth moving back to the top of the list. So when looking at these results, it's interesting to see how many bankers are saying these are either extremely or are very important risks. And when we look at those two categories combined, which we have here in the two blue bars, 88% of community banks that were in the survey saw net interest margins as either an extremely or very important risk that their bank was facing. Second on the list, core deposit growth. 80% of banks in the survey said that this was either an extremely or very important risk, so moving up from last year. What was interesting is essentially we saw a three-way tie for third. So with 78% of banks ranking these as either extremely or very important, we had economic conditions, cost of technology, and cost of funds. So cost of funds dropped. It was actually tied for first last year. We saw that move down to 78% of bankers essentially in a three-way tie for third. That's interesting. We know Joey mentioned this survey followed the rate cuts that we had last year. We have seen some easing in short-term interest rates from the 2024 survey to the 2025 survey. So that probably explains some of that easing in the concern around cost of funds. What's really helpful is to look at these results from year to year. So as we build out the survey, as CSBS does the survey each year, we're able to look at how these results have shifted. So when we look at the top two categories on external risks, we see net interest margins over the last 4 years. It's been pretty consistent at about 88% of banks saying that this is an extremely or very important risk to their bank. But the rankings did shift. As we talked about a little bit in the key findings, and we'll talk about later, we know regulation and cost of funds, they were the top two risks last year, pretty much tied for first. That pushed net interest margins down to third last year. But the share of banks essentially is the same. So we see that's pretty consistently in the top of this ranking. Core deposit growth, we saw a surge in concern around core deposit growth from the 2022 survey to the 2023 survey. We know that the market was shifting, consumers became a lot more aware during that time. We know folks became a lot more rate sensitive, and we saw that result in the survey when you see that concern around core deposit growth. That's held pretty steady. This year, inching back a little bit to 80%, down a little bit from last year, but still a really important risk over the last few years. So another thing when thinking about the recent economic environment is the focus on inflation. And over the last few years, the CSBS annual survey has looked at what is the impact of inflation on your bank. Essentially, cost of deposits has been the most impacted when looking at these survey results over the last few years. Interestingly, this year, 48% saying extremely impacted. This was down from 59% last year, so you are seeing some ease in that, but cost of deposits still the #1 most impacted thing from inflation for community bankers. Personnel expenses second. What was interesting is that operating expenses actually moved up in this year's survey. So what we're seeing is that when talking to community banks, there is more of a focus on the effects of inflation on those operating costs than we've seen over the last few years. So that was up from 11% last year, saying that this was an extremely impacted area of their business because of inflation, to 19% this year. Now, going back to the focus on core deposits, when asking community bankers what are the challenges around attracting and retaining core deposits, the #1 answer was bank market competition. Essentially, 83% of bankers said this was extremely or very important, again, focusing on those two blue bars there in our chart. There was also a lot of conversation around economic uncertainty, with 49% of community bankers surveyed noting that this was either extremely important or very important when talking about attracting and retaining core deposits. Now, interestingly, this was not very different from last year's survey. So I know there has been a lot more focus on the economic uncertainty in the overall landscape, but this pretty much held steady over the last 2 years. Now, when looking at bank market competition, there is an entire section in the survey on bank market competition for a variety of products. So while we just were focusing on deposits, you can look at this for agriculture, for consumer loans, a wide variety of products and services. And we have the list here. Now, when looking at this and asking community bankers, who is your primary competitor? there were 7 of 9 categories where the primary competitor was another community bank. So I have the shares there. You see on both of the deposit categories, it's other community banks that they're competing with. But you see that there's pretty close and a lot of large competition also from those local, regional, and national banks for a variety of these categories. Now, the 2 categories where the primary competitor was not another community bank were payment services and wealth management and retirement services. One thing I wanted to note that was interesting in this year's survey was on payment services, while the primary competitor was local, regional, and national banks, we saw an increase, and it's kind of light up here, but you can see it in your packet as well. The non-local, non-bank, non-credit union, so the all other, which would include fintechs, that share, essentially banks said 28% of community banks in the survey said that was their primary competitor. And that was up materially from last year's survey. So we're seeing that increase in competition there on payment services. And I think that will be a very interesting category to watch in the years ahead. Essentially, that was up 9 percentage points from last year. Now, given the competition for core funding, I thought it would be interesting to look again at a question we've asked, or the CSBS has asked for several years, and that's around wholesale funding sources. CSBS did a deeper dive in this last year, so if you're interested, you can take a look back, but this question has been in there for several years. Essentially, public funds continue to be at the top of that list, and then FHL bank advances, also 70% of banks that were surveyed are using these and expect to continue to use these. With that, I'm going to hand it over to
Kathleen. All right, well, here we go again. Seems like I say this every year. It's all about interest rates when it comes to these external risks. And so we're showing the net interest margin here for the community banks and the dotted line in the industry overall. What you can see really is the roller coaster ride that banks have been on really since the pandemic years. And that has a lot to do with the shifts of interest rates going up in 2022 and 2023, and then back down a little bit in 24, and again this year. Is this button? Yeah. So this is a chart of the yield curve with the 10-year Treasury plotted with the federal funds rate. And the highlight here is, again, just to show over those last couple of years that banks have been in this inverted yield curve environment, which is really, the most difficult, really, type of environment for bankers to have to deal with. And they've actually done it quite well. Again, with the net interest margins still being, pretty good ranges. And what we're showing here is the orange line is the yield on the earning assets, and then that bottom line there is the cost of funding. And so the margins have increased a little bit, mostly because, again, that cost of funds that Kathleen had alluded to earlier has fallen a little bit, while that yield on the earning assets continues to be okay. Other challenges, of course, that this presents for community bankers is to manage the unrealized losses that they have on their investment securities. And this started, of course, back in 2022 when the rates started to go up quite rapidly. But it's still pretty sizable, I'd say, for these unrealized losses. So I will turn it back to Kathleen, or to Joey.
Yes, to kick us off with our regulation and compliance section, I have a quote from Clayton Laguerre, the president and CEO of Merchants and Marine Bancorp in Mississippi. Quote, "The challenges we've faced recently have really stemmed from the continually shifting expectations and the reinterpretation of longstanding rules and regulations. It sometimes feels like certain circles on the federal side have a, quote, flavor of the month club. What are we going to reinterpret today? The rapid shifts in expectations, interpretations, and reinterpretations have been more onerous for us in the last few years than I can remember. It's been a very challenging and has consumed significant time and energy." Kathleen?
So you may have already noticed, and Joey alluded to this earlier, that regulation in this year's ranking of external risks, it dropped dramatically from a tie from first last year to 6th this year. And when we look at the share of community banks that noted this was either an extremely or very important risk, we saw a material decline from 89% in 2024 survey, when again that was tied for first, to 75% this year. So while still a concern that's in kind of the middle of the pack of this list, we see a material improvement there when surveying community banks. Now, I wanted to talk a little bit about some of the new detail in this year's survey. While the CSBS has long asked questions about compliance costs and essentially the share of a variety of expense categories and what can be attributed to compliance, this year there were some additional questions to really get to the bottom of that. The first being essentially looking at the share of total compliance costs allocated to different expense categories. And what you see here is then what you look at for community banks on average, when looking at total compliance costs, the majority is due to personnel costs. Essentially 58% going to personnel, 17% to data processing, and 11% to accounting and auditing. So it's really helpful to look at that, and it actually is a really interesting insight, because when you look at personnel expenses, only 13% of personnel expenses on average are due to compliance. But when you look at compliance expenses, the majority are due to personnel. So it really gives you an interesting look at the data that we hadn't had before. And Tom's going to take a more of a deep dive on that first question in a little bit. Another question that was new to the CSBS annual survey this year was really getting to the bottom of what different laws, regulations, areas of business are, behind these compliance costs. The results here essentially show that 27% of those compliance costs were due to adhering safety and soundness practices, 25% related to anti-money laundering, and 23% to consumer protection. So again, some new questions this year to get to the bottom of those compliance costs. And to really dive deeper into this area, I'm going to hand it over to Tom.
All right, thank you. So CSBS also does a quarterly community bank sentiment index, where we ask community bankers around the country their sentiment on 7 different indicators. And what's shown here is one of those indicators, which is, do you think regulatory burden for the upcoming year will be lighter, the same, heavier, or I don't know? And so the lighter there is in blue, the blue bars, and the heavier is in the yellow bars. And then the index that's created from that is on the right-hand axis, and 100 is that neutral level. So as you can see, ever since we started the survey, this indicator has really been in the tank in terms of how community bankers think about regulatory burden. It popped up last year, right at the time of the election, to exactly even. They're at 100. It had hit 130 earlier this year, and now it's down to 114, 115 kind of a range. So this has been an issue for a while, and it's turned up in our annual surveys as well. And so I took a deeper dive into the annual survey to ask this research question: what effect do banking regulations have on banks of different asset sizes? And there's kind of a gap in the literature in terms of actually being able to empirically test this. It makes kind of intuitive sense that if you have a new regulation come on board and you've got to deal with it, that a smaller institution, one additional person to hire to deal with that is going to cost a lot more than for a larger institution that might even be able to absorb it amongst the staff that they already have. So it makes this kind of intuitive sense. And in the survey, we asked the question, over the last, I looked at the last 10 years of the survey here. What is the average compliance cost as a percent of each one of those expense categories? Okay, and so we got these 5 categories, and now you have to remember these are self-reported results. Okay, so they're making an estimate in many cases. In fact, sometimes you get a lot of 10% results that might go across. but others get really deep dive and you get an 8.65 or something like that. But these are self-reported results. But I know the banks that took the survey, and no one else knows that. And so I was able to dive in and match up their survey results with the bank and look at all the performance indicators, and the size of the institution was the main thing that I wanted to look at. And to Kathleen's point about the personnel costs, it's a large dollar chunk. It might be a small percentage chunk. It is always between kind of this 10 and 12% per year overall. But there's a difference between the smaller institutions and the larger institutions, as you will see. So the first thing I did was chop up the data into quartiles. Okay, and so the red line is the smallest. This is the 25% line. You know, the smallest quartile of banks would be those below that line. The dark blue line is the largest quartile of banks. And so if you look at the 2024 data, what we're saying is a small bank in this research study would be anything under about $200 million. And a large bank would be anything over $900 billion in the survey. Okay, and these are just surveys of community banks, and so everything's under $10 billion as that overall threshold. So what do we find? Well, here are the community bank personnel expenses that are attributed to compliance by quartile. Smallest banks, again, are in red. Largest banks are in blue. You can see that there is a difference between there, and there is in fact a statistically significant difference in there. In this conference, you're going to see a lot of asterisks. And you see these asterisks down here. I gave you the formula so how you can determine if something is significant at the 1% level, the 5% level, or the 10% level. All of these, every single year, was significant, statistically significant at the 1% level. Here were the actual numbers for the smallest quartile and the largest quartile, and then the difference between those. And you can see that that difference across the board is, 4 to 6% almost every single year. And so these were big differences in the, a disproportionate burden really for those smaller institutions. Well, did that hold also for our other categories? Looked at data processing, and once again, statistically significant differences between the smallest institutions and the largest institutions for every time period across the survey since we started doing this survey. I think we might not have had that question the first year, so I had like 10 years of data here, and I haven't analyzed this year's yet. How about legal costs? Actually, no significant difference except for 1 year there. I can't tell you what happened in 2017 on the legal front, but it doesn't really matter. There really wasn't much of a difference between legal costs for the various sized institutions. But there was, again, for audit and accounting and audit expenses, these were statistically significant differences across every single year. And then again, for consulting expenses, we see that the smallest institutions are paying, a greater share of the consulting expenses are going towards compliance. You can see that that's coming down, which probably means that they're learning how to deal with these compliance costs internally and not having to go out for help elsewhere. So the results show that there's some data-driven evidence here that the smallest community banks are disproportionately burdened by compliance costs in those 4 areas. I also looked, what are the other characteristics of these smaller banks? They tend to have higher capital, they hold more liquidity, they tend to be more ag related, in these smaller communities. They don't have as much CRE, C&D, or C&I loans. They have lower asset quality, which is kind of interesting. And they generally have wider net interest margins and lower profitability, but that's not always the case. It wasn't the case in every single year in the survey. So if you're interested in this paper, I believe it's out on the website for the conference program. And it's also on the CSBS website. Go to csbs.org/research. You can find the paper out there. I'm trying to see where I can place it from here. I'd also like to add that CSBS has a group of research scholars. We have 6 scholars. 3 of them are in the room here. We have Allison Nicoletti over here from Penn. We have Jill Satina up there from Texas A&M, and we have Matthew Whitledge over there as well from Mississippi State. These are 3 of our 6 scholars. 2 of these scholars are working diligently on putting together a longitudinal database of the entire annual survey results and so forth, so that researchers and others can dive in on these data points in the future. So that's all I have on that. Back to Joey.
Thanks, Tom. So to kick off our next section on cybersecurity, I have a quote from Lindsay Spitzer, the president and CEO of Bluffview Bank in Wisconsin. Quote, unfortunately, people are probably the weakest link. You can have the best designed systems and controls, but you can't stop somebody from opening an attachment or clicking a link. We spend a lot of our time educating our staff on phishing attempts, and we do a significant amount of testing. We have hundreds of emails sent per month to test our staff of 27. So, Kathleen?
So looking at the set of internal risks that are included in the survey, this is not a surprise. It's pretty much true every year, with cybersecurity taking the top spot of internal risks that are facing community banks. Essentially, if we look at the shares, this year 94% of surveyed community banks noted this was an either extremely or very important risk. Down a little bit from last year, but you see it kind of fluctuates in that range over the last couple years, consistently the #1 spot. So with that, I will turn it over to Tom.
Yeah, there's some sobering statistics here, really, when it comes to cybersecurity. 75% of surveyed businesses say fraud has negatively impacted revenue. 13% reporting losses, 10 to 20% of their revenue to fraud. Voice cloning is one of the newer ways to attack and steal. And 77% of victims there report financial loss. And fraud losses in the U.S. from generative AI are expected to climb from about 12 billion a couple of years ago to 40 billion a couple of years from now. Joey?
All right, so our next section is technology implementation and costs. This quote is from Mark Packard, president of Central Bank in Utah. Quote, over the last 5 years, our compliance labor costs have increased 58%. Our software costs increased 74% during the same period, so our overall compliance costs have increased by about 62%. I'm sure there will be continued software improvements, especially with AI, but compliance costs will continue to increase over time. Hopefully, with the help of AI and other technology, we'll be able to slow down those increased costs of ongoing and increasing regulation. Kathleen?
So if you noticed when we were showing the internal risks earlier, the second spot going to technology implementation and costs. What's interesting here is that that share has been steadily rising over the last few years. So we know with the rapid adoption of technology and I loved what Commissioner Salazar said earlier about the challenges but also the opportunities around technology. We know this is really a focus for community bankers, but you do see that increase in the risks that they see associated with technology implementation and cost over the last few years. Also interestingly, that when it comes to what is preventing community bankers from adopting new technology, you see that cost and ability to implement is at the top of that list, followed by cybersecurity risks and limitations of core service providers. With that, I will turn it back to Joey.
All right. On mergers and acquisitions, we have a quote from Norm Anai, the president and CEO of CBTC Bank in California. Quote, on the M&A side, it's primarily about valuations. Indices for small and large banks are still down and not aligned with fundamentals. Even Citi, which is famously trading below book value, isn't at a level that would spur M&A activity. As a result, deals are few and far between, especially in rural markets. Kathleen?
So as Tom mentioned earlier, there's a lot you can do with the data from the CSBS annual survey. And for questions that have been asked for a longer period of time, you have a longer time series that you can evaluate. This was really interesting in this year's results on mergers and acquisitions activity. So what we saw was that on the question of have you received and seriously considered accepting an acquisition or merger offer in the last 12 months, a jump from 6% of of survey participants to 12% this year. So essentially a doubling in that share. And when you look at how that compares to pre-pandemic, it's actually back in line with pre-pandemic levels. So after the pandemic, that had really fallen. We know it's been very low for the last few years, different interest rate environment, et cetera. But we did see an increase this year when evaluating the results from the survey. Now, what's also interesting is that there's a partner question to this on asking, have you made an offer to acquire or merge with a target institution in the last 12 months? And what you see here is that while that share has been higher, we didn't see the same jump. So when it comes to actually offering, we're not seeing that in the survey sample that we have. So 14% of community banks that were in the survey, consistent with that kind of pre-pandemic releveling, so an interesting result there. And we're gonna kind of go through some of the special questions quickly. I know we wanna be cognizant of time, so with that, I'll turn it back to Joey.
Yeah, thanks, Kathleen. So on fraud, and Tom sort of got to this a little earlier, I've got another quote from Lloyd Hamm that provides some more context for what banks are actually experiencing in real time. Quote, recently, along with hundreds of other banks, we were targeted by AI-assisted fraudsters who obtained customer data from outside sources and purchased lists. They knew exactly who our customers were. Another bank in our market experienced the same attacks. Fraudsters called business customers, impersonated the bank, and attempted corporate account takeovers by asking for login information. One customer provided that information, realized it quickly, called us within the hour, yet $16,000 had already been transferred. That may not seem large, but for that business customer, it was significant. Kathleen?
Thanks, Joey. So on one of the new special questions in this year's survey was looking at the number of fraud cases and how are they attributed to what type of fraud. What you see here on the results is that 59% of fraud cases were due to credit or debit card fraud, and then followed by check fraud and identity theft and account takeover. The second question was on dollar losses from fraud according to the various types. What you see here is things are a lot more even between card fraud and check fraud. 38% of dollar losses attributed to card fraud, and then 30% attributed to check fraud. And I found this to be a very interesting result because while only 17% of cases are due to check fraud, 30% of losses are due to check fraud. So each individual case kind of has a bigger hit when it comes to the loss from fraud. I think that's why when going out into the district and talking to community bankers, we see that focus on check fraud. Also, though, when you have those conversations, you definitely are hearing more about identity theft and that, you know, kind of the challenges to some of the newer technologies, the AI environment showed up here in this first year of survey results on this question. And for the last section, I'm going to move it back over to Joey.
Yeah, so on deposit insurance, we're doing something a little different. This isn't a quote from our 5 for 5, but actually from an audience member. This is Arkansas Commissioner Susanna Marshall and House Financial Services testimony back in February. Quote, small businesses in rural Arkansas should not feel compelled to leave their community banking partners simply because they worry the federal government will not protect their funds unless they are placed with a too big to fail institution. While the costs, benefits, and trade-offs of different deposit insurance reform options are certainly complex, Congress should have meaningful policy discussions about whether raising the deposit insurance coverage limits for business operational accounts would promote a more level playing field for community banks and their small business customers. Kathleen?
So for this special question, community bankers were asked, if you were to update deposit insurance rules, which of the following solutions would you prioritize? And what you see here is that 80% of community bankers did feel that they would offer an alternative solution, so only 20% saying no change, about 20%. And the top two solutions were targeted unlimited coverage and then increased coverage. Under targeted unlimited coverage, this essentially would mean that certain account types would have unlimited coverage, while others, such as non-interest bearing transactions accounts, would have limited coverage. And then under increased coverage, what was interesting was that respondents could write in the limit amount that they would suggest. And this was just a write-in question. And a majority, so 72%, wrote in $500,000 for the increased limit. So an interesting result from the new special question this year. And with that, I don't know if we have any questions where you just have to ask right away. I know we are at 10 o'clock, so we want to keep us on schedule. But if there's any, I'll just maybe give a moment if anyone has a question that must be answered.
We successfully exhausted all of our time to avoid answering any questions.
You can come find us.
Yeah, and
in
we
between
have
sessions.
a break coming up after our next session, and the three of us will be here both days. So I know for me, I love talking about this survey. It's definitely the highlight of this conference, as well as many other things. So, but with that, we'll turn it back to Jim.
All right. Thank you, Joey, Tom, Kathleen, and again, thanks to the Conference of State Bank Supervisors and to the State Banking Commissioners and to all the community bankers who participated in the 2025 survey. So I'm pleased to introduce our first keynote speaker of the morning. Brandon Milhorn is the President and CEO of the Conference of State Bank Supervisors, and even before he was in that position, was just a long-standing supporter of this conference, and so we are grateful for that. Brandon joined CSBS in December 2023, bringing with him nearly 3 decades of advocacy, policy, legal, and regulatory experience. He previously held leadership roles at the FDIC, serving as deputy to then Vice Chairman Travis Hill, and as Chief of Staff and deputy to then Chairman Yelena McWilliams. Prior to the FDIC, Brandon spent 7 years in the private sector with Raytheon Corporation and held numerous positions over a decade of public service. He served as staff director and chief counsel for the Senate Committee on Homeland Security and Governmental Affairs, general counsel for the Senate Select Committee on Intelligence, and as an attorney at the CIA. He began his career with 2 federal clerkships. Please join me in welcoming Brandon Milhorn.
So thank you very much for having me. I'd like to thank the FDIC and the Federal Reserve, our co-sponsors in this conference. It's our 13th community banking research conference. In many ways, 7 years ago, I was chief of staff to Chairman McWilliams when she came down and spoke at this conference. And to be standing here behind this microphone speaking with all of you is really an honor and a privilege. But before I know Kathleen was very worried about time. I am not similarly concerned about your time. I just want to thank the team that puts this research conference together. It's our 13th year. They work from January until tomorrow on putting this conference on and making it meaningful for the participants. I am so thankful for their efforts, and I look forward to their continuing success because we are nowhere near the end of the importance of the conversations that we have at this conference. So thank you again very much for being here and for the team for their efforts. So one of my favorite periods of history is the American Revolution. It fascinates me. The confluence of events, ideas, leaders, and pure luck that led an ill-organized agrarian collective of states to declare independence from a military, economic, and industrial superpower. The triumph of Republican ideals and individual freedoms over an established monarchy. For all of the principles, the high principles embodied in our founding, the United States remains nearly 250 years later an ongoing experiment in individual freedom and limited, democratically accountable government. Now, you might be asking, where in the world is this conversation going? These principles are reflected in our financial markets, even today. Capital allocation remains largely a function of free, competitive markets. Consumers have the freedom to choose from an array of financial products to fit their individual needs. Banks and other financial institutions can choose their chartering or licensing authority and develop business models that fit the needs of the consumers that they serve. Our dual banking system continues to foster individual freedom and dynamic, innovative markets. But I often wonder how our founders would feel about the level of regulatory and supervisory intervention in our financial markets. Could they reconcile the National Bank Act with the historic primacy of the states on local economic matters? Would they accept the market interventions of the early 20th century, the establishment of the Federal Reserve and the FDIC, deposit insurance, and federal supervision of state banks, given the complexity of financial markets and the impact of financial instability on consumers? Could they conceive of the current administrative state and the effect of the federal bureaucracy on principles of democratic accountability, including the separation of powers within the federal government and the distribution of authority among the federal, state, and local governments? Now, these questions may seem theoretical and academic. We are, after all, at a research conference. But I think the perception of the appropriate role of the federal government and the states, our commitment to individual liberty, and the importance of free markets to effective capital allocation remain paramount. More importantly, these principles, embodied in our national DNA, should continue to inform our efforts to appropriately balance state and federal regulatory and supervisory expectations as our world, our technology, and our markets evolve. Now, the regulation and supervision of financial services are purposeful interventions on free markets. In our efforts to mitigate risk and protect consumers, we necessarily distort the operations of those markets. Now, that does not mean that they are inappropriate. They are, in fact, absolutely critical. Take the requirement to be approved for a bank charter, the responsibility to take and hold someone's money. Their financial well-being is built on trust. Financial institutions must demonstrate that they are prepared to honor that trust, to operate in a safe and sound manner and protect their customers before a state will trust them with a charter. Now, supervision helps ensure that banks continue to merit that confidence of the state in their operations while promoting public confidence in the broader financial system. Now, within this regulatory and supervisory framework, state and federal bank examiners occupy a unique position of power. They are not elected leaders. They are not directly accountable to the public. They're tasked with evaluating the financial condition, governance, and compliance frameworks of the institutions they supervise. Those supervisory choices and the expectations they place on banks, the manner in which they exercise sound supervisory discretion, affects the availability of credit, the stability of the financial system, and the business models of the institutions they supervise. And that discretion is an indispensable part of the job. Their work is not black and white. Bank supervision is not a math problem. Because of the impact of bank regulation and supervision on the core principles that define American economic freedom, it's incumbent on state and federal governments to continually examine our supervisory model to ensure that it remains fair, transparent, and accountable. Now, spoiler alert, there are no right answers to this complex balancing act. Our approach to consumer protection, our willingness to foster innovation in financial services, our comfort with risk in an institution's business model, the impact of all these choices on consumers, competition, cost of credit, and capital allocation, the difficult policy choices across all these topics ebb and flow. The answers are a function of economic conditions, individual choices, and election results. Now, with that very long backdrop, I'd like to briefly explore some of the current debates in financial services against the framework of individual liberty, free markets, and limited accountable government. Let's start with tailored supervision. It has become a bit axiomatic. Institutions should be regulated and supervised based on their size, risk, complexity, and business model. What is difficult is deciding what that means in practice. What level of risk is acceptable? How do you define complexity? And perhaps most importantly, how do those definitions and the associated regulations and supervision affect banks and their customers? What should not be up for debate is the impact that supervision has on institutions and their business models, particularly for community banks. As Tom Seams just mentioned in his presentation earlier, we recently analyzed 10 years of data from the annual survey of community banks. Our research confirms what bankers in the audience already know. Community banks shoulder a disproportionately high cost of compliance compared to larger institutions. Supervisory creep continues to snare community banks in regulatory frameworks meant for more complex regional or global banks. The community banking business model is also under severe stress. Increased competition from non-banks and difficulty accessing deposits and funding are ever-present threats. Community banks continue to face rising personnel and technology costs, and succession planning is often a substantial impediment to continuity. More recently, headwinds in the form of inflation and other economic conditions have fueled uncertainty. With all these costly and unnecessary constraints on profitability, it's not hard to see why we have lost more than 2,000 community banks over the last decade, with very few de novos forming to take their place. The hesitancy of federal regulators to approve new business models and the lack of clear operational guidance to support bank-fintech partnerships have exacerbated the competitive challenge for community banks. Meanwhile, consumer demand for innovative financial products continues to grow. But much of that growth has occurred outside of the banking sector. If we want new capital to flow to community banks, we must re-examine our regulatory and supervisory framework for these institutions. The capital markets are sending us a clear signal. Only larger banks with scale can compete in this regulatory environment, and investments in other financial markets are preferred to de novo formation. If community banks are important to the fabric of the United States, we should all be concerned about this flow of capital. While global and regional banks serve important functions in our financial system, growth and prosperity in the United States begins with small businesses and farmers, and community banks propel the local economic growth that is the foundation of the larger U.S. economy. So how do we make community banking sector a more competitive market for capital investment and innovative business models? Adjusting static, asset-based regulatory thresholds that fail to grow with the economy is a great place to start. We heard that from Vice Chair Bowman earlier this morning. Concentration-based limits can be similarly problematic when they fail to consider an institution's business model, market, history of successful risk management, and variations in the components of the concentration. We should also fundamentally re-examine our IT, BSA, AML, CRA, and compliance regulatory frameworks. Are we prioritizing process in these areas over core financial risk? What financial stability and consumer protection risk are we seeking to mitigate? Are the associated benefits clear? Do they outweigh the costs of the regulatory mandates and supervisory expectations? Take BSA AML for an example. I'm a former national security lawyer, as Jim noted. No one wants to keep bad actors out of the financial system more than me. But we must balance national security and law enforcement demands against the billions of dollars that financial institutions spend on BSA/AML reporting and compliance. It's incumbent on the federal government, which imposed these requirements on the financial institutions, to periodically ensure that the BSA/AML framework has not become a strict liability straitjacket on innovation and growth in our community banks. The lack of clear operational guidance on innovation and the proliferation of third-party risk management enforcement actions have limited the willingness of community banks to innovate and reach new markets. And our capital and compliance frameworks have driven lending that used to occur in community banks to other institutions. Appropriately tailored supervision promotes fairness, transparency, and accountability. And just like our regulatory framework, supervision must continuously evolve. With our members, CSBS works to advance more efficient and effective supervision of state-chartered banks through training, technology, and consistent engagement with our federal partners and industry. These efforts help support the healthy evolution of the examination system, and in so doing, improve the fairness and transparency of our supervisory results. The one thing that can't be done is the elimination of examiner discretion. Training can make the application of examiner discretion better and more consistent. Definitions can be tightened to improve transparency. Appropriate oversight and appeal mechanisms can improve accountability. But some degree of examiner discretion will always be warranted. Take, for example, the management rating in CAMELS. Perhaps the rating's definitions can be adjusted. We should certainly work to eliminate double counting, and the M rating should be appropriately weighted compared to core financial risk in other CAMELS components. but management shortcomings should be captured in the composite rating for an institution. Risks such as dominant official, lack of succession planning, inadequate management controls, and other governance failures should be a factor in assessing overall institution risk. Management risks such as these should impact a bank's deposit insurance assessment. There simply is no one-size-fits-all definition of management that will capture all the nuance in an individual bank's governance and controls. In fact, when the FDIC sought to impose one-size-fits-all governance models on larger banks, CSBS objected to the checklist-focused nature of the proposal. It simply went too far. Eliminating the management rating in CAMELS would be an opposite step in a similarly wrong direction. Now, our community bankers have shown hope for the future. Last year, the regulatory component burden of the Consumer Community Bank Sentiment Index was at its lowest point. Tom Sames just pointed that out. The curve dramatically rose after the elections last year, and today the component stands at its highest levels in history. Treasury Secretary Bessent has shown a keen interest in community banking. Federal Reserve Vice Chair for Supervision, Mickey Bowman, is a tremendous advocate for community bankers, a former state supervisor and community banker herself. FDIC Chairman Travis Hill and Comptroller Jonathan Gould have all signaled the importance of supervisory tailoring for community banks. Federal and state supervisors are actively reviewing components of the bank supervision framework, and the third AGRIPA process is underway. We have a unique opportunity in this country to reset the regulatory and supervisory balance for community banks. And state supervisors are prepared to work with our federal partners to develop a framework that is right-sized and resilient, even when the political winds in Washington, D.C. change direction. My hope is that Congress and our federal partners approach the reforms necessary to support community banking with the same sense of urgency that propelled stablecoin legislation into law earlier this year. So while we work to make our supervisory framework more transparent, more fair, and accountable, we must also ensure that it doesn't pick winners and losers, undermining free market principles, limiting access to financial products, and increasing costs. I am very concerned that federal regulation and supervision have been a significant constraint on bank innovation. We've spent so much time telling banks how risky innovation is, how challenging it is to manage third-party and digital asset risk, and taking enforcement actions that demonstrate those risks quite clearly, that we may have missed an opportunity to foster innovation by working cooperatively with the sector and helping to demonstrate how innovation can be effectively implemented. Now, that is not to say that innovation isn't challenging. It is. It requires an institution to think critically about its business model, compliance obligations, and partnerships. But tightly constraining innovation in banks does not eliminate demand for innovative financial products. It simply moves the demand elsewhere, restricts supply, and increases the cost of credit and other financial products. Water finds a way. I'm worried that we may be repeating this pattern with stablecoins. This summer, Congress passed a law that provides a national framework for payment stablecoins. Banks can establish payment stablecoin subsidiaries, and non-banks can also become payment stablecoin issuers under federal and state law. This national framework is vital to promote safety and soundness for uninsured stablecoins, improve BSA/AML compliance, and protect consumers. The United States Treasury Department has indicated that the addressable market for stablecoins could reach $2 trillion by 2028. At present, the stablecoin market is about $300 billion. If stablecoin growth comes at the expense of community bank deposits, the $1.7 trillion migration could have a corresponding $1.4 trillion impact on lending. The deterioration in lending could almost certainly harm the small businesses, farmers, and consumers that rely on community banks. Tokenized deposits are a possible competitive substitute for payment stablecoins that could help keep deposits in the banking system. But without guidance from the federal banking agencies, banks may be unwilling to risk the potential regulatory and supervisory fallout if regulatory perspectives change again. Guidance can help banks clarify the insured status of the underlying deposits and address challenges associated with capital and liquidity requirements, accounting, interoperability, third-party risk management, BSA/AML, and collaboration risks for blockchain networks that extend across multiple banks. Now, some have attempted to downplay the significance of deposit outflows from community banks, arguing that money market funds had little impact on bank deposits or touting limits on the ability of stablecoin issuers to pay interest or yield. I've already seen at least one study sponsored by a crypto firm that claims to support this proposition. Let's not wait to find out. Tokenized deposit guidance from the federal agencies should proceed in tandem with regulatory framework being drafted for stablecoins. If not, we could end up with a competitive environment for banks like the 1980s, when outflows to money market funds drained bank deposits due to regulatory caps on interest that were lifted too late, forcing banks to raise rates rapidly and contributing to further deterioration in their financial conditions. The technological challenges of establishing a tokenized deposit blockchain network are daunting, but guidance that supports banks who want to provide these services could preserve deposits and lending in the banking system, create competitive opportunities for innovative banks, and provide customers with more choice. Now, for our last topic, I promise, I'd like to spend a little time thinking about the importance of democratic accountability for bank supervision. The engagement of state supervisors with the public, their regulated institutions, and their governors and legislatures is well chronicled. In addition to safety and soundness and consumer protection, state supervisors often have a mandate to oversee the industry in a manner that promotes prudent economic development across their states. These relationships, their mission, and their primary focus on state financial markets foster local accountability. Now, federal agencies approach their responsibilities from a national perspective, often driven by a desire for financial stability and risk mitigation. Their perspective, certainly from their headquarters in Washington, D.C., is far removed from the direct local accountability of state supervisors. They are also part of a vast federal bureaucracy that distributes political accountability through Congress, the President, and the executive branch. Now, over the last several years, the Supreme Court has acted to limit the broad deference afforded federal agencies. Two recent decisions are of particular note: the overturning of Chevron deference and the ongoing development of the major question doctrine. Now, the legal foundation for these cases is a simple premise. Congress passes the laws, and the executive branch is charged with their execution. When agencies go beyond their statutory mandate, they undermine core principles of democratic accountability. These agency actions displace Congress and the political process and effectively become the law. The Supreme Court's decisions in West Virginia v. EPA and Loper Bright are a judicial response to the perception of bureaucratic overreach, if not the reality. Along with CSBS, many in industry raised concerns with efforts by the CFPB when we believed it had exceeded its statutory mandate. Some examples included the redundant non-bank registry rule, rules released by blog instead of notice and comment, and proposed reporting requirements for small businesses' credit applications that extended far beyond the statute. Now, if you care about democratic accountability in government, we should be similarly concerned with actions by the OCC that failed to comply with the law. As states, we may not like the OCC's authority to preempt state banking laws that prevent or significantly interfere with the exercise of national bank powers. Nevertheless, Congress granted clearly the OCC that authority. But Congress also placed constraints around the scope of the OCC's authority and established a clear process that must be followed to preempt state law. That statutory process specifically includes a case-by-case analysis of the affected state law, notice and comment procedures, a review of the designations every 5 years, and consultation with the CFPB when the OCC attempts to preempt similar state laws from other states. Now, the Supreme Court reaffirmed all of these principles for the National Bank Act preemption last year in Cantero v. Bank of America. Now, despite these procedural requirements, the OCC has simply reissued its preemption regulations in 2011 without acknowledging the limits imposed on it by law. 14 years later, we're still waiting for the first notice and comment review of the OCC's preemption regulations, let alone the required 5-year reexaminations. We are similarly concerned with assertions in Interpretive Letter 1176 that the OCC may grant bank-like powers to national trust companies. Congress has been very specific when it adds authorizations to the National Bank Act, whether for credit card banks, fiduciary trust, and most recently, payment stablecoin issuers. Congress has carefully delineated the authority of these institutions, and the OCC cannot grant new institutions powers that Congress itself did not authorize. Now, as we speak, the OCC is reviewing numerous applications for new uninsured trust charters, many of them tied to digital asset business models. And in many ways, this was an expected result from the Genius Act, as these trusts can provide custodial and reserve support to payment stablecoin issuers or for other digital assets. But to ensure a level playing field for traditional banks, the OCC must avoid granting these new uninsured trusts bank-like authorities. The ability to take deposits, lend, or engage in payment activities. Only Congress can grant the OCC this authority, and it is simply not found in the National Bank Act. Given the inherent authority of the states to charter trusts and banks, the preemptive impact of the National Bank Act, and the competitive impact that the exercise of this illusory authority would have on traditional banks, this is clearly a major question that only Congress can answer. The OCC must construe its chartering authority narrowly and rescind Interpretive Letter 1176. Now, bank supervision helps protect free markets and promote individual liberty by providing consumers with access to responsible financial products at competitive prices. It must also evolve, responding to economic conditions, new innovations, and the electoral will of the public. To promote public trust in our financial institutions and our bank supervisors, it's vital that we continue to avoid the politicization of supervisory tools, to exercise regulatory and supervisory powers in a manner that is fair, transparent, and accountable. By committing to these principles, by carefully balancing consumer choice, financial stability risk, and economic opportunity, by revisiting our regulatory and supervisory choices with an honest and open mind, we can continue to support a thriving financial services market, a market that supports the health of the community banks that are the foundation of the United States economy. Thank you for your time.
All right, thank you, Brandon. All right, it is time for our first break of the 2025 conference, and when we return, we will hear from our very first research panel. So we're excited for that. So I would ask those of you on that panel if you'll just check in over to my right, make sure we get you all mic'd up and everything. But before I let you go, just a few things that I think are important to mention. So in addition to the 3 research panels that you'll see presented in the front of the room today, we also have two author groups that were selected as poster presenters. And in fact, we've got kind of an interesting twist in the 2025 conference. So one of the emerging scholars that we recognized earlier, Renan Liu from McMaster University, was also selected to present his paper in a poster session. So he will be outside the conference auditorium. Very excited to talk to you about his paper. So I would encourage you to, as you're networking and getting coffee and doing all of those things that you want to do during the break, please talk to Renan Liu. The other poster presenter is Samuel Rosen from Temple University. Although he was not able to join us in person, his poster is out there for you to engage with, and we'll have a video of him talking through some of his findings earlier. But before I let you go, we're going to quickly hear from Renan, and then we'll let you go for break.
Hello, my name is Renan Liu. I'm a PhD student at McMaster University. I have been selected as one of 2 poster presenters for the 2025 Community Banking Research Conference. My paper, Leverage Without Risk Weights, a double-edged reform for community banks, focus on how the introduction of the community bank leverage ratio affects the capital, risk-taking, and profitability of small U.S. community banks. I hope you will join me outside the auditorium to discuss my research during the break. I'm looking forward to speaking with you.
Great, thank you, Renan. We will be back here at 11 a.m. Immediately outside is our hospitality desk as well. So if any of you are experiencing issues with Wi-Fi, technology, just general questions, we have individuals there that are standing by to help you. So again, great kickoff to today. So glad you're all here, and we'll see you back here at 11 a.m. Thank you. right, everyone, if I could ask you to please take your seats. All right, welcome back, everybody, to the 2025 Community Bank Research Conference. Of course, welcome to our in-person audience, and of course, to our live stream audience. We are delighted that you can join us. And we are very happy now to segue to our first research paper session, titled Deposit Franchise Value and Market Power. Our moderator for this session is Elizabeth Lizzie Berger, assistant professor at the University of Houston. You will be hearing from our presenting authors shortly. I will also note that our session's community bank discussant is Bill Bickle, Chief Credit Officer and Chief Risk Officer at Stockman Bank of Montana in Miles City, Montana. So, with that, just a couple of quick housekeeping items. We're going to go from our academic moderator to our presenters to our community bank discussant, back to our academic moderator, and then we're going to open it up for Q&A. So once we reach that, Lizzie's going to moderate the Q&A. So just as a reminder, just touch that gray space. That should turn your mic from red to green. We've had a couple questions already on presentations and other things. Communitybanking.org, the website, is just a rich source of information. So you'll be able to download these papers. You'll be able to download presentations. You'll be able to see speech text and basically all of the visuals that you've seen in this year's conference will be accessible on that site. So no need to, unless you just love taking out your phone and taking pictures of screens, which is fine too, but you don't necessarily need to. So with that, I will turn this over to Lizzie. Thank you, Lizzie.
Okay, good morning, everyone. I'm Elizabeth Berger from the University of Houston, and I'll be moderating today's session. In this session, we're going to be learning about how banks manage their deposit business. So we will learn how they attract deposits, how they retain deposits, and then how they manage their branching networks in response to deposits. And then we will hear from Bill Bickle, who's the Chief Risk Officer of Stockman Bank of Montana, and he will provide a community banking interpretation or perspective on what we learn from these academic research papers. Then I will try to summarize these three papers into a storyline that I imagine to be how they all fit together. And then we'll turn it over to you to ask questions and enrich our knowledge of what we have done. So with that, let's hear from Rajesh on the decline of branch banking.
So, thank you, Elizabeth. Thank you to the organizers for inviting us to present this paper. 14 minutes, Elizabeth?
Yes.
Yeah.
Yep.
So this is joint work with Dimuthu Ratnadivakara, who is at the Federal Reserve Bank of Richmond, and Phil Strawn at Boston College. Just want to emphasize that these are our views and not those of the Federal Reserve or the Federal Reserve System. Okay, we have a very simple question in mind, which is just to try and understand what's driving the branch openings and closings that we are seeing. And we think it's important to understand, answers to this question is important to understand the ongoing industry restructuring that we're seeing. And let me show you a little bit about what we have in mind here. We are witnessing massive and rapid debranching in the United States. So right around, let me see if this works correctly. Okay, there. So the number of banks are in blue and the number of branches are in orange. So right around, I guess if we can see it, I have to go here, sorry. So let me put it this, yeah. Oops. Okay. Sorry, I'm just getting used to this little thing here. Okay, this is the part I want to sort of point out. So right after the global financial crisis, you are seeing a dramatic decline in the number of branches in the United States, okay? And if you sort of parse through this a little bit more, you'll see that the number of branches that are being opened are far fewer than the number of closings. As a matter of fact, you're seeing 3 times the number of closings. So during the COVID period, we closed more than 5,000 odd banks, right? And we're closing about somewhere in the order of about 3,000 odd banks every year. Branches, I'm sorry. And this is occurring across bank size, okay? It's occurring across large banks and small banks. The pace is a little more rapid with the large banks, but it's happening nevertheless with small banks too. Okay? So what we argue is that technology is the force that's driving this debranching that we're seeing, which is that the customer adoption of technology, primarily internet and mobile banking, is what's driving this transition away from branches. So what we argue is that financially sophisticated customers are just generally interest rate sensitive. And if you have a depositor base that's interest rate sensitive, it makes it costly to retain deposits, which then lowers the profits that you can earn from the stock of deposits you have at the branch, i.e. you have a lower deposit franchise value. We also argue that the tech-savvy customers are placing lower value on branch proximity. So the amenity value of a branch is low to them too. So what we show is that banks close branches that have costly deposits, i.e. the branch has low deposit franchise value. Simple way to think about it is that it has a low, where the stock of deposits are low and the depositors are rate sensitive. Those are the branches that are being closed. And they're closing branches where customers can increasingly be served digitally, right? Surprisingly, we find that the closure decisions don't have a lot to do with the credit side of the business. Conversely, banks open branches in deposit-rich markets, but also where depositors are rate sensitive, right? The idea here is that rate-sensitive markets are easier to enter and attract customers by offering higher rates. So that's sort of the basic finding here. In terms of why this is an important question, I think it's important to try and ask ourselves why were branches so important from 1980 to 2008. And, I mean, this was a period when, where the branch was located, it affected the competition in the local market, branch presence affected what kind of information, how you got to know your customers. I mean, if you had a wide branching network, you could move capital across branches and serve loan demand in other areas of your geographic footprint. And of course, it had some effects on monetary policy transmission too, right? I mean, so over this period, when we loosen regulatory constraints on branching, I mean, what did we see? We saw, massive amounts of mergers and acquisitions. We saw consolidation in the industry. The number of banks came down. Branches kept going up, but then now post the global financial crisis, we're actually seeing branches declining. So we think that this technology that's driving this ongoing industry restructuring is going to lead to branchless competition. So it's not that competition is going to go away, it's just that it's branchless. There's going to be more contestability in the markets, potentially more and cheaper credit, higher capital mobility, and perhaps a different way of thinking about relationships, as opposed to soft relationships. Maybe the way to think about relationships now is via data and tech substitute. So soft information becoming harder, becoming more measurable. So the nature of relationships are changing. So essentially the way we go about doing this is simply to show you that there is tremendous variation in the depositor bases that banks serve. So customer demographics vary quite a bit, okay? And these customer demographics are related to the technology usage of banks, related to technology usage by customers, and they vary across banks, okay? I'm just showing you, just the basic stuff on age. I mean, if you just look between large and small banks, you see considerable variation in age, you see considerable variation in education. You also see variations in family income. You see variations in their participation in financial markets. And you also see the deposit beta, which is our measure of how sensitive the bank's interest rate is, or the branch's interest rate is relative to market rates, tends to be higher also. I mean, there's considerable variation. Okay. So conceptually, what we're going to do is we're going to say, look, if there's considerable variation in these demographics, and these demographics are related to how individuals use technology, then these local demographics should influence changes in branch level interest rate sensitivity, which is our deposit beta. And these demographics should also influence how customers use branches, which is usage. And then once we can sort of translate these demographics into these measures of branch, connect them to interest rate sensitivity or the deposit beta and usage, we can then ask, how does this high or low deposit beta influence branch closures? Or how does this beta and usage influence openings? And that's essentially what we try and do in this paper. So we collect data from a variety of sources, a lot of this is pretty standard. I think the only other thing that I might want to point out here is that we do have some, to get at usage, we use some cell phone geolocation data, but outside of that, a lot of it is fairly standard. So what we're going to do is to build a branch level measure of the interest rate sensitivity, which we can't directly observe. We're going to take the demographic drivers of bank level interest rate sensitivity, which we can observe because we know the interest expenses on deposits that banks pay at the bank level from the call report. And we're going to estimate how the demographic drivers or how variations in the demographics of the customer or of the customers that the bank serves influences this beta. And we do this over 3 rate hiking cycles. And likewise, we're going to estimate that model for how, what the usage is for the bank, right? And once we know that, we're going to take how the coefficients on the demographics, in other words, how the demographics, the influence that we can measure, and then say, look, if your branch had this particular demographic, what would its interest rate sensitivity be? And so that's what we're doing when we impute branch level beta and usage, okay? Once we get our branch level beta and usage coefficients, we're going to estimate branch level closures and openings, right? So let me run you real quick and show you that bank level interest rate sensitivities vary quite a bit across the cycles, interest rate hiking cycles that we've had. And the demographics drive this variation pretty consistently across the cycles. Essentially, one way to simply think of it is that if you have a more educated customer base, they also tend to be more interest rate sensitive. That's the first line. Okay? So if you take all of those coefficients and then put in the branch level demographics, here's what you see in terms of the branch level betas. And you see that they vary quite a bit too. And they are different between large and small banks. And they're highly correlated across the different cycles. So in other words, what we're picking up is not something that is not persistent. So if you look, the demographics also drive how individuals use branches. So if you look at the drop in visits, you're seeing that more sophisticated, more educated, younger individuals do not use branches as much. So since I just have a minute, let me quickly wrap up and show you that if you look at, just visually, if you look at the percentage of branches closed and look at the interest rate sensitivity, and we do this by deciles across cycles, you generally see that areas where there are high interest or customers who are highly interest rate sensitive are the ones where branches are being closed. And this sort of holds through in more sophisticated models. You don't see any influence on, or we don't see very much from the credit side of the business. So in other words, it's not because of declining loan volumes that banks are closing branches. Okay? I'm going to sort of skip through this and so show you that we find similar things with branch opening. So they're opening branches in areas where the interest rate sensitivity is high and where the markets are deposit rich. Okay? So, in summary, I think the results that we find argue that technology is a primary driver of bank restructuring today. So the key takeaways would be that the deposit rate sensitivity of the customers that you serve is a key driver for branch openings and closings. And we find, the variation in these customer types generates fairly large effects. Surprisingly, local lending, it doesn't drive, or we don't find that it drives the branching decision or branch closures or opening. And last point is that, if you have a customer base that is rate insensitive, it's a great barrier to entry. So that's probably a strong competitive element. Thank you. I've taken in 1 extra minute, so I'll repay it back in some other way. Thank you.
Okay, so our next paper will be Poverty Spreads in Deposit Markets. So I'm going to just introduce the paper and let the presenter take over.
Thanks a lot for having the paper in the program, and I'm really looking forward to your thoughts about the paper. So I go by Orko. I'm from NUS, which is National University of Singapore, and it's co-authored with my friend Emilio, who is currently at Hong Kong University of Science and Technology. And the paper is talking about understanding whether deposit rates varies across the income distribution. So the primary motivation of this question comes from the consumer price side of it. We know that there has been enough research that has talked about different rates of inflation that people face across the income distribution. So relatively poorer people are exposed to higher inflation rate, while richer people are exposed to relatively lower inflation rate, probably because more product innovations are going on at the right tail of the distribution than the lower tail, and thereby there is this saying that it is quite expensive to be poor. Now that's there in the consumer sides of the market. However, there is little attention that has been focused to try and understand whether rates vary or deposit rates vary across income distribution, and deposit being one of the primary vehicles of financial entry by most Americans, and it is the critical first point of entry in the financial system. So it matters to understand whether deposit rate varies by income distribution. So what we ask, particularly in this paper, is do households with relatively lower income receive relatively lower deposit rate compared to the wealthy individuals? And the answer that we find is yes, otherwise we wouldn't have written the paper to start with. And then we try and understand what is driving these differences. Is it driven by a traditional banking competition that people have talked about, that there exists banking competition across banks in the deposit market, or is it some other mechanism that is going on? And that is what we'll try and understand as we move ahead. So basically what we find in the paper is that there is a systematic evidence of a spread along income distribution in the deposit rates. So moving from the bottom to the top decile of the income increases deposit rate by roughly 22 basis points, which is almost like 50% of the median deposit rate in our sample. So this finding holds within bank, within county, and there's also higher product category that individuals across the higher income distribution are exposed to than individuals lower in the income distribution. What we find, what is going on, is that there is strong evidence of participation channel. That is, the finding that we find, that is the deposit rates vary across income distribution, is not highly correlated with the banking market structure or the competition that is happening across bank on the deposit product. However, what we find is that the participation of individual in the non-deposit market is kind of driving the results, in the sense that wealthy individuals tend to participate more in, say, equivalent money markets, equivalent stock markets, and they have this higher propensity to move their money out of deposit to this other product markets, and that is what is driving the banks to give them higher deposit rates so that they do not move the money out of that deposit market to this other product market. So that is what is driving the results in this paper, if I can't go into much detail because of lack of time. And the way that we show it is we have the breakdowns of income across income that is coming through salary, income that is coming through capital gains, income that is coming through interest rate, and various other incomes. And we do find that it's only the income that is coming through capital gains or through interest rate, which is kind of the income that is generated from participation in some asset market, is what is driving these differences. And we'll do some form of causal identity. So far what we have said is kind of a reduced form relationship. We'll show some causality. If I do not find time, that's fine. That's mostly to say that we are kind of showing some degree of causal interpretation as well, that higher income will lead to higher. So let me talk briefly about the empirical setting. So the data that we use is rather simple. We use rate watch data that has APYs at the branch product level. It has very detailed descriptions of the product that we use. The sample period is from 2004 to 20. And for the income, we use IRS data on average income at the zip code level, which is the lowest level of granularity that we use. And this zip code year level is the level of aggregation that we do for our empirical study. And then we break down income based on what I had already mentioned: salaries, capital gains, interest, and so on. And if I have to put the paper in a snapshot, this is what the paper finds. So in the left panel, so both is by and large same. We're trying to remove some form of unobserved variation. So in the x-axis, we have zip code income deciles, and in the y-axis, we had the APYs, or the rates that they receive. So if you move across income deciles, you do see a very a linear relationship of the deposit rate. So as and when you are increasing in income, you are tending to receive a higher deposit rate on the money that you put. So the graph over here is like a bin scatter. For every bin of decile of income, you have 1 point that is the average of income and the average of the deposit rate. We plot that, and we do find a upward sloping line, which is again saying that as income increases, one is ending up getting a higher deposit rate. And this is, again, I don't want to bore you with all the details of the table. So what this does is it's again showing the same graph in a more structured regression table, and each of these columns are making the identification more and more granular. So you are tightening the specification so to remove any sort of unobservable things going on. So let me pick one of this column, say column number 3, we have year fixed effects, which is removing any form of year specific variations. We have zip code fixed effect, we have product fixed effect. So we are controlling for each and every of these things. And then we are saying that as income increases, there is a higher deposit rate that one is getting, or a household is getting. And if you remember, I had said that the number is 22 basis points high. So if you take any of this coefficients, say 0.128, a number like this would be interpreted as 100% increase in income will lead to 12 basis points increase in the deposit rate. Going from the first to the 10th decile leads to 180% increase in income. So that translates to something around 22 basis points increase in the APY. So now we wanted to show the difference between, say, the number of sub-products, that is whether they have access to more products. As income increases, there is more access to more number of products. More number of products also leads to higher deposit rate, because some of these products are such products that ends up giving higher rates. Minimum subscription size also goes up. So if you have a subscription size of a higher bucket, probably the deposit rates are higher. The maturity is also longer in many of these products. And then, so these are kind of, the previous table was showing that you have access to more products, or more products are available. Now, if you look at a more granular definitions of product, so within that granular definition of product, also you do see as and when income increases, even within product, there is a different deposit rate that one is ending up getting. Again, all of these fixed effects, I don't want to explain. It is tightening the specification as much as possible so that the variation only comes through income, and you're explaining the deposit rate that is only generated through difference in income and not through different products, different banks, and so on and so forth. Our findings are robust to a bunch of other stuff, so I'm not going into that. Now, the next thing that we wanted to show is the result, just an outcome of banking market competition that people have talked about. So we kind of group areas that have a higher HHI, which is a measure of bank competition or bank market structure. And we do see that areas that are competitive versus non-competitive both have similar effect, saying that bank market structure is probably not the main driving force of the results that we're observing. Or the traditional way of understanding bank competition is not the thing that is driving our differential deposits rate. Now, the next thing that I would want to talk about is what is actually driving it. And what I had mentioned is that participation in the non-deposit market is probably driving the results that we're observing. And we kind of do it, and to give you an overview of how we say that this is what is going on, we group income based on one that is coming through participation versus the others. And then we look at participation and deposit flows, whether places that have higher participation, whether deposits in those regions are volatile or not. And that is what we see, that places where individuals tend to participate more in non-deposit market, deposits tend to be more volatile with the movement of the market. As stock market tend to give more return, one moves their deposit out to other money market accounts and so on. And this again is a similar way of trying and understanding. Now we just look at income that is generated through capital gains or through interest income, and we do find again similar relationship of capital gains and interest rate part of the income. That is what is driving the differential deposit rates across the income distribution, and I'll show you it's not driven by the salaries part of the income. So if you focus on these columns, so the first one is the net capital growth to total income, which is the part that we think is the income that is coming from participating in non-deposit market. Probably interest rate to income is also similar, but salaries has nothing to do with income that is generated from the non-deposit market. And if we put all of these subcomponents of income in a regression, we do see only the parts that we think are driving participation, or only those part of income that is coming from participating in non-deposit market are the ones that is driving the differential deposit rates across this income distribution. So this what we do is now we group total income deciles or total income buckets, and within the total income bucket we do see when there is difference in the income that is generated from the net capital gains, that ends up having a higher deposit rate. Now, as a thought experiment, think of two individuals both earning similar total income. One individual have higher proportion coming from net capital gains, another individual lesser proportion coming from net capital gains. The one that has higher proportion coming of net capital gains are the ones that are ending up having a higher deposit rate. All right. So this is just to show that, as participation changes, deposits are more volatile. I'm kind of running out of time, so I'll just speed up a bit more. And this again is showing that, when market participations are high, there is deposit growth, like branch deposit growth goes out in places that have higher participation. So when market returns are high, branch deposit growth goes down when in places that have higher participation in non-deposit market. For lack of time, I'll skip the identification bit, but very briefly we use capital gains taxes. When capital gains taxes increases, the top highest income people have lesser incentive to participate, and we do see that spreads goes down. So this is one way of saying that we use this as an instrumental variable, and this helps us to give some causal interpretation to the results that we have. I'll skip these things, and then the final thing that I wanted to show in this paper is participation and deposit market power. So Rajesh has helped me a bit on this by explaining what deposit market beta are. That is how your interest rate are sensitive to market movement. We do see that participation of individuals in non-deposit market is a way of market power for banks. So if you have a clientele that participates more, your market power tends to be less. If there is a clientele that participates less, the market power tends to be low, and then thereby there is similar deposit market beta accordingly. So that is a different way of generating market power, quite beyond the HHI number that we have talked about, or the traditional way of understanding bank market power. And with that, I'll just conclude. We document there is a differential deposit rates across income distribution, and this is driven by participation in stock markets or other markets. That is what is giving market power to banks to extract higher or give higher deposit rate to a certain group of households compared to the other group of households. And with that, I'll hand over to the next Xingguan. Yeah, thanks a lot. I'm looking forward to the comments and questions.
Right, to keep it brief, I'll just say our third paper is Banks, Images, and Evidence from Financial Advertising. So
okay,
take it away.
And thank you for the organizers. Very happy to present my recent works on banks images, evidence from advertising videos. I'm Shigang from Yale, and this is joint work with Aaron from UBC and Song also from Yale. We know that banks actively advertise to communicate with customers and cultivate loyalty. This is partially because the core financial products that they provide, such as deposits and mortgages, are often perceived as fairly homogeneous. So banks are motivated to advertise and communicate about their advantages to customers. So this leads us to an open question. How do banks strategically build their brand images, and does it work? So in this paper, we use the financial advertising videos to study how banks communicate with customers. We asked two main research questions. First, how do banks strategically craft their images to boost their value? And second, what are the implications for the consumer demand, pricing, and monetary policy transmission? We use financial advertising as a setting because it is crucial for bank operation. On average, bank allocates 9.5% of their annual budgets to advertising. And our data, the advertising creative data, have 51,000 unique TV commercial video clips from 2,700 financial institutions. It has rich, dynamic, multimodal information. So in this paper, we developed a new methodology to extract those information. We combine the video embedding with unsupervised video cluster method to extract those information, which gives us 3 measures of bank images. The first one is pricing advantage, such as we give you the best price. Second is about service quality. We give you the best service. And the last one is about trust and emotion, where your best friend come here will bring the best life. And then with this measure, our first empirical path focuses on the market power, competition, and trust. We find that high local market share banks, they are going to focus on service and emotion. They are going to downplay pricing, perhaps because they do not offer competitive pricing. And we respond to a fintech engine. Incumbent banks shift to a service image focus, such as we have branch in this county, or we have easy to use mobile app. And the last one, financial advertising, also tailored to local demographics and customer base. And the next part is about the demand and pricing. We find that financial advertising strongly impacts deposit quantity, spread, and loan origination. We used a border discontinuity design to identify the effect. And the last part, we linked financial advertising to the transmission of monetary policy. Our results are consistent with the notion of banks' deposit channel, and we argue that advertising could be one micro foundation for banks to maintain their market power and investing in franchise value. Okay, I will skip the literature and let's go to the data and the methodology. For the data, we are going to use Nielsen App Intel from 2003 to 2020. It has 2 parts of the data. The first part is the raw video data. We have those 51,000 unique video clips from 2,700 financial institutions. And the second part is the airtime schedules. We know which each video air when, where, and how much is spent. And then we link our data to standard banking and household finance data such as summary deposits, HAMDA, and so on and so forth. And then for the method, it is the video data. We need to analyze those data. So our goal is to measure the bank's image from those data. So we leverage the recent advantages in those AI to represent each video, the unstructured video data with 3,500 high-dimensional embeddings. And then it has all the rich information. And then we do dimension reduction, we do hierarchical algorithmic clustering to separate those information to different clusters. And then for each cluster, we're going to interpret it using the most frequent keywords, which gives us the 3 banks image measure: pricing, service, emotion, and trust. Okay, this is one visualization of our data. So we can see that pricing is there, service, emotion, and trust is there. So that those measures self-emerge from the data. Let me give you one example. This is the advertising by Trace. So in the advertising, they say that everywhere convenience, everyday security, banker is here to help. And that person is using the mobile apps. So this is all about service quality. If we look at the distribution of the advertising thing, we can see that significant parts of image building efforts focus on trust and emotion. So this is consistent with the literature that they argue that financial advertising is more efficient to triggering customer emotion instead of providing new information. Before we go to the empirical results, I want to show you that what really drives the valuation behind the financial advertising. So here I'm going to regress our measure on different sets of fixed facts to see the R-square. We find that it is not the product year fixed fact and not the county fixed fact explain the valuation. Okay, it is the bank fixed facts, bank's year fixed facts, and bank county fixed facts. Together, they explain more than 50% of total valuation. So in this sense, we can sort of interpret our bank's image measure as one important dimension of bank heterogeneity. So this is we are going to explore in our next session. So we ask, how do financial advertising tell us about bank heterogeneity? We are going to use several important measures of bank heterogeneity in the literature to explain our measure. I'm going to consider deposits and lending business. The first one is market power, such an important and central topic in the literature. So this will help us to understand how image building efforts help banks to maintain their market power. Okay, here's the result. The results are quite straightforward. So in column 1, the deposit markets, and column 4, the mortgage markets. High market power banks do not talk about pricing. In second columns, in the deposits market, they are going focus on the service quality. And the last column, now emotion and trust is more efficient in the mortgage market. The next question is about how do banks adjust their advertising to better connect with local demographics and customer base. So right now we are going to control a bank year visit fast, which effectively we are comparing the actual rates in advertising across different counties for the same banks in the same years. The result shows that, for example, in a county with larger black populations, banks are going to increase their black representation in the advertising. We find similar effects for Hispanics, for Haitian. We find similar effects for the deposit size and the asset size. How about response to competition, fintech entry? We find that when response to a fintech entry, incumbent banks respond by increasing their service-focused image, such as we have branch here, and we also have mobile app, we have online banking, and so on and so forth. And how about response to Wells Fargo scandal, which is a shock to the trust in the banking system? So we find that not only the Wells Fargo itself, but also other banks in the affected county also increase the trust measures to rebuild the connection with the customers. Our last part is about the real implication. We ask how does advertising affect demand, pricing, and transmission of monetary policy. We know that advertising is endogenous to local economic condition, bank characteristics. So we are going to use this identification strategy called border discontinuity design introduced by the TV networks. So the key insight is that consumers on the two sides of the DMA border see different advertising because of the TV network, but they share similar characteristics and have similar product options. Let me show you an example. For example, in this narrowly defined areas, DMA border between Pittsburgh and Johnston, we are going to compare two consumers for the same banks in the same year. One city on the one side of the border, the other one city on the other side of the border. They have similar characteristics, but they see different advertising just because of this TV network. So this can help us to identify the effect. The first result is on the deposit flows and rates. We see that the first row, we see that advertising spending will increase deposit flow and allow banks to charge a higher deposit spread. How about bank images? Those banks that highlighting service, let's call them service banks, that have higher deposit flows and charge higher deposit spread, which means that they have higher franchise value and higher market power in this market. And we find similar results on the loan side. Financial advertising spending also increased loan origination. For the bank's images, now we find that those emotion and trust banks have higher loan demand because they have higher market power, as I just showed you before. The last part is try to connect bank's image with monetary policy cycle. Let's first look at the aggregate time series. We see that when Fed fund rate rises, banks do not talk about pricing. They use more and more survey and trust emotion in their advertising. And then to directly connect the bank's image with monetary policy transmission, we use the standard empirical setting in the literature. So we interact with the change in Fed fund rate with a financial advertising measure. And we also control for the HSI, the market power measure, and its interaction. So we find that when Fed fund rate rises, banks with higher financial advertising spending will increase deposit spread more, experience larger deposit outflow, and larger balance sheet contraction. We find similar results for the bank's images. It is those service banks that have higher deposit spread and experience larger deposit outflow and balance sheet contraction. So this means this is consistent with the bank market power and deposit trend of the monetary policy transmission. Great, let me quickly conclude. In this paper, we asked how do banks strategically craft their images and what are the real implications for banking and monetary policy. So we analyzed 50,000 TV commercial video with AI techniques, and we established banks' image quantitatively. We have pricing, surveys, trust, and emotions. We find that banks establish good surveys and emotion connections to maintain their market power. They establish their images to cater to specific local demographic and customer base. And finally, we show that all these image building efforts can affect their product demand, pricing, and the transmission of monetary policy. That's all. Thank you.
Okay, and finally we have Bill Bickle, who is going to give us a sanity check from the community banking perspective.
I've been accused of many things, but never a sanity check. Usually I'm leading the insanity. But first of all, thank you very much for the invitation to address this conference, and certainly to the presenters and the papers that they present, which certainly create topics worth thought and consideration. As a community banker, as a person with a degree in economics, but who frankly spent more time supporting Montana State University's aspirations to be the #1 party school in the Northwest versus academics, my approach will be a little bit different. And I approach this from the standpoint of 40 years of experience in the banking industry, except for 5 years as a regulator, as a community banker for all of my career. Many of us in this room have experienced firsthand the changes and the evolution in the industry as it's affected branches. The rise of branches and truly national banks, as identified in the papers. The predicted demise of branches in the community banking model, which has never come true, no matter how often predicted. The development of electronic banking, which was supposed to lift from us the burden of managing physical locations, and instead, from my perspective as a community banker, it simply multiplied the complexity of now running multiple delivery channels in a environment, including the branch, and coordinating all the different delivery channels. And finally, the unanticipated impact of electronic banking on the stability of our deposit base. Not all that long ago, we rediscovered that maintaining customer confidence in our institution remains the most important goal. That was true in 1905 when my great-grandfather opened his first bank in rural Montana. That was true in the 1980s when Continental Illinois Bank of Chicago failed. One of the big reasons behind its failure was the unitary banking laws, in other words, no branches, within the state of Illinois at that time. So as we look at this, let me start with basically some bright pictures. And what I want to touch on here is really the composition of the U.S. banking market. And we all have our own definitions of where community banking ends and where big banking begins. I would submit to you, and my position from the perspective of a community banker, is that in the larger banks, the branches are usually monoline. In other words, what they're devoted to is the presentation of retail banking services to the consumer. Whereas in the community banking model, the branch is usually the one, the only, the multiple channel deliverer of products, services, and image to the consumer. My personal definition, 50 billion and over, is more of a monoline presentation within the branching environment, but I'm sure we can all think of one or two exceptions to that rule. The point I want to make is when you put together 50 billion and over, you have a relatively small number of banks, less than 50, that control something close to 70% of the banking assets and probably 50%, roughly speaking, of the offices. But then when you turn to the rest of us, the under 10 billion, We're only 25% of the banking assets. We're 4,300 banks. We have 38% of the branches, and we are a very important part of the industry that behaves very differently in terms of how we use and develop branches than the large banks. I think of those of us in the community banking space, in other words, those of us in the red, as kind of the hobbits, if you think about it in the terms of Middle Earth, the hobbits of the banking industry. But I will remind you that the hobbits are the heroes of that story. And I think that is entirely appropriate. As we look at this, I think, again, going back to how I spent my undergraduate days, pictures are perhaps the best way to describe how different banks and different banking models use the branch, relying on the branch structure itself as a proxy for the argument. This is a very typical example of what I call a monoline branch, typically used by the larger institutions. It's about 2,500 square foot. It's one level. It's usually built in a high-traffic shopping center area. It is designed for deposit gathering. Its lending floor is consumer, small business commercial, usually executed through some sort of automated decisioning platform. The branch is efficient. It's relatively inexpensive to build. The investment in this particular branch, which was built in 2021, probably $1.5 million, plus or minus a little bit, and can also be repurchased. Repurposed. As one of my friends pointed out, this could always be renovated into a Starbucks if necessary. It's also a very successful model. It's maybe very different from how we do things as community bankers, but for its particular purpose, it is a very effective model. The final point that I would like to make, because as the research would indicate, the purpose of having a branch is not consistent across asset size. This branch, which actually is owned by Chase, was the branch in Montana which finished out Chase's strategy of a representation and having a flag in each of the lower 48. And so this bank is here for deposit gathering, but is also here to fulfill corporate goals of Chase's leadership. The other side of the world is this. This is a flagship Stockman bank. We have put institutions like this one 6 times into 6 different markets within the state of Montana. This building is not subtle. This building is very expensive. It actually represents 67,000 square feet of investment plus a parking garage. And it is viewed not only for the purpose of developing retail deposits and small business banking, but it also covers the entire range of services that we provide as a $7 billion community bank located in the state of Montana. Cash management, wealth management, our insurance subsidiary, our commercial real estate, our real estate development lending, and our treasury management for certain large customers are all handled through that facility. And what is different, about our community banking model as compared to the large banks, is that we provide similar services, but we anchor the people who support and provide those services in these branch structures. It's expensive. This is the passion of our CEO and his sister, who also own something over 90% of our company. So it's a corporate model that we are deeply invested in. Fortunately, by our definitions, it is successful. The Missoula market, and this was the flagship branch in the Missoula market, we entered the market in 2015. We've built three large locations in the Missoula market. They represent in total 145,000 square feet of space that is 70% utilized by the bank, our investment affiliate, and our insurance affiliate. So for the sake of my regulator who's in the audience, we're actually using our space as banking space. This is not a disguised commercial real estate investment play. But as you can see, as we grew into the downtown, the Brooks, and later the Reserve locations, we have managed to move our deposit volume in the Missoula market, which is a population of about 120,000 people, up over the $500 million mark in the course of about 10 years. And we've accomplished our goal of becoming the #3 deposit institution in the Missoula market behind 2 large legacy operations, and more importantly, to help pay for all the buildings, because the investment is significant. In our chosen lines of business, particularly commercial real estate lending and real estate development activities, we are at parity to or in a leadership position in lending in those markets, and that's an achievement that we are particularly proud of. The question, as we start to contrast these 2 models, is what do we have in common, and what do we have that's different? In common, both the large banks and the community banks are making an effort to deliver services to our customers through the branch environment. We're certainly using the branches in much the same way as a mechanism to develop stable and, more importantly, diverse deposit funding. The other thing that both of these buildings have in common is that they are only buildings. The quality of what we're able to deliver, our ability to deliver it, rests primarily on the people who are within the actual institutions. Without individuals in either of those 2 buildings who can answer customer questions and who can help customers solve problems, because the customer may have access to electronic banking, but my experience in the real world is when they have problems with anything that involves the bank, they're going to come to the branch building and look for the solution to their problems. And in order to provide that level of protection or that level of service to your customer, whether it's a large commercial client with a cash management follow-up, whether it's a small consumer with a credit card issue, you have to have people inside the building who can look them in the eye and guide them towards a solution. We see a similar issue, or I had a similar issue yesterday with the airline industry. To no one's great surprise, the airline schedule kind of went to heck, leaving me in Minneapolis. I was getting 5 different emails with 5 different departure times. Fortunately, because I had the status to be in the Delta Club, I wasn't reliant upon whatever was coming across my phone, but I could go to a specialist at the front of the Delta Club and say, okay, which of these emails really matter at this point in time? They didn't know, they were just as confused as I was. But more importantly, they could pick up the phone and not call customer service. Rather, they called Delta Dispatch downstairs somewhere at Minneapolis Airport and got the real answer as to where my plane was and what gate it was going to show up at and what time I had to have me and my carry-on at the gate. Extremely helpful information. Likewise, whichever model you're going to, and I would argue the advantage of the community bank model, particularly as we have implemented it within our use of the branch and why the branch is so central to us, is that inside that great building, there are people who have the experience and the contacts if a customer with a credit card problem walks into our office, to either answer the question and help the customer, or pick up the phone and call a colleague, perhaps at the main office, who they know and who they have a relationship with to help resolve the specific problem for the specific customer within the context of what the customer's problem is. When you move into the environment like the larger banks have, and which they probably have to, to where the branch is just a gatherer of retail deposits and its value is exclusively as a gatherer of retail deposits. All the branch representative can do is call the same 800 number, maybe with an expressed access number, but still the same 800 number call center to get an answer for the customer. The final point that I will make very quickly is to do that, you have to empower the people at your branch. They have to have the power to solve a problem. That creates all kinds of regulatory concerns, but it is inherent to the community banking business model, which has been, and hopefully will always remain, people helping people. And again, it's not so much about our buildings, although we're very proud of them, but it's more about the people that we put in the buildings and the empowering them with the ability to help their customers. So I hope this a little bit unconventional view of how we see our branches working is actually helpful to the discussion today. Thank you very much.
Okay, thank you for those great presentations, and thank you for inviting me to speak at this conference. So my goal today is I have this unique opportunity to take a look at 3 academic papers that were selected because they are related, and then my challenge is to tell you a story about the deposit market and how that interacts with banks that incorporates all of the information that we learned today. So let me start by talking about banking as an ecosystem. So the industry has several different bank business models, and I'm going to say a very rough cut of the banking market we can do by size. We have these large mega banks, then we have large banks, mid-sized banks, and then small community banks. And then in the banking market, and maybe it's correlated with size, banks serve different economic roles. So some are very focused on building up the local economy. Some are more nationally focused or regionally focused. But all together, this combination of business models and objectives, economic roles, work together in an economy, whether it's a small county level, or maybe it's state level, or maybe it's national level. But they work together to make sure that people have access to finance. All right, now let's get to deposits. So deposit taking is a core function of what banks do. And the papers in this session all talk about different ways that banks deal with deposit taking. We learn about the methods that banks use in order to attract deposits, to get deposits through the door. Then we learn about how banks strategically retain those deposits. And then finally, how banks manage their business models in reaction to deposit taking and the evolution of how deposits work. And so my goal today is to build a story about how banks manage their deposits, and then for the authors of these papers to help them see what the other papers have done that might be useful to them, and what they can do in order to be useful to the other papers and also just to academic research in general. All right, so the story that I want to tell is the following, and I'm reversing the order of the papers. So I'm going to start with paper 3, and that paper shows us that banks use advertising to get deposits into the door. Then the second paper tells us that banks pay the highest deposit rates to attract and also retain the wealthiest depositors. And finally, the third paper, the first one that was presented, tells us that banks close branches in areas that are dominated by these depositors. Now, clearly, I've gone through and cherry-picked certain results that fit my narrative instead of kind of focusing on the exact main thrust of each of these papers. But the evidence in these papers builds this story. So let's start with the third paper. And here what we're learning is that banks actively pursue local deposits. And what I've done here is include a figure from the appendix, but it's very compelling in terms of telling us what type of advertisements banks are using in order to attract deposits. And so we have different kind of pricing advertising. Then we move on to service, and finally to trust. And so what we learned in this paper is that pricing is a relatively low percentage of total advertising content. When we move over to service, we have about 20% of content, and finally trust is the largest component of advertising creative content. So what can we learn from this? The authors tell us that when they split banks by different, let's say, business models, then banks that have high deposit concentration tend to sell service, and banks that pay the highest deposit rates, not surprisingly, they sell price. All right, so then what can we learn as a body of researchers from this? So what I would suggest to the authors is that you have a unique opportunity to help us learn. So you can categorize banks for us based on your unique data that we can't see, but then our regulatory data that we actually can see. And so using your data, you can see how banks are appealing to local communities. And we can't see that, but you can tell us the characteristics of those banks. So if I'm a bank that's really appealing to the trust component in my advertising, then tell me what those banks look like. And it can be really rough cuts, like size, number of branches, maybe where those banks branch. Are they just located in the county, in the state? Maybe it's national. So what is kind of the thrust of that bank business model? And that's going to help us as academics, because when we try to define something like a local bank, you can come up with 19 different definitions of what a local bank is, and in the academic process, a referee will push you to develop all 19 of those. But it would be nice, using your data, to be able to be more precise about what a local bank is. And I would say, in this paper, we have such an opportunity to really see how banks identify themselves. Because when you are advertising on TV, in a local TV market, you're really trying to hit local people. And so this ultimately tells us which banks are trying to get those local deposits. So I think you have the opportunity to help everyone else. All right, so let's move on then to the second paper, which retains its position as the second paper. And in this paper, what we learned is that rich people, so these are poor people, and these are rich people, that when we move over to the rich people, they get the highest deposits, or rates. So they get a lot of interest relative to the poor people. So let's really focus then on these wealthy people. What do we learn about the relationship between wealthy depositors and these deposit rates that banks are willing to pay? All right, so what we learn is that banks are competing for these wealthy depositors, but they are not competing with each other. Maybe that doesn't surprise the bankers in this room, but they are not competing with each other. They're actually competing with alternative assets that the depositors could invest in. So rather than depositing my money at the bank and earning bank interest, as an individual depositor, I might also buy a municipal bond, or maybe I'm going to buy a mutual fund. But I can do something else with my cash beyond keeping it in the bank. And so banks aren't competing with each other for my money. They're competing with me and my outside investment opportunities. So that's kind of a very different than economic role for those banks. So rather than within a community competing with each other to get community level deposits, now we're competing with financial instruments that are perhaps international. So that changes the economic role of banks. And one thing I really want to know is, are these banks that are really competing for wealthy people's money, are those the same banks that are these local community banks? Do community banks really want to be competing with municipal bond funds and other types of investments? And so I think it would be interesting if you can come up with some proxies for how banks want to serve the local economy and whether they even are serving the local economy. And again, I'm just going to propose my naive cuts of the data, which are size, number of branches, the concentration of branches perhaps in a local market, how broad the branching network is. But maybe from the advertising paper, we can learn about more precise cuts of the data. But I think it would be very helpful to categorize the banks based on their local or national focus, and that's going to help us understand your results in a more nuanced way. And then finally, what we learn from the third paper in my story, first in the presentation, is that banks are closing branches in areas that are dominated by these sophisticated, wealthy depositors. So let's look at the deposit franchise decile, which is basically deposit profitability. And in the lowest profitability decile, so these are the lowest profits, we see the highest percentage of branches being closed. So low profits, a lot of closures, high profits, banks keep their branches open. Now, the low deposit areas, the low profitability areas, tend to be the areas that are dominated by these sophisticated, wealthy depositors. And so what I take away from that paper is that these financially sophisticated depositors demand high deposit rates. Those high deposit rates reduce the franchise value or the profitability of those branches, and then that is driving branch closures. That is really impactful on an economic level for these local banking markets. And so what I think this paper has the opportunity to do is to actually characterize local deposits following these exits. So let's say that we have a branch close because this area has really low deposit franchise value, low profitability, deposit profitability. Then what does the remaining volume of deposits look like? So did that branch walk away with a bunch of local deposits? Or did most of those local deposits stay local? And perhaps that's individuals choosing to work with banks that keep branches in the local area. Or perhaps that's driven by more of like a data categorization. So maybe banks account for their deposits across different branches through their network differently, such that when that branch closes, the deposits don't necessarily exit the local economy. So I think what I'd like to learn is what happens to the deposit environment after those branches exit. And if there's money there, then how are those deposits redistributed across the remaining branches? And then finally, speaking to the second paper, what happens to the volatility of deposits? So if I'm a bank and I shut down my branch because there's low franchise value, then do the deposits that stay have the same volatility? Or as a branch, did I take those highly volatile, wealthy people deposits and did I just move them out, and now the remaining deposits are the ones that are generated by the local economy and that are intended to stay in the local economy? So I think there's an opportunity there to learn about whether that closure actually affects the local banking market. All right, so coming full circle, I think that this story has really important economic implications. So sophisticated, wealthy depositors are reshaping local banking markets. So they're promoting price competition, they are increasing deposit volatility, and they are reducing deposit franchise value. And they lead banks, these type of depositors, lead banks, especially large banks, to close down branches. And so ultimately, this actually might reduce access to banking in local economies. And so what I would like for anyone to take away from this session is that there is a crucial role for a diverse banking ecosystem in order to preserve and promote financial access. But in order to build that ecosystem, we have to incorporate the fact that it exists in our academic research so that we can really learn about all of the different components of a banking market. So, thank you very much. Okay, so now we will begin our Q&A session. So, all right, I see a hand up in the back already.
Hi there, Melanie Hall. I'm the banking commissioner in Montana, and I actually have thoughts about all three papers, so hopefully I'm a fast talker though. Number 3, which I'll go in the same order that the moderator went in. So paper number 3, first one you discussed, regarding financial advertising. First of all, I really enjoyed your paper and your presentation. It reflects what I think of when I think about community banking in terms of service and connection, and I think that customers are less interested and have less of a need to know pricing details because the services that are being offered by community banks and the products can be more individualized. So it's not like we're going to make you a commercial loan at 5%. Is it an ag loan? Is it commercial real estate? Like, pricing can be a little challenging there. So I don't think that's what community banks are selling, and I really enjoyed your paper. Number 2, regarding poverty spreads and deposit markets. One thing that I think would be interesting to highlight is that community banks, generally speaking, are focused on stability of deposits. And so really talking about time-linked deposits, CDs, and the type of deposit product that's being offered, and how that relates to pricing and wealth distribution. I also think that poor people are at work, and really rich people are at home surfing the internet looking for good yields. I'm not sure how you capture that. And then really interesting to me on the paper on the decline of branch banking, and that it just entirely does not align with my experience over being the banking commissioner for 15 years in a rural state. I don't see branches closing in highly sophisticated, wealthy areas. I see branches closing in incredibly rural areas where there is less attractive, there's less attraction, particularly for larger banks. So for instance, in Montana, Wells Fargo used to have a ton of branches. They're having a hard time competing with community banks, and they are closing branches across the state. So my experience has been that rural America is where a significant portion of branch closures are happening. And as someone who lives in a very rural state, I don't associate those rural areas with super wealthy, sophisticated depositors. They might have some land wealth, and then I also just want to say I love Bill Bickle. He is, as the banking commissioner of Montana, Bill and I have known each other for a long time, and I think he brings a really unique perspective to this conversation. But also, Bill, we call them the Bills, because Bill is the chief credit officer and kind of does a lot of things at Stockman Bank, but the owner and president CEO of Stockman Bank is also named Bill. And I think sometimes they can have very diverse views on branching and how that goes in the markets. But I think this was a pretty cool and unique opportunity for the less I need to build a giant branch member of the Bills to reflect on the other Bill's perspective on branching. So,
Melanie has been very entertained by the fact that I have to defend my boss and CEO branching strategy.
I do very much love that. So, but thank you to Stockman Bank and your commitment to Montana and particularly rural communities. Thank you.
Okay, other questions? Insights? Yeah.
Services to highlight this sort of personal connection that's important for not just banking products, but other types of.
Yeah. I think in fairness to the industry, there's an effort on the part of the larger segment to get closer to the community banking model, as I think their own research would indicate that the customer is looking for service. The difficulty, and it's even for us as a community bank of about $7 billion, the difficulty that we're facing in implementing our branching strategy is staffing of these branches, and particularly staffing of the branches with individuals who have the quality and the training and the experience to truly be helpful to the consumer. And so where the convergence is going to fall apart from the perspective of the larger banks, in my opinion, and they certainly don't call and consult me, but never mind, is finding the people within their buildings who can actually deliver the promise. The final point I would make as I sit here and think, okay, what are things going to look like 5 or 10 years from now? If you can effectively use AI to back your branch staff with an interactive database as they're interacting with the consumer in real time, then the large banks have an opportunity to effectively bridge that gap. That'd be my response.
Question in the middle. Yes, yeah.
Really fascinating papers, and I'm also learning from Bill. Since I haven't really worked in the banking industry as an academic, it's extremely valuable. So in my mind, I have this model of banking in my mind, which I think can actually connect, what Bill, you're saying in terms of delivering services, and the finding, at least the second paper, which is that for a lot of the services, banks do not charge explicitly, right? You do not hand the customer a bill just saying, oh, I cashed a check, or I did this transaction for you, and so forth. And so implicitly, you would have to earn that from the interest rate spread, right? And so for customers with small balances, if they essentially consume similar amounts of services, then in order to balance the book, you would have to pay that customer a lower interest rate. That's just how the economics will work out. And so I would really love to learn, now that we have more and more data, how much differences in terms of the amount of services consumed by people of different, say, income levels, and then try to come up with the estimate of the value, and then try to compute, to be reasonably priced, what would be the interest rate spread for different customers, and truly to get to the bottom of, if we're observing X amount of smaller interest rate payment to lower income customers, how much of that is because essentially this is the implicit charge for providing them with the services they're consuming, and how much of it is truly because somehow there is a markup. And so I think that nowadays that we do have that kind of data to be able to kind of get to the bottom of this question that I've been fascinated for years. Thank you.
Okay, thank you. More questions, comments, insights? Yes, in the middle.
Maybe part question, part comment. Brett Aftal from South Dakota. Like Melanie, I live in a very rural state, and our experience has been pretty similar. Most branch closures are not in our, if you can even call them a metro market in our state, but in the smaller communities. So I guess, I don't know how to really even formulate this, but I'm really thinking, how does what these three papers have put together interact with CRA? You know, how does the Community Reinvestment Act work in this environment? How should it work? How could it work? Because I think in theory it, you know, incentivizes or requires banks to invest in their markets, but I think what we've seen is that they make certain investments in certain markets while also shutting down in these rural, you know, less profitable markets. So I don't know how you could put that question into a paper form, but it'd be interesting to see how it interacts here, and is it doing what it's supposed to do, or is it just, you know, do banks just end up making big investments in very certain and specific markets that gives them the rating they need for the whole bank, and then they can close down these less profitable branches with no questions or issues from their regulator?
Well, there is some evidence that that's exactly what's happening, that banks are closing branches where CRA compliance is the issue, especially amongst the larger banks. So there is some evidence to exactly what you suspect. But in our paper, I think it's just more broad. I mean, we control for a lot of those kinds of things. I mean, what we're showing is that the trends are very broad. In other words, it's not being driven by urban versus rural areas. It's not being driven purely because I want to avoid CRA compliance. I think we're seeing some underlying structural shifts, and that's what's causing this broad restructuring. Now, of course, it's going to vary across regions. You're not going to see it the same way in Montana that you'd probably see it in Pennsylvania. But we are losing a lot of branches.
Yes.
The short answer is yes, in the paper. So we are taking into account broadly what we call mergers and acquisitions. So whether these are things that are due to banks because of mergers. So there's merger-related closings or merger-related exits, or just voluntary exits. It doesn't explain the volume of what we see. No. A lot of them are closing unprofitable branches.
Tony?
Maybe a little bit on that. When you talk about, when you talk about profitability, is it all about net interest margin, or is it the whole picture?
I should be careful. This is the profitability that arises from the deposit side of your business, purely. So that's what we mean by the deposit franchise value. Literally, it is the profits you earn from the stock of deposits that you have because you pay below market rates.
Kyle Thomas from CSBS. This is maybe kind of an observation and question for Bill, something that occurred to me listening to your breakdown of the branching strategies. If you go to any small rural community that has a traditional main street, usually the nicest building on that stretch is the old bank building. It's usually the grandest, the biggest, maybe outside of the courthouse. That's usually the bank building. And my understanding of history was that was done to convey to the banking public that this building and this facility is stable, secure, and you can trust us. It conveyed that kind of like power and presence. And as I looked at your examples of the big banks coming in with these fast casual type cheap branches, compared to yours, I'm wondering if they can kind of get away with that because the stability, the trust factor is kind of baked into the too big to fail advantages that they arguably enjoy, versus maybe your branching structure needs to convey that you're here to stay.
Yeah, I think there's a lot of truth in that observation, and it's certainly part of the strategy. In that the too big to fail banks, the larger banks, incorporate the branch as part of a very broad marketing strategy that's wrapped around everything from nameplates on arenas to national advertising to whatever the case may be. Whereas in the community bank model, as it's typically practiced, the building is a nameplate, it's a billboard, it's a statement of purpose, it's a statement of seriousness, it screams for attention. And all of that, I think, in many, many community banks is a very conscious strategic choice, and it certainly is in our institution. It is not an expression of, for lack of a better word, ego by the shareholders or the board or the CEO or whatever the case may be.
Okay, and this is an absolutely fantastic way to end this first session. So thank you to everyone.
Thank you to Elizabeth, Rajesh, Arko, Shugan, and Bill. Thank you for kicking off our very first research session, and thanks to all of you for your engagement and your questions. We are now breaking for lunch. So for our web stream audience, we'll see you back here in an hour at 1:30 p.m. Central Time. For the rest of you, lunch is served immediately outside the auditoriums. We have seating options. We have kind of the high top options. It is buffet style, but hopefully we can continue some of the conversations and engagements that we started here during this session. Also would encourage you to speak to our poster, our one poster presenter, and I mentioned we have a second poster presenter from Temple University, although he is not here. His poster is out in the pre-function area, so I would encourage everyone to take a look at that. The paper itself is titled Mission Driven Lenders, and we're going to briefly hear from its author, Samuel Rosen, right now before we break for lunch.
Hello. My name is Samuel Rosen, and I'm an assistant professor in the Department of Finance at Temple University. I've been selected as one of two poster presentations for the 2025 Community Banking Research Conference. Our paper, Mission Driven Lenders, provides a systematic analysis of the Community Development Financial Institution, or CDFI, program in the United States. Although the program has been around for 30 years, it remains relatively unknown. We address three questions in our paper: how and where CDFIs are growing, why depository institutions seek certification, and how certification awards affect depository CDFIs. We document many empirical findings, including the fact that loan fund CDFIs complement SBA lending, and that the CDFI program appears to relax financial constraints for credit unions, but not for banks. Unfortunately, I'm unable to join you all in person this year, but you can view my poster outside the auditorium and watch my recorded presentation in its entirety at communitybanking.org. Thank you.
All right, and with that, we will see you back here at 1:30, where we will hear from the FDIC's Director of Research and Insurance, Andy Felton. We'll see you back here at 1:30. Thanks, everybody. Everybody, welcome back. And welcome back to our live stream audience as well. Hopefully we were able to keep the conversations going from this morning. Seemed like a very lively and robust lunchtime discussion. So thanks to all of you, and look forward to now rounding out the afternoon. So we've got a lot of interesting components. We're going to hear from our second research session. We're also going to hear from the winners of the 2025 Community Bank Case Study Competition, always a highlight. We are going to hear later this evening from our Community Bank Keynote speaker. But first, we are going to hear from another one of our sponsoring agencies, the FDIC, and I am pleased to welcome Andrew Felton, the Director of the Division of Insurance and Research at the FDIC. In that role, he oversees management of the Deposit Insurance Fund, research, economic analysis, and international coordination. He previously served as a Deputy Director for Systemic Risk in the FDIC's Division of Complex Institution Supervision and Resolution. Andy joined the FDIC in 2005 and has also worked at the Federal Reserve Board of Governors. So with that, Andy, welcome to the 2025 Community Bank Research Conference. Thank you.
Thank you, Jim. So I learned this morning that the main new threat vector is voice spoofing, and so I'm a little nervous that if this is being recorded, it will be used by AI to hack into my accounts. But don't worry, I have two-factor authentication on all of my apps, so hopefully I'm safe. Anyways, good afternoon, everyone. It's a pleasure to be here in St. Louis at the 2025 Community Banking Research Conference. I would like to thank our hosts, as many other people have done so far. So thank you to Jim and the rest of the Federal Reserve Bank of St. Louis team, Brandon and the Conference of State Bank Supervisors, the Federal Reserve System more broadly, and also to my colleagues at the FDIC for convening what has become really one of the most important conversations on community banking every year. I've heard great things about this event over the years, and it's an honor to be with you in person here today. So anyways, as Jim mentioned, my name is Andrew Felton. I'm the Director of the Division of Insurance and Research at the FDIC. And in that role, I spend a lot of time thinking about how research, data, and analysis can help us protect depositors, safeguard financial stability, and support the community banks that anchor our financial system. As you already know, this conference is unique. It's one of the few places where bankers, academics, supervisors, and policymakers sit down together to share perspectives, discuss evidence, and engage in constructive dialogue. This combination of rigorous research and real-world experience is powerful. It ensures the topics we debate are grounded in data and thoughtful analysis, but also connected to the lived reality of community banks across the country. This afternoon, I'd like to share with you my perspective on how research informs sound banking policy and how partnership among bankers, researchers, supervisors, and policymakers ultimately helps us all strengthen the financial system. These three themes, research, policy, and partnership, run through the very core of the FDIC's work and will frame my remarks today. The importance of research to the FDIC's mission goes back to our earliest days. In 1934, the corporation's first full year of operation, a research unit was established to collect data on the condition of banks, study the history of depositor losses, and analyze efforts to stabilize the financial system. That early commitment to evidence has remained a defining feature of the FDIC for more than 90 years. Today, research is not separate from our mission. It's embedded in everything that we do. It ensures our policies are grounded in evidence, our supervision is focused on material risks, and our actions build confidence in the banking system. Let me briefly highlight some of the ways the research continues to shape our daily responsibilities. First, research provides the analytical foundation for protecting the Deposit Insurance Fund. We use models to estimate potential losses, guide provisioning, and calibrate risk-based assessments. These tools help ensure that the fund is strong enough to weather stress and continues to provide the protection that depositors expect. Second, research strengthens supervision. Our analysts develop monitoring tools that combine bank, market, and economic data to identify early warning signals. These tools help examiners target their time and resources more effectively and keep the supervisory focus on core financial risks. Third, research supports policymaking. Every major FDIC rulemaking is accompanied by research that weighs costs, benefits, and potential unintended consequences. By drawing on call report data, summary of deposits data, and surveys, we assess how policies may affect institutions of different sizes and the broader economy, with the aim of regulation to be both evidence-based and proportionate. Fourth, research prepares us to manage and resolve crises. When a bank fails, decisions must be made quickly and under pressure. Long before that moment, research helps us understand the implications of alternative resolution strategies, fund management through the cycle, and the possible effects of a failure on local communities. That advanced work allows us to act swiftly, to protect depositors, and minimize losses to the fund. And fifth, research helps us stay abreast of emerging risks. New products, evolving market structures, and unexpected events often challenge our traditional frameworks for assessing risk. Research equips us to evaluate when assumptions need to be revisited and to develop new tools for a changing environment. And perhaps most importantly for this audience, research deepens our understanding and support of community banks. Through surveys, quarterly banking profiles, and work at the FDIC's Center for Financial Research, we study the unique role of community banks in their local economies. These insights shape how we inform policies, how we think about de novo applications, and how we assess the impact of new rules on institutions of different sizes. One example that illustrates how research and policy come together is deposit insurance reform. In 2023, after a period of turmoil in the banking sector, questions about the future of deposit insurance took center stage. Relying on prior research and extensive institutional knowledge, the FDIC was uniquely positioned to comment on the history and objectives of deposit insurance and the implications of alternative reform proposals. The FDIC responded by publishing a comprehensive report outlining different reform paths, and for each option, we carefully analyzed the benefits, the costs, and the risks. We asked, how would this affect depositor confidence? How would it influence moral hazard? And how much would each option cost the fund in the industry? Our goal was not to advocate for one answer. Deposit insurance reform is ultimately a legislative decision and is part of a larger framework of law and regulation. Our role was to ground the debate in evidence so that policymakers, bankers, and the public could weigh trade-offs clearly. The question remains timely. This morning's presentation on the Community Bank Survey highlighted that nearly 4 out of 5 bankers supported some type of deposit insurance reform, whether through higher coverage limits or targeted protection. Deposit insurance has served us well for more than 90 years, but changes in technology, the deposit landscape, and the concentration of uninsured balances all warrant a fresh look. Whatever path is chosen has the potential to shape the system for decades. The FDIC provides data, modeling, and policy analysis that clarifies the trade-offs and help inform sound banking policy. Deposit insurance reform is just one example of how research informs policy. The same principle applies to many other issues we're debating in banking today: supervision, mergers and acquisitions, new entrants, and the role of technology. These themes are not only central to the FDIC's work, they are also at the heart of this conference. And that brings me to the second part of my remarks: how research is at work in addressing today's most pressing banking challenges. And so far, I've described how research serves as the foundation of sound banking policy. But the real test of research is how it informs the decisions we face today, the policies we set, the supervision we carry out, and the priorities we advance to keep the banking system sound. Topics on supervision, M&A, entry of new banks, and the role of technology are central to the debates taking place in the industry, in academia, and among regulators. Research gives us a common ground to hold those debates. It helps us test assumptions, quantify trade-offs, and see risks and opportunities more clearly. Let me touch on a few of these themes today. I'll start with supervision. Supervision is at the heart of how we safeguard the banking system. But as recent events have reminded us, it is not enough to simply have rules on paper. Supervision must be risk-focused, timely, and effective. Research helps us understand how supervision affects outcomes, when it helps banks recognize problems earlier, how it can promote safe and sound banking practices, and where it may introduce tensions with fairness or burden. These questions are not abstract. They shape how banks experience exams, how supervisors allocate their attention, and how confidence is maintained in the system. We'll hear more about them in our next session on failed banks, and see them reflected in the ongoing conversations about how best to strengthen oversight in the light of past failures. As always, the real value comes from the dialogue between bankers, supervisors, and researchers about what does work and what doesn't. The FDIC, as part of its current agenda, is working to ensure supervision remains centered on core financial issues, such as capital, liquidity, interest rate risk, and credit quality. Research is a critical ally in this effort because it provides evidence that can help identify emerging risks sooner, allocate supervisory resources effectively, and evaluate the effects of exam practices. These insights help us strike the right balance, rigorous oversight that is fair, transparent, and constructive. Another topic where research is indispensable is industry structure, how banks enter, exit, merge, and compete. Questions of concentration, market power, and branch access are not just policy debates, they affect whether communities have meaningful access to financial services. Research helps us measure these effects more carefully, how deposit franchise value shapes competition, how mergers affect the availability of credit, how new entrants can revitalize local markets. We listened to a very insightful discussion on these topics during our first session, and we'll also hear from bankers' experiences at the panel tomorrow morning. On our end, the FDIC is reassessing its approach to merger review and committed to ensuring that de novo applications are considered in a timely and transparent way. But the broader point is this: decisions about mergers and entry are stronger when they're informed by evidence on competition, on community impact, and on financial stability. That is what research can provide. Perhaps no topic illustrates the intersection of research and practice more vividly than innovation and technology. Banks today face both opportunities and risks from technological change. Cyber resilience, artificial intelligence, and third-party vendor reliance are now central concerns. Research helps us understand these developments more clearly, measuring whether AI can improve credit outcomes, testing the resilience of payment systems, and examining the implications of open banking models. By relying on evidence, we can separate signal from noise, helping community banks adopt new tools and manage their costs and risks, without losing the strengths that define their business model. Finally, research informs many other areas of policy that are critical to the system's strength. These topics include calibrating capital requirements, analyzing fraud and payment system vulnerabilities, and adjusting regulatory thresholds to right-size the burden on smaller banks. In each case, research ensures that policies are proportionate, targeted, grounded in data, and responsive to the realities of different types of institutions. Taken together, these themes reflect questions faced not only by regulators, but by bankers and researchers. And research provides the bridge. It clarifies the trade-offs, informs the debate, and helps us move from theory to practice. Which brings me to the final theme I want to share with you today: the importance of partnership and open dialogue in making that research truly effective. Community banks are anchors in their communities, lending to small businesses, supporting households, and building trust that sustains local economies. The FDIC supports that mission. But no bank and no regulator succeeds alone. Partnership is essential. Bankers bring lived experiences and local insight. Researchers bring rigor and fresh ideas. Supervisors bring perspective from across the industry. And policymakers bring the ability to turn evidence and practice into rules and frameworks that endure. Each perspective is valuable on its own, but it is only when they are connected, when we listen to one another, test assumptions, and challenge each other constructively, that we achieve sound policy and strong outcomes. Dialogue is central to this partnership. The FDIC is committed to hearing from bankers, supervisors, and researchers. We seek public input on our proposals. We collect data and request comments on current processes we think can be improved. And through conferences like this one, we learn directly from each other. Dialogue improves policy because it grounds our work not just in models and data, but in the realities of those that we serve. Partnership and dialogue also create opportunity. They open doors for innovation that benefits communities. They allow us to anticipate risks sooner and respond more effectively, and they ensure that community banks continue to thrive, even as the financial system evolves. Let me close by once again thanking the conference organizers for bringing us here today for this important conversation. I'm honored to be here with you. The FDIC is committed to grounding its work in research, advancing sound banking policy, and strengthening community banking through partnership. But that commitment is only meaningful when it includes your voices. So please come find me and my 6 or 7 FDIC colleagues here during the conference, and I want to encourage you all, bankers, researchers, supervisors, and policymakers, to continue engaging with us. Share your experiences, share your evidence, and share your ideas. Because when we combine analysis with experience and policy with open dialogue, the result is not just stronger regulation, it is a stronger community banking system and a stronger overall financial system. Thank you. Thank you, Jim.
All right, thank you, Andy. We are now going to move into our second research session. So I would ask the presenting authors, the community bank discussant, and the academic moderator for session 2 to please come to the front of the room. Looks like we're a little bit ahead of schedule, so we'll start now, and that means you get a longer break in a little bit. So,
or we'll go over,
or they'll take that time back. As they are getting set up, just a couple of reminders. First off, during the Q&A, since we do have a web stream, live stream audience, when you ask a question, just please be sure to turn on your microphone. I know in some cases we can hear you here in the room, but we want to make sure that that everybody participating either here in person or virtually is able to do that. So again, there's that gray button right in front. If you tap it, it'll turn green. It's very sensitive. Everyone will be able to hear you then. A few other things too, and our one of our poster presenters mentioned this, Samuel Rosen from Temple. I know he's not here, but mentioned that in addition to having his poster out there, both of our poster session presenters did a more comprehensive presentation, around 10 minutes. That's on communitybanking.org. So if you'd like to hear from them a little more specifically on their work and on their findings, please be sure to check that out. So here we go, and Director Felton just mentioned this session in his remarks, titled "Failed Banks." So this should certainly be very interesting. Delighted to introduce our academic moderator, Christopher James. He is the William H. Dial SunTrust Eminent Scholar Chair at the University of Florida. And I will also note that our community bank discussant is Jim Edwards, CEO of United Bank in Griffin, Georgia. I know Chris will be introducing our presenting authors today. And at this point, Chris, I will turn it over to you.
You have the clicker?
Certainly do.
Thanks. Well, it's my pleasure to be here and to moderate this session. Just by way of background, I think that the session is an important one because it's dealing with an issue that academics, and I know you all have been thinking about for academics for over 40 years, which is what are the real effects of bank failures and stricter bank supervision? And by real effects, I mean not only how it affects the customers of the bank that's failed or more strictly supervised, but also other customers of solvent banks within the local area. So all of these papers address this topic from a slightly different angle. So the first paper is going to be presented by Stephen Luck, who's become an expert in bank failures over the last several years. So take it away.
Thank you so much, Chris. Thank you so much for inviting me. It's a really wonderful event, and I'm very honored to be part of it. So this paper, this presentation is going to be based on a paper that's joint work with Sergio Correa and Emil Werner. Can you see the slides, or is it, are they? There they come. There they come. Very good. Sergio's at the Richmond Fed, I'm at the New York Fed, so our disclaimer applies. These are our views, and not those of the Federal Reserve System. So the starting point of this paper is that the objective of banking supervision is to safeguard the health and the stability of the financial system. So the way we think of it is banking regulations is the rules in which the banks, under which the banks can compete in the marketplace, and supervisors are really all about making sure we're complying with those rules. And we're spending as a society an enormous amount of resources on banking supervision. So the OCC, the FDIC, and the Federal Reserve each alone have thousands of bank examiners. That's not even to count all the state bank regulators. But also banks themselves, of course, spend a lot of real resources in making sure to be compliant with those requirements from examiners. But maybe perhaps because of that, or maybe perhaps surprisingly, banking supervision is an enormously hotly debated topic. And I would say, to simplify things a little bit, there's three reasons how supervision can be hotly debated, or three aspects to which it can be hotly debated. One is that supervisors are often criticized to not rein in risk-taking before bad things happen. So sort of think of the run-up of the GFC and supervision not, cracking down on certain types of lending practices. Second type of criticism is that once something bad has happened, supervisors are maybe too slow to react to kind of clean up the mess, to close failing banks, and by that sort of they contribute to increasing the cost of crises. And on top of that, sort of most recently, we hear again this argument that supervision is really sort of a core constraint on the banking sector's ability to provide credit to the real economy. Now, it's really important to understand to which extent these criticisms are fair and justified, and to which extent they may be sort of a little bit misguided, especially in the light of sort of more recent debates of the current administration thinking about sort of streamlining or consolidating and reforming the regulatory and supervisory landscape. Sort of in the spirit of Andy's comments, research is sort of what we want to sort of guide those kind of efforts, which we all think, if we all agree that there's sort of scope for reform, we kind of want to guide it by evidence. So this is where this paper comes in. We're going to just ask three very simple questions. Okay, question number one is, do supervisors sort of anticipate bank failures before they happen? Are supervisors usually sort of overwhelmed by market forces, as was in the case of the failure of SVB, or do in most failures supervisors really understand long before the failure happened that something is off with an institution? Now, the answer is going to be yes. Supervisors typically understand very well which banks are in trouble and which ones are not. Now, the second question is, if you understand as a supervisor, what bank's in trouble and which one's not, what kind of actions are you undertaking in those relatively more distressed institutions? And then the third question is, what are the causal effects of banking supervision? So what I'm here after is essentially I want to come up with an estimate. If a policymaker came to me and said, what if I make banking supervision stricter or more lenient, what will be the effects on the banking system and maybe the local economy? Okay, so rather than summarizing the results for you in one slide, I'm just going to straight go ahead and answer all those questions one after another. Okay, question number one, do bank supervisors anticipate bank failures? So I'm going to do here for you, I'm going to plot dynamics in sort of about 500 bank failures since 2000 in the 10 years before those failures happened. Okay, so I'm just going to have a sample of these 500 banks. I'm going to look at various ratios constructed out of call reports. Let's look at those first two lines. They're going to show you the evolution of non-performing loans as a share of total loans and loan loss provisions as a share of loans in banks that end up failing. What you see is around 5 years before a bank fails, some non-performing loans start to show up on the asset side of the bank. And as a response to that, the bank starts to provision. Under modern accounting, provisioning is going to affect income, so net income is going to decline. And if you're not recapitalizing, which seems to be the case, equity over assets is going down. So in a failing bank, in the 10 years before it fails, the equity to assets ratio is going to fall by something like 7, 8, 9%, depending on how you exactly construct the sample. At the same time, a bunch of other stuff is going on. Charge-offs are going up, allowances are going up, dividends are going down. Okay. Now, what are supervisors doing at the same time? Now, that's going to be on the right y-axis. You're going to see the average CAMELS rating in those failing banks is going up by quite a bit as those financials start to deteriorate. So your average bank is going to have a CAMELS rating of 1.8 or so. In the 10 years before leading up to failure, that's going to increase by more than 2.5%, which is another way of saying this: right before failure, failing banks tend to have an average CAMELS rating of way above 4.5. Okay, that's just a very simple way of illustrating that supervisors are very well aware of which banks will fail and which ones will not. Now, given that that's the case, at least in the short term, supervisors are very good at anticipating failure. What actions are they taking? I'm going to focus on 4 types of actions. One is scrutiny. How much resources are you dedicating to failing banks? The second one is about auditing. How do supervisors shape financial statements? The third one is enforcement actions. And then the fourth one is just going to be bank closures. Okay? With respect to scrutiny, here's just one simple way of illustrating this. This is just going to plot you the distribution of the days elapsed between 2 consecutive on-site examinations for banks that are on the rotating schedule. So those banks are sort of in good standing, have a Camel's rating of 1 or 2, fulfill a bunch of other conditions. Now, if you're on the rotating schedule, you either have an exam every 12 months or every 18 months. The data just back that up. Once in a while, there'll be a bank that has an exam, more frequently. That's because of mergers and a bunch of other stuff. Now let's look at only failing banks. Well, if you have a failing bank with using sort of the benefit of hindsight, 5 years before it fails, you see this distribution shifts to the left, and examinations tend to happen at a much higher frequency. In fact, in the year before failure, the average time elapsed between 2 exams is just going to be 150 days. So it's basically the supervisor just finished an exam, is just about to turn out and come back to the bank for another exam. Okay? So the paper we show much more, although these exams are also going to be longer. That's going to be more often led by federal examiners. Now, with respect to auditing, I'm going to now argue to you that if you think about the call report and the financial data that banks publish, that's really an actual piece of financial information that's really shaped by supervisors. So how am I going to make that point? Well, I'm just going to plot you here the probability of a historical revision of either net income or equity in a call report around bank on-site examinations. So what that's just telling you, in the month around a bank examination, in the run-up to the examination, the probability of the bank revising its historical call report submission is relatively low, but it jumps up once an exam has concluded. Okay, so that's sort of indicating that supervisors are having a substantial effect on what is actually written in the financial statement. Now, this kind of graph could be subject to the criticism that a banker is just going to understand very well that they're going to have to revise their historical call report, and they're just going to do it when the exam happens and all kinds of paperwork happens. One way to address that is, well, let's just look at exams led by state bank regulators and by federal agencies. Now, it's well established that given the exact same financial information, state bank examiners are just going to be a little bit more lenient than federal examiners. That's just due to the different incentive structures that we're facing in the dual banking system. Now that's going to tell you sort of something causal about what supervisors are doing. In the run-up to the exam, there's no difference between the state and the federal supervisor. But right after the exam led by a federal supervisor is going to have a much higher propensity of a revision of the originally submitted call report. Now, you may wonder, well, what about these revisions? Are they actually material? So one way to look at this is let's just plot again in the 5 years before a bank fails, the equity to assets ratio in the original first submitted call report, and then in the final call report as of 2024. Okay, what you see is the original submission of the equity to assets ratio always is slightly above what is the finalized equity to assets ratio in those failing banks. Now what I can do is I can accumulate these revision errors over time, over the 5 years before failure. If you do that, it gives you these green dots. So what that's just telling you is that in the 5 years before failure, the equity to assets ratio is going to decline by something like 8%, 8 to 9%. But basically half of that decline comes from revisions of the original call report. So if you wanted to make the most extreme, let's say you can causally attribute all call report revisions to supervisory actions, which is definitely problematic, but it's an upper bound. It's going to tell you that supervisors are really what pushes banks to look undercapitalized before they fail. Now, capitalization is important because it triggers enforcement action. Enforcement action doesn't happen randomly, but it's usually based on capitalization. So here I'm just showing you some simple descriptics banks that haven't failed over the last 25 years are much less likely to be subjected to enforcement actions. That's going to be enforcement actions only from federal agencies, so FDIC, OCC, and Federal Reserve. Now, you have about a 35% chance of having any type of enforcement actions if you're still in business right now and have existed over the last sometime over the last 25 years. 80% of banks that ended up failing over that time period had some type of enforcement action. And there's really big differences when you think about the most sort of drastic types of enforcement actions, such as PCA. That almost never happens in a bank that doesn't end up failing. And in 25% of all the banks that ended up failing over that time period, it happened. Various reasons why it's not more banks that are subject to PCA. Happy to discuss that later. Now, my final point on sort of giving you some simple descriptive statistics is just to plot you the distributions of the days of failures of banks for both historical national banks, so that's national banks that failed sometime between the Civil War and the Great Depression, and then banks that failed since 1992 in the United States. So the blue dots are just showing you that in the historical US banking system, banks essentially failed on any random day. They didn't fail on Sundays, well, because they were closed. They're a little less likely to fail on a Saturday. That's in part because Saturday is just half a business day and people are going to take a bath or going to the pub or something. But they really just kind of randomly failed throughout the day. That's because historically when banks failed, that was a decision made by depositors voting with their feet that they were not happy with the bank anymore, or the owners themselves trying to protect their whatever remained of their equity in closing the bank. Very different in the contemporary banking system, where it's really a supervisory decision when a bank is closed. As you all are well aware of, typically the FDIC prefers to close a bank at the end of business on a Friday, will rewire the IT system and open that failed bank as a branch of the acquiring bank on the next Monday. But it's really making the point that supervisors are hardly ever sort of overwhelmed, at least in an immediate sense, by market forces, but they are actually the ones who decide which banks will fail and which one will not. That doesn't mean failures are not costly. In the paper we discuss this, and you may all be well aware of, there can be substantial costs for the deposit insurance fund. Now, everything I've said so far is purely descriptive. What we're really interested in is sort of trying to say something causal. So that if you came to me and asked, what if I made supervision more lenient or I made it more strict, what would happen? Now, how we go about answering that? Well, the identification challenging of any observational data is that supervisory strictness and sort of bank conditions are endogenous. So supervisors are sort of drawn to the more troubled banks. So what I'm going to do is I'm going to essentially, again, exploit this difference between state and federal examiners. The fact that state examiners are a little more lenient, same financial information, they're going to be more lenient. And I'm going to exploit the rotating schedule at the onset of the financial crisis. And the basic idea is that right before Lehman fails, there's some banks that are scheduled to have a federal-led exam, and some are scheduled to have a state-led exam. And if that's arguably random, so that's some arguably random variation that's got nothing to do with what's going on in the financial crisis, because all those banks have a good Kammel's rating, they're in good standing. But it's relevant in the sense that if you're getting a federal exam early on, you're more likely at the same financial information getting rated with a 3 or 4 or 5. So you're more likely to end up on a list of troubled banks, which is then going to trigger automatically additional supervisory scrutiny. And what then helps is that during the GFC, the supervisors essentially became overwhelmed. They become resource constrained, which meant that essentially they couldn't go out and look for new problems, but focus on the banks already in trouble. So the idea here is essentially if you have 3 fires in a city and you have 3 fire engines, well, you're going to send those engines to those 3 fires. You're not going to look for new problems. So it's showing you how this works. Now, essentially, this graph is just plotting you the average Kammel's rating for both banks that have a federal exam, a federal-led exam in the phase right after Lehman, and those that have a state-led exam in the phase right after Lehman, these 2 vertical lines. What you see is if you had a federal exam early on, your Kammel's rating is going to increase very, very fast on average, and then essentially remain much above the orange line for most of the GFC. You also see that after about 1.5 years, the banks that had a state-led exam right after the failure of Lehman Brothers, they catch up, but they don't catch up all the way, which comes from this sort of path dependence that I was talking about. Now, in the paper, we discussed this in much more detail, but essentially this is going to set the stage for 2 main results. The first result is that if you have more supervisory strictness in an exogenous sense, you're going to be more likely to fail. So stricter supervisors, because bank failures are supervisory decisions, are going to close more banks. So in my sample, the probability of a bank failing is 3.5%. The difference between a bank that gets more supervisory scrutiny and that gets less is 3.2%. So that's massive. It just emphasizes how important supervisors are. What you're getting if you're getting a stricter supervisor, you're going to get lower losses for the deposit insurance fund. So on average, the FDIC loses 22 cents on the dollar in a failure. It's going to be a 9-cent difference if you had a stricter supervisor. And this for various reasons. One is essentially that stricter supervisors just close banks much faster, so there's less potential for things to go bad. But, and here's a big but, it comes at a cost. This does not come for free. You also find that if you have stricter supervisors, in the immediate phase after the crisis, you have much lower credit growth. So in some sense, you want to think of stricter supervisors as marking everything to market, tightening capital constraint, cleaning up the mess immediately. But that's not necessarily desirable because you're really going to see a big reduction in credit right away. So I'm out of time, but what I want to emphasize that there's this policy trade-off. So I'm just going to conclude a key role of banking supervision that you shall not forget if you're thinking about reform of the supervisory landscape is to avoid kicking the can down the road. And then there's this trade-off that you have. Stricter supervision is at the margin going to close more banks. You're going to have less losses from those failures, but you also potentially are going to have less credit available right at the height of a crisis when it's potentially very valuable. There's no welfare statements that I can be making here. It's more I'm telling you as a policymaker, if you're a policymaker, this is a choice you have, and you want to carefully think about these trade-offs. Sorry for going over time.
No worries. Thank you, Seth. Our second presenter is Brian Lee from Emory, who's going to talk about when bank fail, depositor attention, and the cost of funding of survivors.
Thank you so much. My name is Brian Lee. I'm a finance professor at Emory University Louisiana Business School. And this is joint work with my friend Stephen Wallace, who's a finance professor at Boston College. First of all, I just want to say thank you so much for having our paper on this wonderful program. This is a spectacular venue and a very, very nice event. We're just really pleased to be part of this and contribute to this wonderful program. Okay, so without further ado, I want to get started. This for next slide, yes? Okay, so many research papers that have to do with banking crisis, bank runs and bank failures, they like to reference the movie It's a Wonderful Life, okay? Which is a great movie, it's a classic, I really like the movie, but I'm gonna be slightly alternative and reference a different movie from that classics genre. This is a scene from Mary Poppins. If the scene was vaguely familiar to you, that's where it's from, okay? For two reasons. The first reason is that it's just a much better movie musically speaking, so I appreciate that. The second and more important reason, in the film there is a very clear and established notion of a local competition of the bank. Specifically, I'm referring to The Woman Who Feeds Birds. Okay, so if you forgot the plot of the movie, this part of the movie a little bit, the whole bank run crisis episode is starting in the movie because the children don't want to keep the money in the bank. Instead, they want to walk out of the bank and give the money to the woman feeding the birds. Okay? So this analogy doesn't make any sense to you if you don't know the movie. So here is a slide that is going to capture the description of our paper, what we do, in a movie reference independent way of describing the paper. Okay, so I'll begin with the big picture motivation. I want to say two things on the motivational note here. The first thing, it doesn't really require an explicit statement to this particular audience that bank failures are very costly, very significant economic events. I think everybody's on board with that statement. The second thing I want to say here is that depositors play a very crucial role in this mechanism, in this context, but they're a very difficult subject to study. There's a whole body of research saying depositors are very sleepy, they never really pay attention to deposit rates, etc. But also at the same time, these same depositors play a really important role in initiating banking crises as well. So that brings us to the particular research question in our paper, which is how do bank failures affect deposits in the local competitor banks, okay? And this is a short format presentation, so I'll just highlight the findings and summarize them right away here in the second slide. What we find in the paper, first, deposit rates of competitor banks rise significantly after their competition fails, okay? Now, is this just the deposit rates, or does it have material impact on the lending side? We find that it indeed does. What we find is the lending growth falls And also, more importantly, the fact that this is a deposit rate story to sort of illustrate that. What we show is that the non-bank lending in that same local economy is not affected only by banks. Okay? And then we do heterogeneity tests to understand the mechanism behind this finding. What we do is that we find the similar effect going on for banks that have higher leverage, okay? So the ones that perhaps that the depositor might be perceiving as more risky. And also, interestingly, that insured versus uninsured deposit product rates effects are also the same, which is kind of puzzling, a head scratcher. If something is perceived to be more risky, perhaps this is precisely the reason why depositors are going to require sort of higher compensation. So what might be going on? Well, I'm going to show you that the one cross-section that really pops out in our data, that's something that seems to be really explaining this result, is coming from public attention. In other words, what we find is a much stronger effect of this deposit rate finding for bank failure episodes that are receiving higher public attention. Okay? So let me just set the scene with some very overall aggregated trends and data first. Okay? So the first picture that I want to show you is plotting deposit rates and federal funds rate, and also the share of the deposit that belonged to one of the failed banks in the throughout the last 20 years or so. Okay? What we're really going to, of course, bank failures, this is not like a public company doing earnings announcement. It doesn't really happen on a regular basis. It only happens in big crisis periods. So our focus is going to be on this GFC, the 2008 crisis. What we show, what we find, just to set the scene, is that the federal funds rate, of course, goes to zero very, very quickly. Are deposit rates sort of keeping up to go down, or is it kind of more hesitant to go down with the federal funds rate? That's the blue and the red over there. And importantly, what's going on over here, sort of in the backdrop, is that a lot of deposits are associated with one of the failed banks over here. Okay. And the second thing I want to show you is then, in this paper, geography matters. So I want to give you a little bit of an idea of to what extent we're seeing bank failures happening across the United States. So in our sample period, what we're seeing is here are all the counties that are colored blue that have reported a bank failure during our sample period. The white means they've never had it during our sample period. Two things that I want to highlight here. The first thing is that bank failures occur kind of broadly across regions. This is not just the East Coast phenomena or the South phenomena. It's sort of West Coast. It's kind of everywhere across the United States is represented in our sample. And the second thing I want to say is, well, this seems to be visible enough event, okay, during our sample period, meaning quite a few counties are represented here. However, it's also not so pervasive. So it's big enough so that we can kind of think of this as an event that's not so rare that we should, we'll see this, we care about this, but at the same time, this is also not so pervasive. We also have the sense of somewhere in the middle in that spectrum. And the third thing I want to say is just generally this notion of public attention around bank failures. Okay, so this is a very simple plot showing you Google search volume about the bank that's having this a failure episode around this failure date, and just a very straightforward picture to show you that people are hearing about this and searching about this bank when this is going on. Several things, of course, are kind of naturally that's related to the generation of the attention. Is going to be the media coverage and the FDIC, which is involved in sort of the public outreach, getting the word out that there is a bank that's closing, and if you have uninsured deposit, this is a number you call it, etc. Okay. So just to set the scene, and I want to go to the findings of the paper. Okay, so without going into the weeds too much and talk about the technical details, so what are we after? In a nutshell, we're trying to estimate the effect of bank failures on same county neighbor banks' deposit rates. Okay. Now, of course, that county might be very different from, fundamentally from other counties that don't have a competitor bank that's failing. So what we're doing in the specification, you control for county level economic conditions, all these variables that are usual suspects. And as importantly as well, what we're going to do is have bank year time fixed effects, meaning we're going to control for anything that is going on at the total bank level. Now, to give you just a quick intuition in terms of plain English, so imagine a bank X has branches in counties A, B, C, different places, okay, and county C is going to have a neighbor bank that fails. Okay, so we're going to track the change in the deposit rates of County C branch, but also use what's going on with the branches in counties A and B and tracking that changes over there and using that as a benchmark to estimate the effect. Okay, so the data that we use for this project is a pretty standard sources along the lines of FDIC, the CRA, HMDA data for lending, call reports, the BLS for local economic controls, and then deposit rate information from RateWatch. Okay, so this is our paper's main finding in one figure. Okay, so on the X, what we're showing is the years since bank failure, the local competition having a bank failure episode, and then on the Y is going to be the effect of that event on deposit rates on 100,000 CD. Okay. And the confidence interval to indicate statistical significance. So the story is very simple. The effect on deposit rates is immediate, going up around 4 to 5 basis points. And this is also persistent. It persists for up to 3 years that we see. Okay? So that's one figure to summarize the key main finding of the paper. Now, of course, you can ask a lot of follow-up questions here. The first kind of natural thing to ask is how is this effect robust? Okay, so this is, I'll defer to the paper, but the finding, that number, the main estimate is going to be robust to various different ways to think about alternative measures and different specifications. And then that deposit rate, what's the implication of that onto other things, like I sort of previewed in the second slide. It does have material impact on the other parts as well. First is going to be deposit volume. So despite the rate being higher, what we find is that the deposit, there's a deposit outflow. So the volume growth is going down by something like 4.5%. And then the next result that we share in the paper is on small business lending. Because rate going up, this means cost of funding is higher. This then is something that's reflected on the lending side of the bank activity. Small business lending declines by 2%. Okay. Then some more natural follow-up questions that I want to share, just in bullet point style. So the first question is the lending effect driven by local demand for loans? Okay, county is experiencing a bad event. It just means the people who would be taking out loans, there's less demand coming from that side. Well, what we do, one analysis that we do is we look at the mortgage lending going on in the local economy by banks versus non-banks. Okay, so the banks are the ones that rely on deposits for their funding. Non-banks don't. What we find is that for non-banks, they're doing just fine. Okay? In fact, a lot of borrowers are substituting away from banks to go to non-banks. So this kind of makes us think that it's not entirely driven by demand. It's a supply side story as well. The second question is the main effect driven by neighbor banks who are in distress? Okay, so your neighbor had a bank failure episode. Does this mean you're experiencing distress, and that's why your depositors are now demanding more in terms of deposit rates? The main effect is driven actually by well-capitalized banks. So you can cut the local neighbor sample by those that are well-capitalized versus poorly capitalized. But this rate going up, this is happening for everybody, mainly actually by the well-capitalized banks. And then also there's no evidence of bank failure contagion, at least in the specification that we have. Okay? And then similar a sort of thought experiment along those lines is the main effect due to panic-induced bank runs. Well, if this was the main thing driving the story, then we would really expect a much bigger effect for uninsured deposits, but that's not what we find in our case. And the last thing is the main effect, stronger for certain bank failures. Is something special to categorize a bank failure that's really driving our main finding. And as I said in the second slide that previews our findings, what we find is that this main effect is primarily driven by highly publicized bank failures using Google search volume. Okay. So at this point, the short presentation format, I don't want to go into the weeds too much, so I can just give you a summary of our paper and then wrap up. So the first thing I wanted to say, bank failures, of course, generate significantly costly spillovers to the neighbors. Okay. The higher deposit rates for neighboring competitor banks who observably in the data seem just well-capitalized, healthy, and all these good things, but they have to raise these rates, meaning their cost of funding has gone up. And this has material impact for the lending side. So the results that I shared with you today are on small business and mortgages, a very standard way to sort of think about that question. And then we argue that this is surprisingly not driven by risk compensation from depositors, but rather it seems like these depositors, their attention about rates perhaps is more heightened, and it's just a uniform increase in the rate sensitivity that's driving and explaining the main finding. Okay? So
thank you.
That's good. Okay.
The next paper is being presented by Yannick Schindler, and it's on bad banks, bad luck, evidence from 1 million firm bank relationships.
Thank you very much to the organizers for having me. It's a pleasure and privilege to be here today, and it's a wonderful conference so far. This is joint work with my colleague and friend Peter Lambert at Warwick and the London School of Economics. And what we try to do in this paper is we study the effects that bank failures have on firm-level outcomes, with a particular focus on the very smallest businesses in the economy. Now, I think with the present audience, I probably don't have to motivate this topic all too much. Suffice it to say, clicker, there we go, sorry. That bank failures are not like a vanishingly rare event in the US, unfortunately. There have been about 3,000 bank failures since 1980. Unfortunately, again, they disproportionately affect smaller regional community banks, but of course we sometimes also get these really large, high-profile bank failures, as was the case 2 years ago with Silicon Valley Bank and First Republic. So this is just a timeline of when these bank failures happen, where the size of the bar is the size of the bank measured by assets. Now, these events do draw a lot of media attention, as we just found out. And yet I was surprised to find that actually, when you go to the literature, we know surprisingly little about how these events affect the very smallest business in the economy. And that's particularly concerning because we know that small businesses are very reliant on bank lending for getting credit, so they can't issue bonds, they can't go to equity markets. They could, of course, rely on things like credit cards, but they really do rely on banks for getting credit. And furthermore, they tend to really only have one relationship with a bank. They don't really diversify their relationship portfolio when it comes to banks. And so they seem particularly exposed to their lender failing. The reason for why this particular question has been difficult today to study is because in the US there has traditionally been, it's been very difficult to have very comprehensive and large-scale data on the business bank relationships for these very small businesses. So of course there are some data sets that tell us who banks with whom, so you could go to like syndicated loan data, there's some supervisory data, but when you use these data, you're generally looking at firms that have at least a couple dozen, if not hundreds or so employees. Just to give you a notion for the size of firm that we study in this paper, the median firm size here is 3 employees. So there's a really very small microenterprise. What I want you to have in mind is like, I don't know, a mechanic or a laundromat, a very small restaurant. We overcome this data challenge by collecting 36 million loan documents that span about 2 decades, so from 2000 to present day. We use these loan documents to build a data set of 1.5 million unique businesses linked to 4,000 unique banks. The firm level information about these firms is going to come from a commercial data provider called Dun & Bradstreet, and the bank level financial information we get either from call reports or, again, a commercial data provider called Orbis. Now, we bring in some other data as well. So we've recently been working on getting branch level information in. So for example, around each of the 1.5 million businesses that we have, we draw a 10-mile radius and then bring in all of the branch locations of branches that are nearby to these businesses. And so, of course, we have this really rich data set now to study many questions related to small business lending. But the first thing that we set out to study was how bank failure affects the performance of these firms. In particular, we look at 3 dimensions: firm survival, employment, and revenues. And we can exploit over 200 different bank failures that are covered by our data set to do so. Just to give you a preview of the results, small firms who bank with banks that fail are significantly more likely to cease operating in the years after the bank failure relative to peer firms who are very similar. Those firms who survive after the bank failure or after being exposed to bank failure also show significantly lower employment growth and lower revenue growth. And we also document that there's very large variation in the harms of bank failure to small businesses across the different bank failure events that we study. So some bank failures have historically been much more harmful to small business borrowers than others, with a very small fraction of bank failures actually showing in our data to have had a positive effect. Now, of course, I think generally when I present this, I have to pause here a bit. I think the present audience is probably more familiar with how bank failure operates than other audiences. But I want to stop here and to just say, like, ex ante, these results weren't, I wasn't sure what to expect when we started this research program. Because, of course, a bank failure isn't the kind of situation where you show up on a Monday and then the bank is closed and it just says, you know, I don't know, good luck, we don't know what will happen with your deposits, and have fun. Yeah, we don't know what will happen with your loan, and yeah, bank is closed now, but rather it's a highly regulated event, right? As Stefan showed us, there's going to be basically a press release that goes out Friday night after markets have closed at the end of the business day that says, Bank XYZ unfortunately has closed. Of course, deposits are insured. Oh, and by the way, we've already been working behind the scenes to find an acquirer of this struggling bank. So don't worry, online banking will continue to work. Checks will continue to clear, and on Monday you can still go see Bob or whoever it was who was the loan officer who handles your business account or your business credit line. And so against that backdrop, it's not even clear that going through that sort of regulatory event as a small business borrower would be bad for you. I mean, if anything, it could be a good thing. By definition, you're basically having your relationship moved from a struggling bank or a poorly capitalized bank to a well-capitalized bank. But the results show that, yeah, these bank failure events are quite detrimental to these small business borrowers. Now, because these results are based on very new data, I just want to spend a couple minutes talking about how we put this together. The 36 million loan documents that we collected are called UCC financing statements. Here's just one example. This is a UCC financing statement for a very small coffee shop in LA. The key thing to note here is that these documents get filed with the Secretary of State offices in each state. Importantly, they tell us the name and address of the business that is taking a secured type of credit, either a credit line or a secured loan from a bank, and it tells us who the bank is that is providing this loan. Now, banks like filing these whenever they extend secured credit to a business because it's a public record. It prevents that business from then going to the next bank and saying, oh, by the way, I'd like to take my business assets and get another secured credit line, so it prevents recollateralization. And it also gives lenders a bit of recourse in the event of non-payment to have this piece of document to say, well, you haven't paid, so we can now claim against your business assets. In terms of geographic coverage, we obtained these documents from 6 different Secretary of State. So these California, Colorado, Texas, Illinois, Florida, and the state of New York. But because very often someone will file in a particular state for a business that operates in another state, we do have coverage for virtually all counties within the United States. Now, once we've put together our data set, I'll spare you the detailed econometrics. But what we're doing is we're looking at firms whose bank we know fails and comparing their outcomes in terms of firm survival, firm employment, and firm revenues going forward for 10 years, and comparing those to firms whose bank did not fail, controlling for a lot of both bank and firm covariates. So what I want you to have in your mind is that we're basically comparing 2 firms that are of the same age, the same size, operating in the same location, operating in the same industry, banking with a bank of a similar size in a given year. One of these firms is going to go through a bank failure, is going to experience their bank failing, the other not, and then we trace out the differential trajectory of these 2 firms going forward. The results of that exercise are here. The way to read this is that on the x-axis, I have event time relative to the bank failure event. On the y-axis is the effect size in percentage points. So the way to read it is if you look at sort of event time 5, that's saying that after 5 years after the bank failure, a business or small business that had a relationship with this bank at the time of failure is about 7 percentage points less likely to still be operating relative to very similar firms that did not experience this bank failure. We can also go and do this analysis going backwards, so prior to the bank failure, just to convince ourselves that this differential evolution in the survival rates of these firms, or the picture looks exactly the same if I do employment or revenues, but to convince ourselves that these effects really start at the point in time of the bank failure, not before. We can also take the event time backwards, and we see that when we look prior to the bank failure, we don't yet see any of this divergent survival rates, employment growth, or revenue growth, convincing us that yes, most likely this can be attributed to the bank failure event itself. I also want to point out that there's this persistence, right? So with survival, it's a bit weird to think about because obviously once the business has died, it can't come back. But for example, if we think about revenues or employment, it's not that upon bank failure exposure, so my bank fails, I just sort of slow down hiring or I slow revenue growth while I get a new bank relationship, and then once I'm banking with a new bank, I have this catch-up growth. No, this picture would look the same with employment and revenue, in that the bank failure event seems to have these long-term scarring effects on the firm's viability even going forward, and are statistically still being detected a decade after the bank failure event. Now you may still be worried, okay, but maybe like right in the lead up to the bank failure, the bank is sort of throwing Hail Marys and just trying to lend to everyone, and so all that this analysis is picking up is that right before the bank failure happens, that bank is really basically taking loads of lending risks, and so you're just seeing selection effectively, that this bank that is about to fail is extending credit to just much worse firms than would otherwise be the case. To address that particular concern, we leverage a particularly interesting case that happened during the financial crisis, where the FDIC was forced to close a bank that was relatively well capitalized. So going into the financial crisis, there existed a bank holding group called FBOP. There were 9 banks that belonged to this bank holding group. They were operating predominantly in California and Arizona, so sort of the US Southwest. The largest of those were operating in California. They were Pacific National, San Diego National, and California National. And this picture that I'm showing you here shows the trajectory of these banks as they're going into the financial crisis in terms of their capitalization ratio. And you can see that, for example, California National went from being well capitalized to basically having 0 equity left, or having a capital ratio of 0. Similar very steep declines for both Pacific and San Diego, so that by September 2009, the FDIC is saying we need to close those banks. They've become non-viable, and we're going to make use of a very unique power that the FDIC has, which is called the cross-guarantee power, which allows it to make other banks in the same bank holding group responsible for the losses that failed banks are causing to the FDIC insurance fund. Now, very unfortunately for Park National, which was a very small bank, around 120 million in assets, which is operating a couple of branches in Illinois, it belonged to this bank holding group, was effectively delivered probably one Friday evening, or maybe they waited until the weekend, basically a demand for payment, more or less, from the FDIC to cover its sister banks that had failed, and immediately became insolvent because, of course, it was swamped by this liability, and the FDIC closed that bank. So in that case, we can argue that at least for Park National, the closure of that bank, which at that point was still adequately capitalized, at least according to this taxonomy of capital ratios, was arguably a bit more exogenous than just any old bank failure. And when we run our analysis just doing Park National, we still get that this had an effect on small business borrowers. I want to also highlight that the effects of bank failure on small business are really concentrated amongst the very smallest businesses out there. This is plotting the effect averaged across 5 years post-bank failure for different firm size categories. Again, on the y-axis, you have the size effect in percentage points on firm survival. And we note that even when you have businesses that have 6 or more employees, the effect is basically nil. But that for very small businesses that only have 1 or 2 or 3 employees, the effect is really quite large. And again, this highlights that if you were to look at some of these existing data sets where you have businesses with many dozens of employees, you would have never seen this particular effect because it really is concentrated among the very most vulnerable and smallest businesses out there. The last thing I want to say as I wrap up is that when we do our analysis for each individual bank failure individually, and there's no need to sort of turn your head and try to read the x-axis here. The point is really the picture that shows you, sorted by size of effect, the effect of that particular bank failure on small business survival, that there's really a lot of dispersion there. Some bank failures really were much more harmful to the small business borrowers than others, and on the right-hand side, we do pick up a couple of bank failures where it did appear to be a good thing for those business borrowers that their struggling bank was acquired by a better capitalized bank as forced by the FDIC. We've thrown quite a lot of things at this trying to explain this gradient in effect size, because obviously the burning question now is, well, tell us what makes a bank failure be in the far left and what makes a bank failure be in the far right so that we can get more from the far right. And that's currently work in progress, so stay tuned. Just as I conclude, if there's one thing you should be taking away is that, these bank failures, even though on paper they really do look quite frictionless, the FDIC does a great job of finding acquirers for struggling banks, and the process is relatively frictionless for these small business borrowers whose bank fails. There do seem to be these really detrimental effects to the very smallest businesses that experience this. The effects are substantial, long-lasting, and there's large variation across banks. It's new data. I'm very excited about it. I'm going to just shamelessly plug the work a bit more. If you have any research ideas or you find this data interesting, please find me or reach out. I'd love to do much more work with these data, because now I've invested the fixed cost and poured my sweat and tears into this. So do find me if you have ideas with what sort of things you wish to have studied with these data. Thank you very much.
Thank you. Thank you, Yannick.
Jim is going to give us a perspective from a community banker who's been in markets in which banks have failed.
Well, good afternoon. It's really an honor to be here with you today. This is the first time that I've been to this conference, and I've really enjoyed the presentations this morning. And all of them have had slides and pictures. And I don't want all of you to think I just didn't do my homework. But as I thought about this presentation, I wasn't really sure that a picture of this topic of failing banks made a whole lot of sense. So I'm going to skip that today and just talk to you. And before I get started today, I want to thank our new Georgia Banking Commissioner, Bo Fears, who's with us, for encouraging me to do this, and Melissa Sneed, Senior Assistant Deputy Commissioner, and for being here. I know many of you know them, but we're just, all of the state banks in Georgia are excited about where we're headed under Bo's leadership here, and I appreciate him being here today. But being a state chartered bank, we have the privilege and the pleasure of also being regulated by the FDIC. And we have a holding company, so we get to see our friends from the Fed occasionally as well. So I will tell you, though, that it's nice to see all of you outside of a exam exit meeting. It's a different experience for me just a little bit. But to follow on a little bit with Director Felton's comments here, which I enjoyed hearing just a minute ago, flying up here yesterday from Atlanta, it occurred to me that I've been really fortunate to stay connected with my undergraduate university, Emory University, as well as University of Virginia, where I got my MBA, and to have connections with some of those professors and to talk with them about banking issues occasionally. And obviously, in my 30-plus years as a banker, I have had ample opportunity to talk with regulators. This is the first time that I've ever had the opportunity to talk with both groups as well as community bankers in the same room here. And you know, as the FDIC director said, I think this is really very unique, and I think it's important, and I think it's a valuable thing to do. Because in my view, regulators, academics, researchers, and community bankers represent sort of a three-legged stool, as I was thinking about it yesterday coming up. Each of us brings a critical perspective to the shared goal of building resilient, safe, and sound financial systems. And that continues, and all those systems that continue to be able to meet the financial needs of the communities that we really want to serve there. And so I think it's important that we're talking, and I think it's important that we're having this conversation. Let me give you, to give you a little context, let me talk to you just for a minute about who I am and who our bank is. United Bank's a $2.2 billion asset community bank. We serve 10 contiguous central Georgia counties. These are a mix of suburban and more often rural communities, all within about a 90-minute drive, either southeast or west of Atlanta. Now, we're a true community bank offering a full range of consumer, commercial, mortgage, and government guaranteed loan programs, along with retirement and financial planning services through our wealth management and trust division. And we're also really proud to be one of the largest employee-owned banks in the United States. Through our employee stock ownership plan, or ESOP, our employees own over 1/3 of the company now. And that ownership culture means that our team doesn't just come to work at United Bank, they come to work for it. And culturally, we think that really makes us different from a lot of our competitors out there. Our story goes back to the beginning of the bank in 1905, so we're quite an old institution. My grandfather joined the bank about 20 plus years after that, just a couple of years before the Great Depression started. And he commented to me several times his timing could have been a little bit better to pick a time to become a banker, I guess. But you know, they say that hard times and challenging times make good bankers, and I think that occurred with him. And I'm proud today to be part of the third generation of our family to lead the company. Now, the papers discussing that we're talking about today, they're all related to bank failures, obviously, and that is a little daunting to be sitting in front of this many regulators and talking about bank failure, I have to admit. But our company did have a front row seat to the impact that bank failures can have on a community, and particularly small and rural ones in Georgia during what we now call the Great Recession, or sometimes it's referred to as the global financial crisis. Because during that time, our bank acquired the assets of 4 different failed banks from the FDIC. The first 1, 2, 3 in very rapid order, and then the last one right at the tail end of the Great Recession. Now, let me take you back for a minute and just remind you that Georgia's banking system was hit especially hard. If you saw that map up here that Dr. Lee had, there was a lot of blue over central Georgia there. And the reality of it is we lost 25% of our bank charters before the storm passed. I mean, think about that. 1 out of every 4 banks in our state failed during that great crisis there. So it was really a phenomenal time, and you know what caused it. There are lots of things that we could talk about that caused it. But to be very brief, Atlanta and Metro Atlanta had grown incredibly rapidly for quite some time, with not a lot of slowdown. That brings job growth. Job growth brings housing growth. Housing need means lots of development. And when it stopped very, very quickly there. Now, it wouldn't be true for me to stand up here and say that our bank was not affected during this challenging time also. But I think we fared better than some other banks, really for just a couple of primary reasons. And one of those is that, you know, as a closely held institution, we had our board had always focused on maintaining a high level of capital and liquidity. And I think we did a good job of not getting too concentrated in any one lending area. And secondly, and this is the honest truth, is that when the Atlanta real estate market imploded in 2008, we were just a little farther away from the blast zone than some of our peer banks. Today, though, I'm proud to say that all of the institutions that we acquired through this challenging time have become vibrant, productive parts of not just our bank, but also the communities that they serve. Now let's turn and let me give you a few reflections from myself, as well as our senior management team on the academic researchers' research here. I wanted to share this with my senior team because I wanted to have a little bit broader view than just mine. On Dr. Luck's paper, which was on supervising failed banks, it did really resonate with our group. We agreed that with the paper's conclusions that examiners generally do a good job of identifying banks at risk and ensuring problem assets are properly valued. One of the things I've always valued about regulators and examiners is that they have a wider lens than just we do in our bank. And so I've as a practice, have never finished up an exam and not had a conversation. Tell me what else you're seeing around the state and around the region that we need to be careful of. With all that said, I would gently remind our regulators here that it's important, I think, to avoid a purely check-the-box approach and assuming that just because one asset class is troubled in one area of the state or region, that automatically means that it's a problem asset in every one of the banks. And I think it also brings we heard this morning from one of the earlier speakers that bank exams, they're not math problems. And I agree with that. I think it's a great phrase because it is so important that interaction that examiners have with the senior management of banks to understand what's really going on in that portfolio. And so I encourage you to remember that and to keep that in front of everybody. The paper also found that federal regulators sometimes act more quickly than state regulators when closing troubled institutions. And while that may have appeared true during Georgia's toughest years, I think we use the analogy here of you got so many fire trucks and how many fires do you have? And that's a great analogy as well, and I would certainly agree with that. Because we didn't find really that from a big picture standpoint. We found the collaboration between the FDIC and our State Department of Banking to be very good, and from an organizational standpoint, we really believe in the dual banking system, and we think it produces better outcomes than a single national regulator could. Now, Dr. Lee's paper focused on depositor retention and the cost of funding for surviving banks. It raised several points that hit close to home for us. It's certainly true that in times of financial stress, banks' instincts to raise liquidity quickly, often by increasing deposit rates, and that's the focus and the goal oftentimes. As the paper points out, and as we experienced firsthand in the first bank failure that we were involved with, liquidity, not capital, can kill a bank very quickly, sometimes much quicker than capital issues. That said, during the downturn, from a big picture standpoint, and again, we're the acquiring banks, we're not the bank next door, we're the acquiring banks, so slightly different from what his paper focused on. Our bank didn't face significant deposit pricing pressure. We were already known as a stable, well-capitalized institution in those adjacent markets, and I maybe should have pointed out that all of our bank acquisitions were in adjoining markets, so we weren't moonshotting to another state to buy a failed institution. And also, it was such a challenging time then that there frankly was very little loan demand. So we did not have a lot of incentive to chase deposits during the height of the recession there. And further, our bank was fortunate just in that we have always maintained a very high level of non-interest bearing consumer deposits and small business customer deposits with less than 10% of our deposits in CDs. So we had probably more liquidity than a lot of banks, a lot of peer banks as we headed into the recession there in 2008 and 9. Now, having said that, I will say that the world has changed a lot since 2008. We talked about the impact of technology today, and today community banks like ours, don't just compete for deposits with the bank across the street, which was what occurred back when I started my career a lot more. Today we're competing with banks across the country for deposits. So in this next downturn, the liquidity issue may look very different. And obviously, with the SVB failure, there was a lot of liquidity pressure there, and the rates did go up. Finally, with Dr. Schindler's paper, Bad Bank, Bad Luck, it examined how customers were affected after their bank failed. Now, we've always believed very, very strongly that a community bank's greatest asset is not its loans or its deposits on its balance sheet, but it's its employees and it's their relationships they build with their customers over time. So when a bank fails, those relationships can absolutely be severed. And, think about that. It's not that the banker you go to see, sometimes the banker may still be there on Monday morning after the bank fails, but he's got a new boss, okay? Maybe in a totally different position. They may have a totally different business model than the bank that failed with. So that lends a lot of credence to what the paper was saying there, I think. From our perspective, we tried to take a different approach. Again, we were in adjoining markets already, but we tried to take a different approach. And yes, we had to resolve a lot of problem loans. That just happens when you take over a failed bank and get those situations and are working under a loss share relationship. But we tried very hard to maintain those relationships with those customers, because that's where the long-term opportunities were from us having acquiring these banks. And I'm really pleased to say today that some of the best customers that we have in our entire bank were from customers that came to us through those loss share failed bank situations there. And I think that's really important, because we've said this in different ways today, and in listening to some of the earlier videos, I've heard this also from prior years of this conference here. 2/3 of all job creation comes from the growth of small businesses. And who is the primary provider of capital to those small businesses? Well, we all know it's community banks. And that's why I think the institution of community banks and community banks across this country are so critical as we look forward and we think about the opportunities that we've got in front of this here. So bottom line, we agree with almost all the majority of those findings, and it was a good paper. In closing though, this conference, which is bringing together researchers, regulators, bankers, I think it couldn't come at a better time, folks. With the exception of a few regional bank failures, which we mentioned here just a few minutes ago, we've just lived through a decade plus with relatively few bank failures. And I think that gives us a moment of calm to reflect, to study, and to figure out maybe what we could do better next time as we approach these challenges, because there's always another recession that's coming. You just don't know when. And I don't say that from a negative standpoint, but if you're a banker, you've got to think that way. So again, let me thank the Federal Reserve Bank of St. Louis here, the CSBS, the FDIC, for continuing to sponsor what I think is a really, really important event. And I've appreciated being part of it today, and I look forward to your questions. Thank you.
Thank you, Jim. Well, my task is to try to bring everything together, and I thought the way to do it would be to start thinking about what the real effects of bank failures are, because all of these papers are trying to address that issue. And over the last 40 years, I think Ben Bernanke's dissertation was on bank failures in the Great Depression and what economic effects they had. Economists have been struggling with the following. We know that bank failures are associated with economic downturns. They're clustered in economic downturns. The question that economists have to ask is, do they add to those downturns? In other words, do they cause further economic damage, or are they just associated with an economic downturn? It's a critical public policy issue. Because if it's just associated with an economic downturn, then we don't have to think too hard about the costs, the trade-offs between strict supervision on the one hand and lower economic activity. So the causation challenge is a daunting one for financial economists, and all of these papers are trying to identify a causal link in a very clever way, I think. The problem with identification is the following, okay? Bank failures are associated with economic downturns. You see it in a graph from Stefan's earlier paper that shows that when the economy does poorly, so do banks, and so do bank failures occur. We've seen a relative calm. We were getting over the hangover of the global financial crisis as late as 2013-14. And we see relatively few failures in the calm that followed, even though there was a large SVB failure. So the question then is, well, if you're going to think about real effects of bank failures, the first question you have to ask is, well, what causes a bank failure? Okay? And there's really two potential explanations from your earlier work. One is that they're bank runs. That was the case before the Federal Deposit Insurance Corporation. And what we worried about in bank runs was the following. solvent banks would face a liquidity crisis. They'd have to sell their assets at fire sale prices, and that would cause further economic damage. Okay? We had deposit insurance, and deposit insurance led to greater supervisory oversight as a way of mitigating moral hazard. The second cause of bank failures, and I think is prominent, much more prominent in the post-deposit insurance era, is solvency. Poor fundamentals, such as credit risk, interest rate risk, and fraud, are what cause bank failures. Okay? And if that's the case, insolvent banks may not face runs, okay, due to deposit insurance, so you need supervisory intervention to close those solvent banks because zombies cause damage, as we all know. So what's the empirical evidence? Stefan has a paper that, to paraphrase Milton Friedman, our evidence suggests that the primary cause of bank failures is almost always and everywhere deterioration of bank solvency. Okay? Not a big surprise in an era in which you have federal safety nets. What that does suggest, however, is if it's bad fundamentals, then it should be predictable. Okay? And that is the case. This is a graph from one of your papers, Stefan, again, shamelessly borrowing from his research, where it's basically saying, okay, if I look at the things that cause bank failures, insolvency with low earnings, non-core funding, okay, non-core funding combined with insolvency, and then I add rapid asset growth and aggregate conditions, what do I see? Well, this is a graph that says, well, if I were just flipping a coin as to who to close, okay, it would be along that 45-degree green line. What you see, however, is that you can predict bank failures with these characteristics with a lot of precision. Okay? What the graph shows is that about 86% of the time, 1 year out, you get a true positive using just fundamentals. Okay? And you'd only make a mistake, false negatives, roughly 10% of the time. Okay? That's important to keep in mind when you think about supervisory oversight. One of the things I'd like to see in Stefan's paper is what is the incremental effect of supervision on this, because we have highly predictable bank failures. Okay? So why worry about bank failures? I gave a paper recently to a bunch of non-banking academics on branch closures, and the first question I got is, who cares? Okay? You know, Barnes & Noble goes out of business all the time. Small businesses go out of time. So why do we care about bank failures? And the answer is, we think that they may have adverse effects on both the customers of the failed bank, and they have spillover effects, as Brian's paper suggests, and Stefan's work as well. In other words, it adversely affects the customers of solvent banks that are in the same market as the failed bank. Okay? And that's a problem. So let me talk about each one of the papers real briefly, try to highlight their strengths and point out some additional work that might be done. The first paper, the Supervising Failed Banks, has really two parts to it. One is descriptive, which is what actions do supervisors take in response to poor financials? Do they take actions? I certainly hope so, because the financials are predictive of failures. So if they're predictive of failures, my gosh, I hope the supervisors can identify those and take actions upon them, because we can see them in the financial records of these institutions. The second part of the paper, I think, is far more interesting. Does increased supervisory scrutiny hasten bank failures? The answer is yes. And if so, what's the cost? Okay? Does strict supervision have a cost to it, or are we just getting rid of banks that would fail because they've taken exorbitant risks of fraud or made bad interest rate bets? the identification, and I have to compliment Stefan for the courage of going before a group of state bank supervisors and talking about the difference between federal and state examiners. But the idea here is that federal examiners may be more stringent. We can there's a random assignment at the start of the GFC based just on the timing of the prior examination. And you can then look at what stricter supervision implies. This is his table about the impact on bank failures, which is, I think, not terribly surprising that stricter supervision leads to more timely closure of banks, lower costs of the deposit insurance fund, and a higher probability of failure. What I think is really interesting about this paper is the table about what regulatory or supervisory strictness implies, which is in the local markets in which you have stricter supervision, okay, you see slower loan growth, slower real estate growth, slower C&I loan growth, more rapid branch closures, and reduction in bank employment. Now, what's encouraging to the strict regulators is the bottom panel, which is the effects are short-lived. In other words, there's not a lasting impact of stricter supervision on those key factors. Now, what I struggle with this paper, and it's not a criticism, it's an observation, and the authors are pretty upfront about this, is the findings pertain to GFS supervision, or global financial crisis supervision after the financial crisis, a period when there was a lot of unbooked losses that were a major problem to banks, right? And so it isn't clear what the welfare costs are associated with stricter supervision in terms of deposit growth and lending, because we're talking about a lot of banks that had a lot of unbooked losses, okay? And then the question is, are you stopping gambling on resurrection with stricter supervision? And is more supervision and lower earnings implying a faster operational adjustments to a low rate environment? Because what followed the great financial crisis was a very low rate environment. And a low rate environment put a lot of pressure on community banks because spreads were very narrow, okay? And that prompted operational changes, okay, as you're all aware. You gotta push people off onto a different platform if you're in a low rate environment. The second paper, Depositor Attention and the Cost of Funding, this paper's contribution is to say, well, there's another spillover effect that we ought to think about. And that other spillover effect is when you have a bank failure, okay, what happens to the rates that banks in that same market have to pay? They go up. And deposit growth declines, which means there's a shift away from deposits, okay? That's a negative externality, what we call in economics. And it has real effects if those deposits lead to, as they do, slower loan growth, okay? And particularly amongst small businesses. And what the authors are pretty clever in doing is disentangling the mechanism, which is depositor attention, as opposed to solvency concerns. So one of the issues with all these papers on bank failures is they tend to be clustered at periods of slow economic growth, and in particular, the global financial crisis occurred at a time that was subsequent to or preceded a period of very, very low interest rates. And then the question is, did that lead banks to close branches? Did it lead branch closures lead to the kind of real effects that we're talking about? So is it the failure of the bank or the low interest rates that led to closures of branches that led to declines in economic activity. And so is the mechanism saliency or infrastructure changes? A couple of other comments. First is the focus is on really large CDs and 100,000, 500,000, which is a small portion of the funding of most community banks, okay? And it tends to not be localized funding. It tends to be out-of-market funding, okay? The other thing that is a little tricky here is when the FDIC takes over a bank and the acquirer assumes the deposits, if they're insured, in a time deposit, the acquirer tends to continue to pay the rate on those assumed deposits, which means that if the failed banks were paying higher rates, okay, you're going to see higher rates almost mechanically at the $100,000 mark, which is why I think the impact, maybe one reason why the impact on deposit rates is greater for the $100,000 than the $500,000. The other reason may be just the difference in platform. You're not picking up $500,000 CDs, okay, in the local market at a small branch. Okay? The final paper, Bad Luck, or Bad Banks, Bad Luck, I think is a really fascinating study. And the reason, as an economist, I'm fascinated by this study is what we don't have in the United States that Europe and Asian countries have is a credit registry. So that you can track borrowers and lenders throughout the system. Okay, we don't have that here. Okay, what they've done is really a quite clever way of coming up with a credit registry. Okay, so one of the pitches would be, let's have a credit registry, okay? The interesting thing about this paper, again, not only the data, but the basic idea behind the FDIC's closure policy is we want to mitigate the disruption associated with the transfer of banks' assets, okay? The liquidation of those assets by transferring them, the good assets, to an acquiring bank and the deposits to an acquiring bank. That's the whole idea. So defined, okay, real effects on bank customers for particularly small business customers of these banks when most of the P&A failures are treated with as a P&A transaction is somewhat surprising. So it's an amazing database. The contribution is a lot of new evidence about persistent adverse impacts of bank failures. This graph shows the effect. It's mostly in the first 5 years, okay, which strikes me as surprising that it's so long lasting. So then the question becomes, and I have to say this because I'm an economist, and when economists talk about papers, they have to think, well, what else is going on? Okay? And what comes to mind is reverse causality. Okay? It's not that the failure is causing the decline in, or the increase in business failure rates, or causing declines in unemployment, but they're a reflection of the fact that the insolvent bank had made bad loans. Okay? So it has worse customers. Worse customers are more likely to fail, okay, and have slow employment growth, particularly in the period of time that's the focus of the paper, which is in the post-GFC time period. Now, one of the things that I think makes the reverse causality argument plausible is something about bank culture, okay? Which is that when you look at material loss reviews, what do they say? They say the bank failed for a variety of reasons. They'll pinpoint one or two, such as, oh, you made bad construction and development loans, or you had a large portfolio of other underwater mortgages, but they also typically say something about deficiency in underwriting, credit administration, risk analysis, and recognition. It's a culture problem, okay? If it's a culture problem, then a couple of things come to mind. If it's a culture problem, then it's not just one part of the portfolio that might be performing poorly of a failed bank, but it would be all parts of the portfolio. Not just the small business loans, but the larger commercial loans, the real estate loans, and the like, okay? There's a couple of interesting papers that I'll summarize here. One is, if you look back at banks' performance in 1998 during the Asian financial crisis and ask the banks that performed poorly during that period performed poorly during the global financial crisis, the answer is yes, okay? There's a recidivism rate in culture. Second, there's this boom and bust paper in small bank business lending, which is really interesting because what they do is they say during boom periods, banks that are flush with deposits tend to reach out and lend to small businesses at further distances, okay? And if you're lending at further distances, you're not getting that relationship with that customer. And what do we observe? We observe higher default rates for distant loans to small business borrowers, okay? So where do you see that? You see banks whose branches were in primarily high growth areas reaching further and further. I know I'm over. What does that tell me? Well, it tells me failed banks are likely to have large asset growth. Large asset growth may be in high deposit markets. I might be reaching for small businesses at longer distances. What Yannick might say is, well, maybe it works in reverse. The bank fails, the branch closes, and the acquirer says, you know, it's now further from my market, so it looks like a riskier loan. I don't want to make it, okay? Which then leads to the failure of those, a higher failure rate for those customers. So again, to look at the selection, I might look at lending at bigger, longer distances. So just to summarize and then open up for comments and questions, this is a great set of papers. From an economist's point of view, and hopefully from a community banker's point of view, what's neat about these papers is they have very clever ways of trying to tease out causal links, which I think is really important. What I think is needed, and Stefan mentioned this, and I would reinforce this, is they do provide evidence of a trade-off, okay? Stricter supervision, slower growth, okay? But the question we need to ask is, what's the cost of not taking action? Do the zombies cause more harm than prompt corrective action? And unfortunately, we don't have good empirical evidence to guide us on that. Okay. So with that, I'll open it up to questions or comments from the panel. In the back.
Yes. Excuse me, Kelly Lammers with State of Nebraska, and in full disclosure, I am a state regulator. I won't call myself more lenient, but nonetheless, I have a question of all three. Relative to paper number 1 and looking at the mathematics, and for decades, I have looked at state exams versus federal and looked at both trends and levels. How do you consider joint examinations as a entity goes into increased regulatory scrutiny? To move quickly then to paper number 2, as the bank failures lead to lower lending, is this a situation in which the community that was experiencing the bad lending emphasis was over penetrated and it was moving to a more normalized effect, or is this simply a pendulum swing? And then finally, with paper number 3, actually quite enjoyable in terms of, is this relationship banking? And all of a sudden, I'm stepping back and looking at the resolution papers that I have worked with are all cost basis. And is there a desire, or could there be, with more mathematics? I understand you can't do a bank exam with mathematics, but in this case, with more mathematics, is there actually a value in having a like-minded lender acquire that type of business of the closed institution? And with that, I just wanted to say thank you. Incredibly thought-provoking papers.
Should we collect more questions? Okay, yeah. Should I answer?
Yeah, please.
Yeah, thank you so much. So, first of all, there's no, when I say lenient and strict supervisor, there's no judgment involved. It's an empirical statement. It's an empirical statement. If you consider the exact same bank and you take a state regulator, the CAMELS rating will just be lower. And so I think it's an excellent question on the joint examinations. I didn't really talk about this, and we actually don't really mention it in the paper, but for the main result of the paper in the causal sense is what we're looking at is this idea is, okay, if you get a federal guy early on, you're more likely to get on the problem bank list, and then you're just going to have all kinds of things happen, all kinds of motions get sent into action, and people are going to start looking for more problems, and that's just going to sort of lead to this overall more scrutiny. Now, that effect is actually a little bit attenuated if you consider joint examinations, where you have a state-led exam and it's actually accompanied directly by federal examiners. So I think it's an important detail if you really want to sort of get the exact differences between those two, right, the levels. But in terms of the qualitative difference, it's not going to matter. But it's an excellent question. Thank you.
Yeah, thank you. Also, excellent question for my paper. So this we don't really dig into too much in the data. It's not really a dimension that we're emphasizing in the current analysis. But without looking at the data, I would say, in theory, when the cost of funding goes up, you would expect the bank to be more selective with the projects that they're funding, and perhaps this, in theory, would say, the average quality of loans that they make would be of higher quality. But that's something that empirics could speak to more concretely, and something perhaps that we do in the next stage of the project.
Yeah, so it's a great instinct for analysis, because it's actually the thing we're currently working on is looking at the acquirer's side of these bank failures to see if there's any characteristics of the acquirer that can help explain this gradient I showed at the very end in terms of which bank failures are more harmful to small business than others. With the story, so the hypothesis would be that if you have a community bank that fails and is then taken over by another community bank that has a similar philosophy in how it extends credit to small businesses, then maybe the effects aren't as big, because again, that acquiring bank will again lean on the relationship model of extending credit, whereas if, I'm going to pick on JP, like if JP Morgan were to swoop in and buy up a community bank, it might say, well, actually, we don't do the whole going down to Friday night football to figure out who's the good business proprietor. We have this algorithm written by these kids at MIT or whatever that tell us exactly who the good credit risk is, and then all of a sudden all of this soft information goes away. And then I think Jim, we talked about this in the past. So one thing that I've come to realize is when we think about loan officers in particular, I think the standard economist's view of a loan officer is like, oh, well, that's a screening device. Like a person comes in and then, yes, there's some small talk, but really the loan officer's screening, like, was this a bad risk, good risk, what is this kind of person like? But what I've come to realize is that actually there's a lot that goes into, and of course I think the practitioners here are going to say, yeah, we know that, you don't have to tell us, but for me, I don't do small business lending, so it's kind of new for me. Is that there's a lot of post-loan kind of support that a loan officer will also provide. Because if I go out and I'm like, well, I want to start a food truck business, and I go get my loan from, let's say, Jim's bank, but that loan officer not only extends and screens me, but also it has a lot of local knowledge, and will then also be able to tell me like, hey, by the way, and buying that huge truck is probably not right. I've seen this a couple times before. You make these big capital outlays. That's not right. You want to start small. So there's also this sort of local info, and I want to call not mentorship directly, but some additional support that goes on after. And I think probably the larger banks maybe aren't as good as that than the others. So we're definitely now bringing in information about the acquirers and trying to then see whether the sort of difference in asset size or type of bank charter could explain that gradient. So thanks for that great question.
And that is the community bank value prop, and you get right down to it for small business in a lot of ways. I mean, our customers, when they come to us, it is not just about, can I get the check so I can go do whatever I want to do. We're having those conversations, not, you have them after the loan, but you really have them on the front end a lot of times. A lot of small business customers, they may know how to work, have a great auto body shop, but they don't understand cash flow, okay? And it's a complicated subject for a lot of small business owners. They don't understand the fact that they can grow themselves into bankruptcy from a cash flow standpoint if they don't understand how to have sustainable growth levels and things, you know, so just small things like that I think really do matter, and it's where community banks, I think, you know, earn that margin that we have to have a little better margin a lot of times than a JP Morgan does.
Real quick here, just kind of to touch on that a little bit with the relationship. So one of the things, an acquiring bank is not buying the relationship. You cannot buy a relationship, they're buying numbers. And that kind of goes along with what you were saying, that if they don't have that relationship, they may not, you know, help them as much, but they also don't understand the credit, and they're buying potentially tainted assets in their perspective, and so they're not going to have the same latitude given sometimes as well. So there's some of those other things that could be at play there. There's going to be a perception amongst the loan officer that, yeah, I don't really want to give them that extra latitude, and they don't know them. You have to build that relationship over time, and so if that doesn't take place. So another thing to consider with that.
In the back.
There we go. Jeff Trammell, Merchants Marine Bank, Pascagoula, Mississippi, Chief Operating Officer. Used to be a bank examiner, state examiner. Stephan, you and I have to talk after this. I was a hard examiner, but that's okay. On the last paper, you know, the hidden harms, I can see it working with small businesses before, where when you take them off track, they tend to be highly efficient, be very myopic, very focused, and when you change the way they do business, it upsets the apple cart. And I can see maybe there is something there to the failures, just not being because they made bad loans, just because now their attention has changed, the way they're getting funds, the way they do treasury management's changed. I can see that. It's very interesting work. On the second paper, higher rates, I don't know if there's a correlation between sort of like market gains. When a market gets in a downturn and people tend to sell, you know, the late sellers are usually the small retail lenders or retail equity buyers. They tend to buy low, you know, buy high and sell low. It's almost like there's a information cost, the cost of delayed information, where now that there are bank failures in my local area, I don't trust banks as much. Therefore, I'm requiring a higher return on my money. So it might be different, just like the equity markets kind of work. People sell too late, a little scared. They're the same way with their money there. But very interesting paper. And the last one, it recalls when I was a bank examiner, I used to talk about how the report of examination in any sense was never shared with the public. And the chart that you had up there where all the closures were on Fridays pretty much after the Great Depression. And and you said, you know, that's a supervisory-led deal. And I always wondered, and in these talks I had with examiners when I was examiner, is that the customer no longer has information on what's happening with their bank anymore. They kind of advocated that to the federal regulators. And so they don't know when their bank is bad or not, right? They don't get Campbell's reports. They don't get anything that indicates the reports are bad, and maybe that causing that delayed reaction in banks being closed at a point where they get to that tipping point and they finally tip over, and having more public information may let the people vote with the dollars faster. Don't know if there's something there or not, but I appreciate it very much.
Yep.
Good afternoon. Greg Bertone, Regional Director, FDIC Chicago. And I want to thank you guys. It was great papers for give us some additional thoughts on some things. And just one observation that I wanted to share, and I'm interested in if you had any comments on. I've been through a few crises in my time, and One of the things that I heard anecdotally consistently was from those institutions that either survived or entered the markets afterwards is a few years down the road, they said some of the best loans I made were the loans that I made at that time. And it may have been because they got to pick the best of the worst, or there wasn't any competition, or that they could, price set where they were at. And I'm just curious how to quantify that, if it can be quantified, and especially Jim Edwards having to gone through something like that, his thoughts on that.
Yeah, well, the flip side of that we talk about in our credit committee pretty regularly is, bad loans get made in good times. And we've been in pretty good times now. And so, we tell that to our younger lenders who didn't see this, great recession, didn't live through that, because there is a little bit of that, if you've never bitten by the snake, you're not worried about it. It's just something that's supposedly out there in the bush. And when you've seen what can happen, that's a problem, then you're more cautious about it. So I think that's absolutely true, and you're right. I mean, the other thing is, when times are really challenging like they were in 8, 9, 10, small business customers are much less likely to forget that you stood with them, that you continued to fund their accounts receivable, that you said yes when they had a great opportunity. I mean, they remember that, because credit's, when credit's not easy to get, it's more valued, just like everything else in supply and demand that our economists can talk more eloquently about than I can.
Stefan, you wanted to?
Yeah, I wanted to add something about the comment or question on sort of the supervisor's role of providing information to the public. I think so. Bank failures may come as a surprise to certain retail depositors who are not paying attention on any given day, really, basically. But I would argue that banking supervision is really sort of key in kind of making financial statements of banks accurate. And banking supervisors, in my view, don't do it because they want to inform the public, and the public really maybe doesn't care about downloading call reports and making some charts, although the public could. And so some people do it for them. But really, the banking supervisors do it in order to sort of be able to take legal action. So to say this in a different way, when supervisors are criticized, why did they not take action at SVB? SVB had a Keynote rating of 2. If you walk into SVB as a supervisor and you say, oh, we think, 2 weeks before SVB actually fails, you walk in and say, oh, we should close you guys because we think you're not doing good. They're going to take you to court and they're going to win, right? Because they had equity over assets 15%. So if a supervisor wants to close a bank, it's a long process in which the financial statement needs to reflect the adverse conditions of the bank, and only then legal action is actually warranted. That process, which again, it's not necessarily the supervisor's goal to create some information for the public, but it does actually make it very much transparent which banks are in bad conditions, and which ones are not. And to Chris's point, you show one graph of an earlier paper of mine. Bank failures are, from these public information, are extremely predictable. It's hard to miss them. And in part, the predictability comes from the supervisory process, which is slow, which requires sort of this long, back and forth between a bank and supervisor in trying to agree of what, the asset values are, which then governs the capitalization and then the scope for legal actions. But so just all that saying, even if Keynote's ratings are not public, all that information is in the call report, and that's because of supervisory action. It's because supervisors audit. In both state and federal in an equally effective way.
Okay. Well, it seems like we have a lot to talk about in the networking break, which is about to begin. So please, let's thank Christopher, Stefan, Brian, Yannick, and Jim. All right, so we're going to break. We're going to be back here at 4 p.m. Again, we intentionally have these longer breaks to really continue these conversations, so please seek out our speakers and each other. This is an opportunity also out in the function area during the break to enjoy a local St. Louis treat. So we have to put our local stamp on it today. So enjoy. We'll be back at 4 o'clock, where we will hear from the winning team from the 2025 Community Bank Case Study Competition. We'll see you back here at 4. Thank you.
Carroll Bank & Trust has its roots back to the community of McLemorsville, Tennessee. The bank began operations in 1907 and served that community through the Great Depression and some of the more turbulent times of the 20th century. The bank provided access to local credit and savings for families, farms, and businesses. In 1972, a group of young bankers, Billy Carey, Billy Tynes, and Graham Funderburk Jr., decided that this small bank was a good opportunity for them. They borrowed the money from Union Planters, now Regions, and bought the bank. They soon branched to Huntington and McKenzie and expanded the team and services offered. In 1980, they changed the name to Carroll Bank & Trust. Today, we stand on their shoulders and continue to provide quality products and services in support of the communities we serve. I think the number one strategy that has contributed to our growth and stability is just hiring really good team members and supporting them, empowering them to be effective in their markets, investing in them, encouraging them, and those team members have done an excellent job representing us in the various markets that we are in, and the relationships that they have built have been a key factor in our growth. In terms of the current interest rate environment, right now stable, predicted 2 rate cuts this year from the Federal Reserve. We are curtailing our borrowings on the liability side of the bank. We're actively watching deposit rates and moving quickly to move those with the market. And then on the asset side, we are locking in some longer term things because of the rates that are here now that may not be here in 24 months. Over the last 15, 20 years, we've had some very successful branch launches into those areas around us, counties that we were not in. In terms of actual dollar numbers, I'm not sure I can put that in front of you right now, but I can tell you that we have become strong competitors in each of those markets, and the communities that we serve, we have attempted to be very committed to giving back to those communities, and that also, coupled with the key team members that we have in those markets, has been very beneficial for our overall company growth strategy and brand. Technology and digital service lines have enabled us to be competitive with larger banks who have those same bells and whistles, but we've been able to deliver those into the markets that we serve, and by doing that, it's made us just as attractive as some of those larger entities with all of the technology that our customers need and want today. In terms of regulation that may affect our branching, the one that comes to mind first is the CRA requirement to be diligent about serving all socioeconomic tracts of a market. We have to be careful to serve low to moderate income, unbanked, as well as those that may be in the moderate to high income brackets.
Caring. Customer service.
Community.
Excellence. Family.
If you look closely at the Carroll Bank & Trust logo, there are 2 oak trees in the logo. These 2 trees represent the bank and the community growing together. A strong community bank is the lifeblood of a growing community.
Good afternoon, and welcome to our case study competition segment.
My name is Rashonda Kelly, and I am the chair-elect of the Conference of State Bank Supervisors Board of Directors and the Commissioner for the Mississippi Department of Banking and Consumer Finance. I'm honored to moderate one of my favorite segments of the conference. For 10 years, I've watched this competition from the audience, and today I have the privilege of having this conversation with the winning student team. CSBS began this competition in 2015 to increase awareness of community banking. The purpose of the competition is three-pronged. First, to build a deeper understanding of the community bank business model and the role that community banks play in our local communities. Second, to connect academics with an interest in banking and financial services with the banking industry to foster research in community banking. And third, to grow the understanding of community banking among undergraduate students and steer them toward a career in banking and bank regulations. Student teams from across the country in any academic discipline can partner with local community banks on to research a specific topic. This year, 35 student teams representing 27 universities partner with local community banks. Students were challenged to explore the impact of interest rates and inflation on the business of banking. The research focused on strategic planning for future through branching, technology, and compliance, including the regulatory cost. It was a tough competition with 3 rounds of judging from a panel consisting of state and federal regulators. This year's submissions were truly exceptional. I want to thank all of the teams that participated in the competition and congratulate the top 3 winning teams. A team from Illinois State University placed 3rd. A team from the University of Arkansas came in 2nd place. I'm honored to personally congratulate and welcome the #1 team from the University of Tennessee at Martin. Please wave when you're introduced. Aaron Bartholomew, Anna Batt, Mackenzie Boris, Blair James, and Hayden Weber. I would like to also welcome their faculty advisor, John Clark, and their community bank partner, Mike Carey, President and CEO of Carroll Bank and Trust. The top 3 teams' work is published in the CSBS Case Study Journal, which you should have found in your chairs after the break. This can also be found at csbs.org. This is the 3rd time that this team, that a team from the University of Tennessee at Martin has placed 1st in this competition in the past 5 years. So the format of this discussion will deviate a little bit from the past years. In the past, the students have walked through the details of the case study, they've explained their analysis, and they've shared their conclusions. This year, we want to have a deeper dialogue with the student team, the academics, and the advisors and the bank partner. But before we get started with this dialogue, I do want to give the student team individuals an opportunity to introduce themselves, give their major, graduation date, and if they're not graduated, their major, but if they have graduated, what they're doing right now. So Aaron, we'll start with you.
Okay. Hey everyone, my name's Aaron Bartholomew. I'm from Parsons, Tennessee. I graduated from UTM in May. I hold a degree in accounting as well as finance. I currently work in public accounting at a small firm in Jackson, Tennessee.
Hi everyone, my name is Mackenzie Boris. I graduated in May with a double major in accounting and finance. I currently just moved to Hawaii and am looking for a full-time position.
Hello everyone, my name's Anna Batt. I'm from Brewston, Tennessee. I just graduated from UTM in August with a degree in accounting and finance, and I work in accounting in Martin, Tennessee.
Hello, my name is Blair James. I'm a senior accounting and finance major from Milan, Tennessee. I graduate in December, and I'm really excited to be here.
And my name is Hayden Weber. I graduated this spring with my bachelor's in accounting. I'm from Somerville, Tennessee, and currently working in halls at a public accounting firm.
Thank you. I have a pretty easy question to start. How many of you felt like you had a good grasp of community banking before you entered this competition?
I didn't have a great grasp of community banking. I banked with a community bank back home in Parsons. Other than that, no, I knew how to balance a checkbook and put money inside and outside of my savings account. That was about it. So
pretty basic.
Yeah, this was a pretty eye-opening experience for me.
I'm about the same as Aaron. Never even really go into a bank, pretty much just use my phone. But I do know what a community bank is because where we're from in Tennessee, there's really only community banks, but yeah.
Kind of going off what Aaron said, I went in banks as a kid with my parents, not as much now, but I have a checking account with a bank. But community banks in West Tennessee are not few and far between, but on every corner, and we're glad to have them.
I feel like we all pretty much had a vague understanding of community banks, like in depth, but we'd all been in there and very well respect the work that they do.
Yep, just going off of what everyone else said, basically, I had some more experience with larger banks, regional banks, but you can tell in rural West Tennessee how important community banks are to how the community grows, and we really appreciate all the hard work they do.
So this competition focused primarily on the landscape of community banking, specifically the impact of interest rates and inflation on banking, as well as the operational costs and opportunities of doing business. Your case study was well written and your conclusions were well supported. Will you share each area of focus you were responsible for as you completed the competition, what role you played in that written and final work?
Yes, well, since there's 5 of us, we conveniently had 5 parts, so it made it pretty easy. I was over the financial performance, financial analysis section of the paper, part 1.
I really studied part 2, which was the interest rates and inflation portion.
I was over the branch strategy portion, which was a great portion for me. I really, I kind of wanted that part going into the competition and seeing that was a section. Carroll Bank has a great marketing director that helped us a lot with the video portion, which I was also a part of and was really glad to do it.
I had the technology section of the paper, and I also helped Anna with the video as well.
And I was left with the regulatory burden, the exciting stuff, I know. But I enjoyed it and learned a lot.
Well, you each kind of walked through your 5 areas, and I do want to ask you, what was the most interesting or surprising finding as you worked through this competition?
I think the most surprising thing for me was just the complexity of the day-to-day operations. Like I said, I hadn't had much experience with community banking to start with, so it was definitely an eye-opening experience for me. The day-to-day operations, along with just the relationship-focused atmosphere that the community bank, Carroll Bank and Trust specifically, presented, is something that really surprised me. I'd always thought about just banking with the name on the building instead of, now I know it's with the people and the people inside it.
My most surprising finding was that as inflation was increasing, Carroll Bank and Trust was still able to grow and thrive. I was able to work with Jordan Allen and Phil Fry, and they showed me that they were able to make good, efficient decisions, and were still able to carry out their branch strategy that is really important to them.
For me, was how close-knit Carroll Bank and Trust is, and as well as the branch strategy portion, which I had a big hand in, as far as how many moving parts there is, all the work that goes into choosing a location for a bank, choosing people to operate the bank. There's a lot that goes into it that I just didn't realize, and I commend them for because they do a great job at it.
The most interesting thing I learned was how Carroll Bank and Trust leveraged technology to remain competitive, but also maintain those personal relationships, which is truly what they're about, and being very involved in their community, which I feel like they did exactly that.
My most interesting finding was Carroll Bank and Trust, specifically Dr. Taylor and his compliance team that the bank has on staff there. They are very dedicated to the Community Reinvestment Act and making sure that they are serving all individuals throughout the economic levels of the communities that they do business in.
I was talking with Mr. Clark and Matthew Whitledge before we got into this segment about attracting students to this competition. That's typically one of the harder facets, well, at least what I hear from the academic advisors, What attracted you guys to participate in this competition?
I was really attracted to the research format of the paper. I've never been a part of a project like this, never been part of a group project or really written a huge paper of this size either. So just the research, the ability to ask the why questions. I usually get in trouble for asking the why questions, but they helped me on this paper, I do believe. But just the ability to be myself and like I said, ask those questions and really dig deep into a subject like banking that's very vast and large.
I was most attracted to participating in the competition because I was really excited to learn about a new career field that I didn't really know much about. More specifically, I was excited to work alongside banking professionals like Mr. Mike Carey.
For me, getting a major in both accounting and finance, I wasn't really sure if I wanted to go the accounting route or the finance route, and I think this has been a really good indication that banking could potentially be a career for me in the future, as well as the reputation that the team at UT Martin has for this competition has done very well the past few years, and it's exciting, but it was also a little nerve-wracking for us to, keep it going, but I think we've done well, and it's been a great experience.
I had the opportunity to talk with some students that did this in the years past, and they talk so highly about the competition and about the advisors that we have at UTM, and they really are passionate about what they're teaching students. And so I just really wanted to be a part of a team that was excited and ready to educate students on this, and I think it's important to have students that are ready to learn and ready to just really sponge all the information in. So I think that's what made it appealing to me.
Dr. Cole, she's a faculty advisor for the case study and works at UTM. She approached me and told me about the competition, and I thought that it was a really interesting opportunity to go out and get some hands-on experience and get out of the classroom and actually get to go and meet people and learn about the day-to-day operations of the banks around Tennessee.
Y'all's responses are a good segue to my next question for you guys. Many students that participate in this competition in the past have gone into banking as a career. They've gone into bank regulation and supervision. Do you think, I think one of you mentioned that this gave you some perspective or some insight as to what banking looks like as a career. Do you think this has changed or has influenced your future decision for a future career at all?
I do. It's definitely given me a new renewed appreciation. I'd always appreciated bankers, but I really now I'm able to more fully appreciate them for what they do, and it's definitely affected my my future career plans. One day to potentially pursue a career in banking.
This opportunity has really opened me up to a new career field, and I'm definitely interested in banking and would love to be able to work in banking. And I'm really thankful for what this competition has opened me up to.
Like I said a little bit earlier, going into finance and accounting as my major, I wasn't really sure what field of work I wanted to be in. And although I'm in the accounting field right now, I could definitely see myself working in the banking industry in the future.
I plan to pursue my CPA upon graduation, and I got to work with the CPA at the bank, Jordan Allen, and they really value his CPA there, and I think it really opened my eyes to how they are very valuable in the banking industry. And so I do think that has made an influence on my career goals.
Before this competition, I wanted to be an accountant, and I've been lucky enough to find a job at an accounting firm there in West Tennessee. And I'd also, like Aaron said, we wanted to I'd like to pursue my CPA, and I'm working on study for that right now. But as far as banking goes, as Blair said, Jordan Allen is a very valued member at CB&T, and I could see myself in a role like that.
Thanks. So I'm going to move into my conversation with the banker. So I'm going to move to the chair and have that conversation. So first question for you, Mike. I know that community banking days are full. What time commitment did this competition take, and how well did you use that time?
Thank you. We first off,
just want to tell you guys what a great conference this has been. Congrats to CSBS and the Fed on a wonderful opportunity. I was very thankful to get to come. It's been a unique opportunity for me. I'm glad to be here. Carroll Bank & Trust, $614 million in total assets, rural community bank, 120 employees, 5 counties, and so thankful to be here and exchange and be a part of this opportunity to engage in these students. On the time commitment side, Rashonda, it didn't take very much of our time because this team, Tracy Crawford, who's sitting in the back there, and Mr. Clark, Mr. John Clark, they did such a great job organizing the team. Team was very organized, so it did not take a great deal of our time. We had about 1 to 2 hours in group session, a conversational format, history of the bank, strategic direction of the bank, various parts of the bank, roles that are subject matter experts or topic area experts that they would be working with in the bank. That took maybe 2 hours at the most. Then at the end of the competition, they presented their findings to us in such an excellent way. Just a great team, so very fortunate to be here with them. But they presented those findings in an excellent way. That took probably an hour and a half and 2 hours. And then individually with our team members, maybe 1 to 2 hours in the different topic areas that they worked on. Also, they were able to work with some of our strategic partners. Jimmy Sawyers of Sawyers and Jacobs. If you're looking for an IT strategic partner, Jimmy Sawyers really took care of our team last night, took them out to dinner, took care of them, showed them St. Louis. He did a great job. Dr. Ken Thomas is a consultant on branch location. He worked with the team. Also, we had Caitlin Spivey, Chris Pastina. All those members are strategic partners of ours. Chris Pastina's with Raymond James. He's a bond trader, bond guy, and he worked with them. But each of those partners spent maybe 1 to 2 hours with you guys. So, not an onerous amount of time. We were very thankful to offer the time, so it was time well spent for us.
So all the bankers in the room, he said it.
Yeah, it was time well spent.
So this morning, CSBS shared the results of the 2025 CSBS Annual Survey of Community Banks. The topics for this year's survey were centered around emerging risks and opportunities in our current financial environment. As a state regulator, I often hear our community banks talk about remaining independent, remaining viable, and remaining profitable. CSBS tracks the banker sentiment quarterly, and regulatory burden consistently tops the list of concerns among bankers. This case study also highlighted the bank's response to regulatory expectations. The student team did a great job of outlining the bank's priority of achieving regulatory compliance through well-defined policies, comprehensive compliance programs, and investments in human capital. With that being said, regulatory compliance is not cheap. The complexity and volume of regulations can also make it more challenging to maintain compliance. The student team also noted the disproportionate impact of regulations on smaller institutions, as was noted this morning, and that the cost of regulatory compliance may make it more difficult to serve customers. There is a question. From a banker's perspective, do you think that this case study competition and this level of research has been effective in increasing awareness of community banking, underscoring the impact of regulation on community banking, and attracting future talent for community banks?
Very much so. It hit on all of those things. Obviously, it introduced some potential future bankers to community banking. The regulatory burden side of it, obviously, if you're shut down, you can't do business. So you've got to maintain your regulatory compliance. They did look at that pretty thoroughly in their research report. We're very fortunate. We're a state member bank regulated by the Federal Reserve and the Department of Financial Institutions out of Tennessee. Commissioner Greg Gonzalez, member of the Conference of State Bank Supervisors, a great guy, a leader. We've got one of the best in Tennessee. Those of you who know him.
Greg's a great guy.
we've got one of the best, and so he sets a tone of fair, reasonable, supportive, and that's the same tone that I found with the Federal Reserve, and I'm very thankful for that. And you know, fair, reasonable, supportive, and we've been very pleased with the examination process. But vital, important, and I think I missed one. Rashonda.
Attracting talent. It was.
Talent.
Yes.
Oh yeah. Well, that's the key. I mean, the bank's not the building, as these folks have highlighted. The bank's those people. And attracting quality talent and retention is harder than ever. And those relationships are what make the bank. And you know, it's a tough job keeping that team together. But getting good quality team members like these folks that you see here that are intelligent, committed to learning is, you know, it's hard, but it's a vital piece of what we do. And we work hard at keeping and retaining those people every day. So.
We've talked a lot about the case study. You know, I've complimented the team on their input and their analysis. Is there anything that they recommended or they discussed during the competition that you would use going forward?
I think more than that, it did for me was, you know, for 30 years we've been hearing, or my whole career, we've been hearing that brick and mortar are going away, and we've been hearing that a long time. And, you know, more than anything else, it kind of validated their research and their, you know, uncovering our financial data and organizing our financial data really validated and encouraged me that what we were doing was meaningful. It was meaningful to the communities that we serve. So more than any unique observation that occurred, it was more their research validated what we were doing, encouraged our branching strategy, which has been successful, and then highlighted the fact that while young people or new people to banking want electronic services, digital services, stable coin, whatever the next iteration of these things are, while they want those things, when times get tough, they want to go down to the corner and walk in, and they want to see Mr. Clint, or they want to see Mr. Jordan, or they want to see Miss Jessica, and they want them to talk to them about what's going on in their life and how to get through it. And so they reiterated that for me, and that really encouraged me that what we're doing is a good work. So,
thank you. Move on to you, Mr. Clark. Okay. So the students have shared what they took from the competition. What do you think they get out of the competition?
First of all, they get a good, Aaron touched on it, CSBS and everyone that puts this on does a great job. It gives them a complex project that has meaning, it has relevance, the topic is very current in banking, and it requires them to do an extensive research paper, put it in the right format, do it the way you're supposed to do it, you know, in academia, and then do a video, and so it's a great discipline. It also enables them to engage meaningfully with a real bank, a real community bank. And the community bank, I usually contact the CEO first, and then they have always, we've done 8 of these now, they always then look at the topic outline, and then they engage their proper management team. And so these students get to work with real people in a real meaningful way. What they get out of it too is they get to form a team. Again, that's a big part of being successful in life. And sometimes they know each other, sometimes they don't. Now, Aaron was the oddball here a little bit because, anyway, he sort of came from a different group. The 3 young ladies, I think, knew each other, maybe knew Hayden a little bit, but anyway, but they come together and they form a successful process.
Well, as an academic advisor, what is your biggest takeaway from participating in this competition?
My biggest takeaway is, again, the process. It's very meaningful. We look forward to the topic each year when y'all announce it, and it's been good every year. Went through COVID and interest rate rises and a lot of stuff over the last 8 years. The big takeaway is, again, getting to work with fine students like this, you know, and help them learn a little bit about community banking, and getting to work with bankers. Again, they're a good group. Sometimes they're a little bit different, but anyway, challenging, but they're great to work with, and they've always been so giving of their time and attention to the students.
So I've talked to you a little bit about this, what's the secret sauce you're using. Your school has been remarkably successful in competing in this competition. You placed third in 2019, you won in 2021, 2023, and 2025. So what secrets do you have to share with the room around your success in the competition?
Well, and I don't mind sharing them, okay? Okay. Success is success, and if we can help the rising tide, you know, what is the tide rises, it brings all boats up, so if we can bring community banking up. The first thing, again, is the structure. The secret of the success every year starts with the topic and the structure, and that comes from you all. So if that was a bad topic or didn't really fit, it wouldn't work. You know, it wouldn't work as well for sure. The second success is the students. You got to have them. And the faculty there, Dr. Cole was mentioned, and she would be here, but she wasn't able to be here today, and others. They and Tracy and I, you know, we find students, but anyway, finding, screening the students and everything, and it's that ability to do that every year. And then the bank. Again, you got to have a great bank partner, and they got to be willing to give of their time and their executive team and others. And so it works.
It's simple.
Well, it's a lot of hard work. So.
How much time do we have left? We have time for questions. Are there any questions from the audience? Okay.
What was the strategy that you guys outlined to help Mike Carey?
Start down there, Hayden.
As far as working with our bank partner, we decided that we'd break it down by each part, each section, and we formulated some questions to ask the specific officers in the bank that knew about those general areas. So we each worked with those officers that were relevant to our sections and sent them our questions, and took those answers and kind of stewed over them and tried to understand some of the lingo they were talking about. But that's kind of how we went through that process of getting those ideas to paper.
Yeah, I was just going to say, one of the hardest parts about this paper, in my opinion, was editing. When we first, it sounds crazy, but I didn't realize it, but when we first wrote this paper, what was it, 38 pages? We had to get it down to 25, so really understanding what's fluff about the bank and what's, hardcore, has to be, can't afford to not take it out of the paper. That's what ultimately had to stay, and that's a big part, I think, of why we were able to be successful.
They've encouraged us to open branch 10. So branch 10.
Susanna?
Thanks, Rashonda. So several of you commented that maybe you had been into a bank or been with your family in the years past, but were familiar with community banking, and I think that's very true for many of us in the South. I'm from Arkansas. But what I worry about is other young adults, young professionals, and then the next generation and the next generation, that those individuals won't have exposure to community bank for whatever reason. Is there anything that you could share with us individually out of this experience, and whether we are regulators or bankers or policymakers, because we need to know what we can do to help ensure that there are community banks and that the next generation of young professionals and young individuals want to go to a bank, use a bank, even if it's an app on their phone. But how can we ensure that they are engaged in banking and understand that relationship, Mike, that they need that and will want that and will benefit them for many years to come? Any thoughts you can share with the group of how we could help change that narrative and help, kind of further communicate the importance of community banking and especially to young individuals?
I think that we were able to have bankers come into our university and speak with our students, may it be at a conference that we're hosting or just at a an accounting majors meeting or a finance majors meeting, or just if it's a university thing overall, coming in and explaining to students the importance of it, or just being about the basics. Some students have never been into a bank. They don't really know what it means. They just have it on their phone, or their parents might do it for them. But I think really coming in and just kind of breaking it down and not making it seem over their heads. I think it's very overwhelming for a lot of young students. So I think the more you can engage with the students, the more you can interact with them, going into schools, going into universities, even if it's career fairs. I think that's a great way to start.
This is really for anybody. I'm David Coxon, and I am a banker. I think maybe specific to Blair, but for everybody, what do you see from a technology standpoint should be the things we should be looking at? What are you looking at from a bank's perspective as the next greatest technology that should be available to you in the banking services as you've done your research?
I guess maybe I have a different perspective after doing this, but I feel like as a college student, it's like, what's the new biggest thing? But after doing this case study, I think it's more like, what is going to be protective? You know, you don't want to maybe do just what has come out and is the newest thing that everyone's maybe promoting on social media. It's what's going to be, what is the community banks promoting, and the ones that you value, and the ones that maybe you bank with. I think it's really important to do your research before just going in and using something, and that's how fraud happens. And I think that happens, I feel like, with more younger students than maybe the older, is just diving in too quick, too fast.
Just as a follow-up to that, how much time did y'all spend talking about digital currency and Bitcoin and stablecoin? Mike mentioned that, so didn't know if that perhaps came into the play in terms of the future for you.
I don't know that we talked about that a whole lot. We talked about some other services, you know, mobile banking, those type things. I wasn't in the IT part of the discussion.
Well, I want you to know the reason I asked the question, I wanted them to explain it to me. So.
It was interesting to see that our core provider has partnered with Circle, and they're going to try to deliver a stable coin. We're with Fiserv, so it was interesting to see, and I think we're going to see it. And, you know, we talked about the legislation earlier today. I think we'll deposit-backed digital currency. You know, of course, a lot of our things are digital anyway, you know, practically. So, but I think we're headed that way. So, anyway.
Thank you.
Matthew?
Matthew Whitledge, Mississippi State University, the team advisor for Mississippi State, who got beat in 21, 23, and 25, I think.
Keep trying.
Yeah, we got you in 2020, and also in, well, never mind. So I'll give you my question and then make a comment about some of the value that I see from my perspective for the student. So the question would be, after going through this process, what was maybe the most surprising thing, something that was maybe most counter to what you thought, or that you didn't know about community banking or that process? So I'll let you stew on that for a minute. My comment about the value that it adds to the students, I think that giving them the opportunity to sit down with CEO, COO, president, an environment where they can have a real conversation, casual conversation with bankers that every time we go to meet with them have always been great. They're always welcoming. A lot of times they'll provide lunch too, which is nice. And so it's an opportunity for them to kind of break down that wall that they may have, especially a generation that maybe we were concerned a little bit more about soft skills, that they get an opportunity to break that down as well. So I think that the value of meeting with them, seeing that they're people, they're just trying to do the best they can, they want to be successful, they want to impact their community is a great value. So with that, is there anything surprising throughout the study that you can remember that you wanted to speak on?
I'll just say how willing Carroll Bank and Trust was to get us people to interact with. I know myself, I had Mike as a person to help with my part, specifically the branch strategy section. I had the city president of Milan, Tennessee, and then the city president of Paris, and then the marketing director helping me with the video portion. Just being so willing and just fast responses, and I think that was one of the key items to our success in winning this.
I was just going to say, one of the things that I thought was a little surprising was that it really does take a village, not just one person. It's a lot of different people that bind together to complete the overall task, the overall goal to eventually, grow and keep continuing to provide for the community and things like that. Another thing that I think was surprising was not necessarily about the day-to-day bank operations, was just to work in, because coming into this project, I didn't have a great perception on a team structure. It always seems like, there are different places. There was some person was doing all the work and some people was not doing anything. Well, this completely reshaped my focus and my perception on how good a team can be when they are all focused, they're all really advanced, and everybody's working to the common goal of everything.
I think I have time for one more question. Tony, you had a hand.
Okay, thanks, Rashonda. Tony Salazar, State of Maryland. So it's for the team, I guess. I always have heard or gotten the perception that among the younger consumers, there was less trust for financial institutions and banks in particular, maybe regulators. Do you feel that, you got more trustworthy, or you felt more if you were concerned before? Maybe that's wrong. You could tell me, oh, no, that ain't the case. But what are your thoughts on that topic?
Seeing how well and how much they prioritize their community is definitely shown me like I can trust community banks. And it's not that I didn't before, it's maybe I just didn't know much about it. But seeing they really prioritize their community and give back to their community a lot, and that's helped a lot.
Kelly, you in the back.
Kelly Lammers with the state of Nebraska. Simply, as your career progresses, what would cause you to walk into a bank?
Somebody's got to I would say for people like Mike Carey right here, I just really appreciate just the time and effort that they put into teach. They taught us so much during this competition, and I think going back what Blair said about just going to schools, colleges, informing young people that you can trust community banks, and that would be one of my main reasons. And also going back what Mackenzie said, I didn't not trust community banks before, but I just have a completely different outlook now, and I really appreciate them and all that Carroll Bank and Trust has done for us specifically.
And touching on the work that Carroll Bank and Trust does, they really invest in their people, and we were able to see that throughout the course of this study. And community banks, the ratios don't tell the whole story. The ratio might say that they're not doing as well as others, but if they're investing in their people, then that's a good investment for their future and the future of the communities they serve.
With about 1 minute left, I want to share the topic for next year's competition. The 2026 case study competition will focus on how external factors impact the business of banking. We know banks play a critical role in the U.S. economy by providing credit and financial services to businesses and consumers. Community banks play an especially important role in the nation's financial system. In addition to sustaining their local economies, community banks also serve as a key provider of banking service, particularly in rural communities across the country. As a regulator, I understand that effective asset liability management practices must be balanced with calculated risk and loan strategies and lending decisions. Likewise, capital retention and deployment are influenced by expansionary activities. Community bankers make this decision daily and understand the critical balance and the correlation between earnings performance, loan portfolio composition, asset growth, capital levels, and liquidity. The student teams during next year's competition will explore how banks approach interest rate risk, how they make lending decisions, what impact inflation has on business decisions, and how they address capital. I do want to note that the timeline returns to the original format during the competition next year. The competition launches next week with the statements of interest due December 19th, the student and bank registrations due January 23rd, and case studies due April 10th. So Matthew, get started. We will announce the winners in 2026 competition during the State and Federal Supervisory Forum in Seattle, Washington, May 13th. You can find out more information at csbs.org. Once again, I want to congratulate the winning team and thank the team, the academic advisor, and the bank partner for joining us today and telling the story. Please help me in giving them another round of applause.
And thank you, Rashonda. All right, as they return to their seats, we're going to dim the lights here briefly. So we have a video that we would like to play for you, and then I'm going to introduce Kara Hunter, Colorado State's bank commissioner, and then we will hear from our 2025 community bank keynote speaker. So it looks like as folks are moving out, I feel like we're safe.
If you asked a bank 20 years ago, who's your customer? They would say, everybody's our customer. Well, if everybody's your customer, no one's your customer. Your solution doesn't work perfectly for anyone. I'm Alexander Price. I'm the CEO and president of Citizen State Bank. The bank was originally founded by 30 of the top business members in the community in 1913. My family and I took over in 2016 as part of a leadership change and an acquisition. It did have all the hallmarks of a community bank, but technologically it was not forward-thinking at all. They weren't putting the money out into the community. In 2016, I was working in San Francisco in tech startups. I was actually transitioning between 2 different jobs, so I had the opportunity to come out when we closed on the bank. And I spent half my time here for the next 6 months consulting, and I learned every different role: tellering, bookkeeping, loan officer, loan admin, and just tried to understand how did they do it. Not what do we need to do, but how did they do it? And then that learning over those 6 months informed what the next version of Citizen State Bank needed to be like.
My name is Tamara Gouldy. My husband and I own Mountain Fever Shirts and Gifts.
My name is Darren Hill. I'm in the grocery, hardware, and liquor business.
My name is Robert Allison. I'm the owner of Allison Construction.
My name is Ashley King Grambly. I have been the executive director of Weehawken Creative Arts and the Ridgeway Chautauqua Society. And Citizen State Bank has always been involved in one way or another. I mean, obviously it's a long-time bank in this area.
This is a 100-year-old building, 100-plus-year-old building. I mean, it was dilapidated.
There was an old lobby with bars and old desks.
It's the kind of place where you could have seen bank robbers.
It's so nice to see how CSB has transitioned in such a positive way. Systems that they brought in, the remodel of the building here that we're in, being part of the community.
We don't really see Citizen State Bank as a bank, we see them as a partner.
Being in a small community and that relationship is very important.
They've helped us on several different deals. Because we know each other, it's comfortable. It's not starting fresh.
You know, for us, it was really about, all right, let's rethink what kinds of products are needed for our customers.
Typically, in my industry, construction, you have ups and downs.
Busy in the summer, but we still have a very weak winter business here.
And oftentimes, folks, in the summer when you're making all this money, spend all this money, and they've got a note due.
We, every summer, have to pay off the debt from the winter, and that's a stress every year, and that's what we have to factor in on our business plan in order to survive. And Citizens has made it really easy to do that.
There's a reason why you want to bank locally, and it's because your deposits become your neighbor's loans. That's not a small thing. Every grocery store that's here, they're trying to pitch that same thing. Every t-shirt shop, they're pitching that same story. So you then pitch it to them, right, to convince them to use you. Right? You believe in shopping locally, well, you should believe in banking locally as well. And so for us, thinking about the long-term vision really oriented around the work that we did in 2016, around what are our core values, what are the meaningful things to us. in the end, we had 5 core values, we now have 6, but it all came down to one core value, and that was true north. Do what is in the best long-term interest of the customer, the community, the bank, and the employees. And all 4 of those things have to be aligned. And so you have to balance all of those things together. And so we really prioritize, okay, what are the things we need to do initially? We need to invest in the physical infrastructure because the buildings were falling down. We need to invest in the digital infrastructure because we didn't even have a mobile app. And we need to invest in the people. And so for us, it was really about those 3 investment areas.
But Citizens Bank has changed dramatically.
It's great to see the growth of the bank and the vision for the future, and its cautious growth and its planned growth, no different than how I do my business. But it's nice to see there's a future plan for all the people here.
They also, I think, maybe are a little bit exceptional as a bank, or a lot exceptional as a bank, because they understand the value that nonprofits bring to a community and the livability of a community.
Because the more people you have in the community, it thrives.
Being in a smaller community, you kind of have to do a little bit of everything.
What I see is people that care, that have passion, that understand the community, that want to be involved, that want to give back.
I really believe that because they've grown, they've been able to help more businesses here.
I think whether you're big or small, in our case we're very small, it all comes down to people. That's whether that's your people or your customers. That's where the rubber meets the road. One of the things that we talk about is it's not about me, it's about we. The miracle of compound interest happens through the miracle of compound effort. The way we do it is just good service, high touch, the ability to solve problems. That's where you have the magic of any community bank. And for us, that's where we're able to really shine.
All right. Well, I am pleased at this time to introduce Kara Hunter. Kara is going to introduce Alexander Price, our 2025 Community Bank keynote speaker. Kara has served as Colorado State Banking Commissioner since August 18th, 2025. Yes. Only a couple months. In that role, she's responsible for the regulation of state-chartered commercial banks, trust companies, and licensed money transmitters in the state, but she began her career with the Colorado Division of Banking in 1998.
Yeah, don't say when I started with the Fed.
Okay, I will scratch that from my comments. Throughout her tenure, she has provided strategic and operational leadership, managing key regulatory programs, budget oversight, and staff supervision, while acting as a key advisor on complex regulatory issues and, of course, coordinating with federal agencies. Removed date of when she was a senior examiner at the Federal Reserve Bank of Kansas City. So join me in welcoming, please, Kara Hunter.
Yeah, I'd like to say I started when I was 10 in 1989 at the Kansas City Fed as a examiner trainee. So good afternoon, everybody, and thank you, Jim. But you left out a few key things. I'm the commissioner for the great state of Colorado, and also I am a proud state regulator. So I got that out there. Right, Brandon? So I'm honored to share a few words about the importance of community banking, especially in Colorado, and specifically about Citizens State Bank of Ouray and Alexander Price. Colorado is diverse, with industries ranging from agricultural to ranching to technology and renewable energy. Colorado community bankers understand these local economies better than anyone because they live and work alongside the people they serve. Community bankers provide essential credit to small businesses, farmers, families, helping them weather challenges and seize opportunities. A shining example of this commitment is Citizens State Bank of Ouray, which has been serving the community since 1913. Ouray, often called the Switzerland of America, is nestled in a boxed canyon surrounded by snow-capped peaks and waterfalls, a charming mountain town with a rich mining history and a strong sense of community. It's an unforgettable place to visit, and I'll make a pitch for Alexander, make it your next vacation choice. Just ask Jim and his film crew, they did not want to leave. And they did an excellent job on the film, but it sure did not do Uray justice. So Alexander Price, under his leadership, President and CEO Alexander Price brings a unique background of technology and public service. The bank has embraced innovation, but staying true to its local roots. As we look ahead to the continued success of community banks is essential for a dynamic, inclusive, and innovative economy. Please join me in giving a warm welcome to Alexander Price, the President and CEO of Citizen State Bank, Uray, Colorado. Good luck.
This is my speech. Just kidding. Thank you to Kara. I'm assuming right now is not the right time to discuss our exam findings, so I'll skip that for now. This has been a very interesting experience because it's kind of like going to the zoo and discovering you're actually the monkey. So we're serious people, but let's not take ourselves too seriously. So close your eyes. Imagine yourself, I'm serious, close your eyes. Imagine yourself in a small mining town in the early 1900s. You're surrounded by peaks that are almost 3 miles high. In that town, fortunes are literally carved out of the rock. Where over 30 mines hummed, and the Camp Bird gold mine had just in the last 5 years pulled out 1 million ounces of gold. That is Uray in 1913. So open your eyes. Now, imagine a saloon in this town, old-timey piano playing, and there are 30 business people sitting around, and we actually have, and I don't think it was in this, but we have a picture of this, and they are sitting in a saloon, just chit-chatting away, and they're talking about making a bank. That was how banks were done in 1913. And that saloon that they were having that conversation in ended up becoming that building that you just saw, that we did a historic renovation on in 2018 and 2019. And it is an excellent embodiment of the way beginnings happen. So it's been 112 years since we were first founded. We've had to change a lot in that time period. We have all had to change a lot in that time period. We have our original FDIC certificate on the wall. We were already 20 years old when that certificate went on the wall. So think about this in 1913. When in 1913 there were 24,000 banks. That number grew until 1929 to 29,000 banks. And then some things happened, and something went off a cliff. That number came down pretty quickly. But it really, our perseverance over the last 112 years really goes towards who we are as an organization, who we are as a community bank. And I would say, even though it's our trademarked motto, I think it applies to most community banks. And that motto is yesterday, today, and tomorrow. You have to know where you've been coming from, to know where you are today, to know where you want to go. But you can't be burdened by what you did before. That won't work. If we had done things the way it was done in 1913, or 1920, or 1940, or 1960, or 1980, we wouldn't be here today. We have to pay attention to, where are those students? I don't see them. Oh, they took off. I hope all of you heard very carefully the way they responded to those questions about banking. Because my number one question was, do you guys have a community bank? And we need to be paying attention to that, because that's an existential threat for all of us. And I know we're all running good, sound, safe businesses, and we're being responsible. Not everybody is doing that, and not all the actors are doing that. I think a lot of the community banks are doing that with zealotry. But that doesn't mean that Square is. That doesn't mean that Apple is. That doesn't mean that Amazon is. And so one of the things that I talked about in the video, but is really key, is that concept of true north. It's that balance of your customer, your community, the bank, and the employees. And everything has to be in line. You can give a customer a 10% loan, and that's great for the bank. You're going to make a ton of money. But it's not great for that customer. They're more likely to end up in a debt spiral. By the same token, you can give them a 10% CD, and they will be overjoyed. But your NIM is going to go through the floor. And you have to have that same partnership as the bank with your employees. We're an ESOP, and I was actually very happy to see Jim say that they're also an ESOP. We firmly believe that you have to be thinking about 10 and 20 and 30 years out, because that's where good investment is made. We have a long time horizon. You expect that if you're going to be around 112 years, you're kind of planning on being around another 100 years. That's a goal that you want to have. Now, we were founded in a mining town, so let's just say that it still maintains those characteristics of grit. Right? Mining is a tough job. It requires an incredibly strong work ethic, a commitment to relationships, a commitment to community. But we're founded in 1913. By the early 1920s, mining was going away. And that was, like I said, within 20 years of 1 million ounces of gold being pulled out of the mountains. It can change like that. What we're doing can change like that. But we didn't wait for a bailout. We tried to figure out, how do we reinvent ourselves as a town? Not just as a bank, but as a town. And they decided to pool all their money together and actually build a literal pool. So the Uray Hot Springs, and I don't know if Corey, who's actually right there, he's going to be the unsung guy. Corey's taking pictures today. He was out there. They pooled all their money together and built the Uray Hot Springs. That's what Uray is now known for. And it's been 100 years of the hot springs drawing people in from outside the community. So we went from miners to being hosts. That is a pretty dramatic transformation. I don't know how many miners you guys have met. It's quite challenging. And there are still miners around. There are still a couple of active mines here and there. It's a company, it's an organization, and it's a community that refuses to be defined by what we've lost, just by what we're about to become next. We are all going through that transformation right now. You cannot lose your sense of purpose or your sense of connection to the community. When we say yesterday, today, and tomorrow, and our belief in True North, it's not just branding. It's actual operational DNA. So I told you this wasn't my speech, and it's not. This is our ledger book from 1926, August of 1926 to 1930. This page here, that's noted as Booster Day, is Black Thursday. That's the beginning of the Depression. Black Monday and Black Tuesday are the next 2 days. When that happened in our country's history, you had to figure out what was next. And it happened not just this time. This was probably the most significant time. But we did it over and over and over again, and you just figure out, how do you survive? And then you figure out how to thrive. And you survive it by adapting, by evolving, by listening to what your customers and your community need. And one of the things that you heard in the video was, in 2016, we arrived, and by the way, the bank had been for sale for 4 years. So the employees had been in limbo because the previous owner had passed away. So they had gone through 2 or 3 unsuccessful sales processes. This is in a community of 1,000 people, by the way. This is no small thing. There were probably 15 people employed. This is a sizable employer in the community. And we came in 2016, and there was no mobile app. Typewriters were being used to do loan documents. And I know that sounds crazy. I'm going to remind you what date. It's 2016. There were typewriters. And I came in, and I had this fintech bravado, thinking I knew, we'll be fine. We can figure this out. I just get rid of all that stuff. But it lost the essence of what it could have lost the essence of what it really needed to be. We also had, alongside the typewriters, 5 paper vaults. This is in one bank. We had stuff from 1945. In fact, the regulators probably would have encouraged us to burn it down, which almost was the result for the buildings, like I said. The buildings were falling down. And so when we came in at first, the nice part was, for me, the strategic plan sort of wrote itself. By the way, I do want to thank Jim Fuchs and Corey, and there's actually a guy named Mark who's sitting behind this wall, hidden. He's the one, they're the ones who produce all the videos. Jim gets all the credit. They do all the work. You guys did such a good job editing that video, you made me look like I knew what I was doing, and I don't know how. But the key word actually in that sentence is doing. We were doing a lot, because you have to try so many different things to figure out what's going to work. One of the things that we talk about is one-way doors and two-way doors. One-way doors are, like we all know, they're like wires. That goes out, you're not coming back through that door. So you better be right. A two-way door, you can go through, try something, and come back. And you're back on safe ground. But a two-way door, the key thing is go quick. Because you need to learn that thing. And we made a lot of mistakes. Don't worry, Kara. Not those kind of mistakes.
That's between you and me.
Yeah, right, exactly, exactly. And like I said, I had this mentality of coming from this fintech. I was in San Francisco in startups before, and I thought I knew all the answers. That probably sounds like a lot of fintech partners that you guys have worked with. Don't worry, I've got the answer. You have to know your customers. You have to hear what they're saying. It wasn't until I joined full-time in 2019, when I wasn't a consultant, that I really understood what was special about community banks. Community banks excel in crisis, whether that's a really big crisis like the pandemic, or a really small crisis like a death, a divorce, fraud, identity theft. That's where we do a great job, is because that's where you want to come in and say, hey, I have this problem. And it is so unique to that person that no AI system could possibly say, here's exactly what the solution is. In the crisis of COVID, we delayed loan payments for the first 3 months. I'm sure a bunch of you guys did the same thing, and we became experts in PPP. Basically, the federal government made us all, I think there are hundreds of thousands, if not millions of us, bankers, made us all captains of the recovery. We became unemployment insurance people, effectively, which was quite a brilliant strategy, actually, like when you think about it in retrospect. We were talking about this earlier. We were on a conference call with some of our congressional leaders, both parties, talking about what we needed to do with PPP as that plane was taking off. We were slapping on wings and putting on engines and explaining how the implications of what they were thinking about putting in place, how they were going to create problems, and then Congress actually made the changes to fix that problem. It was one of the best examples of solutions coming through bipartisan work that I have ever seen, and to be honest, I used to work in politics, so that we did kind of everything. We learned how to do we did webinars. I mean, because you weren't going near anybody. We figured out like little niches that we could help on, little sets of folks that we could really be powerful for. Because in crisis, people trust other people to organize them. Banks have a responsibility to be a stabilizing presence. In 3 of the markets, and this actually goes to the papers that we were talking about bank failure, in 3 of the markets, we are the only bank there. We're only in 7 markets. It's almost half of our markets. You have to take that responsibility so respectfully. You know, you can't charge too much. You have to be fair. You have to take care of that community. It also means sometimes you have to say no to somebody for a loan. It also means sometimes you have to say, you know what, I don't think we can lend you this. They might be upset, but you're preserving yourself. You have to be thoughtful. You have to be conservative. But here's the change that's on us right now. This is a period of significant transformation for banks that, besides maybe the Great Depression, we may never have seen. And that transformation is the AI revolution. Now, we talk about it, and I know we're talking about it tomorrow. As banks, we think, oh, that'll come. We need to be ready for it now. We need to start to experiment now. Because it's just a continuum, right? The AI revolution is a descendant of the cloud revolution, is a descendant of the internet revolution, is a descendant of the computer revolution. So if we think it's not coming, or it's just a little ways away, the biggest harm is that we're wrong. But if we're wrong, that probability is enormous. That consequence is enormous for us. And one of the things that I think we want to think about as it relates to community banking and AI, which sometimes seems opposite to each other, is you want to think about the conflict between ethics and automation and real experience versus artificial intelligence. 2 years ago, Mike Van Noorstrand, who represents ICBC, the Independent Community Bankers of Colorado, and I were in a meeting in Durango. And there's a really wonderful FDIC examiner, I won't mention their name, but they said, how many of you use AI? Now, the way they asked the question, the answer was a given. Because the answer was supposed to be no. And me and a couple of the other people sort of foolishly or naively raised their hands. And then a couple more people sort of raised their hands. But it was still a small percentage of the room. And the thing we have to realize is we have to be raising our hands to that question. Because even if you're just experimenting, even if you're just using ChatGPT to write your emails, my gosh, it's going to save you a lot of time. We know that the change is coming, right? This book is an embodiment of the changes that we've all gone through. How many of you guys run your business on this? Right? So you know that there was change. There probably needs to be change going forward as well. Now, being a small bank and a small business, and we're like I said, we're very small. We're $200 million. I actually look back at all the speakers. I think we're the smallest speaker that's ever spoken here. Jim, you probably know. But the thing we want to think about is, well, let me tell you a story. It's about a woman named Jessica. She's on our team. I think many of you who are bankers, or even the regulators, you've seen these people in their organizations. You've seen a Jessica. Jessica started as a part-time teller. She's now been with us 20 years. She started as a part-time teller when she was 15. So she's still very, very young. She was a part-time teller, then a teller, then a loan admin, then a compliance officer, then a senior loan officer, then a chief lending officer. So she's now our chief lending officer 20 years later. I always joke, she is Jessica GPT to me. Because when I have a question, I give her a call. And I say, Jessica, I don't understand this thing. And there are a lot of times I don't know what the answer to something is. And she has the answer. But the scary thing about AI is that Jessica's skill set and then every one of your most knowledgeable people can be served up much more efficiently to other people. And in particular, you want to be thoughtful that it's served up diligently, right? In a way that feels connected. Now, AI is very capable. AI actually, in some ways, can go back to 30 or 40 years ago about how we used to run banks. Because AI has an incredible ability to catch fraud, right? It excels at those minute anomalies. So check fraud, we heard about earlier today. There are check frauds that honestly are almost hilarious to watch. Insofar as you see the check, you can see the cursor where the editing software was sitting. But if you're doing, no editing or no auditing of checks below, say, $1,500 because you can't look at 1 million checks at a time, you're not going to catch that until the problem's identified, you put a stop payment on, and you start looking at them. AI does not have that problem, right? In 1980, you probably remember you used to have checks, and all those checks would come in bags from the Fed, and you would look at the check and go, no stale date, signature right. You cannot do that anymore. You won't exist as a bank. AI can do that for you. It's like having 10,000 tellers. They don't need to drink coffee. They don't need to go to bed. They can operate all the time, and they're going to remember every single check from the last 10 years. That is incredibly powerful. They're also incredibly good at dynamic risk monitoring and interest rate management. Right now, and granted, we're small, so I'm sure some of the larger, Jim's Bank, Bill Bickle's Bank, I'm sure they're doing much more complex things. But for us, we run 3 interest rate scenario situations. It is like driving forwards while looking backwards and steering the steering wheel every 90 days. It's sort of madness. And that's one of the things that AI is able to take all this data and continuously adjust as you go along based on the decisions that you're making, the changes that you're making with your balance sheet, your income statement, how things are coming back from the communities. Are you having success opening deposits? Are you having success with the loans and the rates that you're charging? It is also very good at operational efficiency. So, as an example, we did a thing with Jessica, and Jessica was totally willing to do this, where we brought on a fintech partner, but we set up the contract where it allowed us to effectively test it out. And it was a loan spreading software, because Jessica is not valuable spreading tax returns. She's valuable analyzing them, she's valuable building the relationship, but just sucking stuff out of an IRS form is not useful for her. And so, and to be honest, full disclosure, it didn't work. But that's okay, right? That's a two-way door. We went through, we came back. Now, it will improve our ability to do loan processing. There's no value in a loan admin sending 15 emails to a customer asking again and again and again for, I missed 2022's tax returns. That's not useful. It doesn't build any relationship. If anything, it annoys the customer. AI is never going to replace Jessica. She's so talented. But it may replace her to-do list. It's going to allow her to focus on the right kinds of things. We also know, and we talked about voice impersonating, AI is going to allow the bad actors to be very, very effective. You no longer get bad phishing emails where the grammar sucks and you can catch it right away. That doesn't work anymore. So we have to be alert, because you're going to need other ways to use AI to catch the AI, basically. Now, the AI revolution is not keeping me awake. The question is that in our rush to automate everything, are we going to lose the thing that makes us really successful? And that's the people. Because the people are the thing, like you saw here in the video, the people are the thing that make us really great. Now, where humans need to lead is with experience and real intelligence, not artificial intelligence. AI does not have a moral compass. It follows instructions, not values. With a concept like True North, or whatever you might have at your community bank, that's exactly how you're going to be rooted. That's how your people are going to be rooted. Because AI can tell you what's legal. It is not going to tell you what's right. It can impersonate maybe what it thinks is right, but it's just imitating that experience. It also lacks local context. So AI is trained on big national data sets, big global data sets. Even if it ingested every single thing from your local newspaper, and there are a lot of really great local newspapers, we have a really great one, it's still not going to understand the texture of those communities. It is something that really has to be felt. And I'll give you an example. There was a Knights of Pythias, which is sort of like the Elks, but 110 years ago, a Knights of Pythias building in downtown Montrose. In downtown Montrose, this building had been dilapidated for the last 10 or 20 years. These customers, we sort of had a passing knowledge of them. They had gone to about 10 different banks and asked for a loan because they were going to build a hotel. And they were going to do it with state and local historic tax credits. Every bank had turned them down. Well, it just so happened that we have actually done historic renovations with historic state tax credits and federal tax credits, so we understood what was going on with them. An AI system is not going to know all those different pieces and how to put that puzzle together very effectively. And the nice part is, it's now, it's won a historic landmark award. It's the kind of thing where we actually didn't take any more risk, we just understood the risk better. And that's the key thing. AI is also not going to be able to effectively empathize. It's going to simulate empathy. It will look like it's saying, I'm so sorry about that. And it's one of the things that actually makes it excel at customer service sometimes is it doesn't take offense to the abuse that you're giving it. Everybody knows, everybody's done that to a chatbot, or, don't pretend like you haven't. That artificial experience doesn't equal a real relationship. It can recommend overdraft protection, but it can't lean across the desk and say, hey, I've been there before. Let's help you out there. And AI, most importantly, it needs a steering wheel, right? It needs oversight. It needs accountability. That's what we provide. It's not just about what AI can do, it's about what it should do. That's why values matter. Values like True North. When you're acting in the best interest of the customer, the community, the employees in the bank, everything, you need that community to last, right? We were talking earlier about rising tide lifts all ships. When you're one of one, that ship is going up. You just have to take care of the community. Everything's going to be fine for you. So this brings me to sort of the tough truth that we're sort of facing. Geography, the thing that sort of best exemplifies where we are, we almost have a literal moat. There are 3-mile peaks surrounding where we are. We are still not immune from this phenomenon. And there are some nasty mountain passes to get there. With remote banking, digital wallets that you heard from these guys, right? A mobile first generation, and then competitors like Starbucks, Amazon, Apple, those are our real competitors. Yes, the bank down the street is also our competitor. Bill is my competitor. But not really, because there are other businesses where like the banking is sort of ancillary and they're doing it for free, or transfer payments, right? And that's where we have to be diligent. It's not our moat. It can be 50 miles to get to your bank. It's not a moat anymore because they can use their phone and fly right over the mountains. Our differentiator is our community-rooted realness. We will not be able to out-AI the mega banks. They're putting billions and billions of dollars into this, but we do need to be smart about how do we use AI, because they're going to be able to imitate great customer service, but it's going to kind of feel like you're negotiating with a vending machine. You know, you're kind of like, am I talking to somebody on the other end? So we want to be diligent about where do we point the AI. And I can't remember if it was Jim, maybe it was you, Bill, but you need to point it to your people, because now you have Jessica in their ear all the time, being able to guide them. But it's Jessica plus your CFO plus your, don't worry about the CEO, they're boring. The COO, you know, those are the people that they're going to be knowledgeable. That person in new accounts that knows new accounts inside and out in your organization, they are going to be able to be there as you're dealing with the question. And you can get somebody up to speed much, much faster. We do have to be honest with ourselves. A lot of the work that we have done at a bank is grunt work. There's a lot of moving papers around, shuffling stuff. This will free those people up. Again, like Jessica's going to be able to just go and have conversation after conversation. She's not even going to have to set up the conversations, because an AI system is going to reach out and say, hey, we'd love to find a time. Can I work on your calendar and get them in? And she just needs to show up and be the real her, because she is the real her. You don't use it to replace the relationship. You use it to enhance it. You use it to protect it. You need banking that's thoughtful and efficient, but those two things have to come together, because otherwise you've lost the whole thread. Technology serves the relationship instead of replacing it. So there are 3 sets of you in the room, and I actually have a challenge for 4 sets of people, and I'll explain why. We need to build AI that supports community banking, and that sounds very kind of nutty, and I apologize, but I do think it's an existential threat for us. The AI skepticism that exists from the regulators, from the bankers, from a lot of conservative folks, it needs to switch to AI experimentation, then to AI adoption, then to AI leadership. The nice part is about being a community bank, your size is your advantage. You're small. You don't have as much bureaucracy. You can move pretty quickly. So that's the effectiveness of essentially leveraging speed as your scale as opposed to actual size. And you need to build AI strategies with ethics and integrity as a core part for these banks. Now, to the regulators, that same FDIC examiner, he asked in that meeting, what should we do as regulators? Should we let the big banks run ahead and then sort of see where they land? And my answer was, in the meeting was, heck no, that will be a disaster for all of us, because we're going to fall further and further behind. And so we need all of you to run out in front. Kara, I was so pleased to hear you talk about how much you're spending on the Genius Act, to understand what that practically means, because for us, that's a lifeline. You're going to know much better, and you're going to have a bunch of compatriots that will teach you what is going on. And that's absolutely essential. We need you to balance innovation and encouragement of innovation with consumer protection. It does matter. We care to be regulated. We actually like being regulated. We always joke that regulators are kind of forced upon us consultants. So might as well get the most out of it. Because practically, they see 20 banks a year. I see one, a lot, the same one, over and over and over again. You know, think about creating spaces for sandboxes, transparency standards, access to fair training data. That's one of our disadvantages. We're not big enough. Now, on the researcher side, please make sure to study AI's impact on rural prosperity, because it's very easy to see how useful it is, you know, in a city. But rural prosperity, that's where most of these banks that we saw earlier, that's where they exist. And then finally, and they're not in this room, but for fintechs and vendors, maybe it's a regulator responsibility as well, partner with us, not around us. It's so easy to think, I'm Square and I have the solution. The American banking system is incredibly unique. The community banking system is incredibly unique across the world. You cannot lose that value. Stablecoins risk sucking a ton of money out of the system. It's not going to suck it really out of JP Morgan. If anything, it might benefit JP Morgan. But out of small community banks where you have $200 million, that really matters. We need AI that amplifies human connection, not that replaces it. So just as we transition from a mining town to a tourist economy, we're now transitioning into an AI-enabled era. In 1913, it was 30 businessmen versus the world. And what they were really practically creating was a community resilience engine. And we now need to do that for the AI age. We need to lead it humanely. We need to be in an era where a 112-year-old startup becomes a 21st century innovator. The question isn't whether AI will transform banking. It will, it is. The question is whether we'll let it transform us or whether we'll become less human. But we really need to become more human. AI is like the gold of this era. How do we use it to help us prosper? In the 1920s, when conventional wisdom said, cut your losses, and there were other banks in UA that did, they left. Cut your losses and leave. Our citizens chose to reinvest and reimagine what their future was like. We have to recognize that the next gold isn't in our mountains. It's in our willingness to adapt. And it's in our people. And how do we pull that out of them using the technology that comes in? 1/3 of you run banks, 1/3 of you study banks, and 1/3 of you safeguard banks. But all of us serve the same communities. Today, we're going to write the next chapter. AI might optimize the journey, and that'll be great. But only real intelligence, rooted in empathy, ethics, and experience, is going to know where we're going and guide us in the right way. Thank you.
All right, one more time, please join me in thanking Alexander. That's fantastic. All right, well now it is, we are going to wrap up day one of the 2025 Community Banking Research Conference. We have had quite a day. What a long range of insights, perspectives. And to wrap everything up for us, I am pleased to introduce our head of banking supervision here at the Federal Reserve Bank of St. Louis, Carl White. Carl has more than 35 years of experience in the supervision division here at the St. Louis Fed. He currently is Senior Vice President of the Supervision, Credit, and Learning Division. Throughout his career, he has served in various other roles within safety and soundness supervision, beginning his career as an examiner. He has served as a lead instructor and course developer on numerous Fed system training courses, including an international assignment in Brazil. In addition, he served as a central point of contact for the district's largest state member bank before and during the financial crisis. He and his team were nominated for the district's President's Award for Innovation as a result of efforts to implement and enhance off-site loan review and examination processes. I've had the pleasure of working with and for Carl for a number of years, and I am pleased to welcome him to the stage.
So I get to follow the dynamic keynote speaker who got 2 rounds of applause, and I'm standing before. Yeah. And how did I not get to go on that trip? We got to talk. All right. Well, good evening, everyone. As Jim said, I've been part of this conference since its inception 13 years ago, first as just a participant, but then on the planning committee. And now, more importantly, to all of you that are actually here in the auditorium, I'm the person who stands before us and our wonderful reception. So I'm going to be brief, but I would like to share some comments about my observations about the conference as far as day one. But first, I'd like to thank the rest of the planning committee, And a big thanks to all the support staff here in St. Louis. From when you walked into the building, our law enforcement, our folks that greeted you, got you in the door, all of our support staff, our tech support, everyone on the team. I'm not going to name everybody, you know who you are. Thank you, thank you, thank you. But I do want to specifically thank 3 people who will start for next year. Are we going to cancel Friday's call? All right. Next week, we're going to start planning for next year. So Jim Fuchs, obviously, Summer Dumont, and Amy McDaniels. Those 3 put in hours and hours and hours of work putting this together. So big thanks to those 3. So as I said, let me offer a few thoughts on what transpired today for day 1. I think Vice Chair Supervision Bowman kind of summed it up very briefly, but very well. In her comment, she said that this conference truly matters, and it really does for all of us. One overarching theme is that this is a room of experts who care deeply about community banking and the community banking business model. First of all, mention our researchers. They spend months and months, maybe in some cases years, trying to understand community banking on a much deeper level. They ask difficult questions. They challenge us, which is good. And they search for answers to those questions that may be counterintuitive. I think we heard some comments today that maybe we might not all agree with, but answers that, when thoroughly researched, contribute to our knowledge and understanding of community banks, which is what this conference is all about. Our community bankers in the room are master practitioners of this craft of community banking. We've heard a lot about relationship lending today, about how they synthesize information from a variety of resources to make decisions that lead to business creation and support the health and vitality of local communities. Our regulators, and I'm a proud federal regulator. See, no applause, none. That's the difference between the states and, nothing. But our regulators understand that a banking system works best when all of a bank's stakeholders trust that the bank is working in the best interests of those who depend on it. We as regulators think about risks, we think about trade-offs, but also understand that bankers need to make choices in order to expand and grow. Regulators have the luxury of seeing intimate details of banks across business models, across different geographies, and can use that knowledge in discussions with the banks that we supervise. Despite many challenges faced by banks in recent years, we've gone through the pandemic, competition from non-banks, cybersecurity risks, the introduction of AI. We continue to see the almost unbridled optimism of community banks through the CSBS annual survey. And yes, community banks are experiencing margin compression. They are concerned about core deposit growth, but the CSBS survey shows that bankers are quick to identify challenges, figure out a strategy to manage those challenges, and look ahead to what's next in the future. The research presented today was provocative. Our researchers presented interesting evidence around the motivators for opening and closing branches, and our community bank discussant offered really interesting insights into his bank's branching strategy and how they think about branching in a way that runs somewhat counter to what the researchers found. We saw measurable impacts of bank failures on small business lending and heard from a community banker who weathered the challenges of the 08 and 09 financial crisis. He saw firsthand the impact of bank failures in Georgia on local communities and on the businesses that those communities support. He saw how the loss of confidence in one or two banks in a market can impact all banks in a market, but he also showed how banks can and do lean in during times of crisis, supporting communities' recoveries and rebuilding trust. We heard from leadership at the Fed, at the CSBS, and the FDIC who confirmed the importance of community banks as key financial intermediaries, but also as economic engines in the communities they serve. This afternoon, we heard from our 2025 case study winners from the University of Tennessee at Martin. They reminded us that the mission of community banks is appealing to the younger generation. Perhaps we just need to do a better job of articulating some of its virtues to those graduating college and embarking on their careers in banking, perhaps, and maybe even in regulation. And we just heard from Alexander Price, our community bank keynote speaker, who described how the North Star of his bank is not only an idea, but it's something actionable that drives lending and investment decisions and forms the basis for the bank's entire relationship with its customers. So this was a very full day. I'm glad that our conference team records and posts archives of every session. We've reminded you many times today, communitybanking.org. If you don't have it bookmarked, do it now. I suspect many of us will be going back and reviewing those sessions from this year's conference and maybe even from prior year's conference. Tomorrow we'll continue to add to the discussion as we feature insights from our own Reserve Bank President Alberto Musalem and also Federal Reserve Governor Michael Barr, who is in the building. We'll also hear from our third research panel, who will discuss the role of technology in small business lending. And then our capstone panel tomorrow will feature a team of experts who will discuss the strategic choices many banks have to make in order to continue to expand while still meeting the unique needs of their customers. So with that, I'd like to thank all of our presenters today, but I'd also like to thank all of you who actively participated here in the room and also online. And so as we close day one and move to our dinner reception, we're going to be there in less than 3 minutes, I promise. I'd like to wrap up with some interesting references from today. Math problems, fire trucks, Mary Poppins, zombies, bells and whistles, True North, monkeys, saloons, and miners. But my favorite was from Bill Bickle. Community banks are the hobbits of the banking world, but also the heroes. So we are honored to host this conference every year. We look forward to ensuring that this annual forum continues. We're going for 20, right, Jim? Maybe 14. Let's go. And so we will reconvene back here tomorrow. Doors open at 7:20. Breakfast will be served. We will start promptly at 8:20. So make sure you're seated and ready to go. Thank you all. Have a great evening. And literally right outside that door is food and drink. Thank you.